Good morning, everybody. It's good to see you. Thanks for coming. I hope you're doing well. My name's Jeff Gibby. I'm going to read a legal disclaimer and kick us off today. Thanks for being here. Thanks for being part of this session. A couple of things as we get started. If you have questions and you're watching us on GoToWebinar, just click the questions button. It'll allow you to submit a question, which we will be able to see and we will answer. If you're watching us on YouTube and you have a question, just type it in the chat. I hope you're doing well. I appreciate your being here. And if you are watching us on YouTube, I'd remind you that if you like, comment, subscribe, all those things really help. We appreciate them. It'll help you kind of help us continue to deliver events like this one. So I believe I promised a legal disclaimer. Let's go ahead and get going. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. So I hope you're doing well today. I appreciate you being here. Beautiful spring morning. My goal for you today is for you to learn something. I hope that it's helpful for you. I hope it's informative. I hope you learn something. So as we get started, I do want to say thank you to our sponsors. I want to say thank you to Stocks and Commodities Magazine. They've been running articles since 1982. It's a magazine that stocks on technical analysis. They've supported us for years. They've supported the Online Trading Summit and what we've been doing for years. They've been publishing since 1982. If you haven't registered and you want to, you can get a free issue while you register if you go to metastock.com/traders-summit. Also want to say thank you to the Traders Forum. The Traders Forum is a place where you can hang out, chat with other traders, learn about the markets, learn classes. It's a community of traders. Everything that I just kind of talked about is free, and you can join for free at the tradersforum.com. Community of traders. We've got about 1,400 members now, and it's growing. So come join us at the tradersforum.com. Also, we are MetaStock. MetaStock is a software company. It's been creating software to help you do technical analysis of the markets, stocks, futures, options, whatever you might be. We've been working on that software since the 1980s. It's been rated #1 in its price category for like 32 years in a row, 33 years in a row this year. You can get an extended trial of that at metastock.com/summit deal. I need to update the slide, I think. metastock.com/sales chat, or you can give us a call at 800-882-3040. I do want to welcome our first guest. Our first guest here today is Jeffrey Scott. Jeffrey Scott has got his MRI methodology. Very, very smart trader. He started as an oncologist and is a doctor, literally. And as such, he has to make all of his trading decisions at the night, and that's what he kind of specializes in doing, is figuring out what he wants to do and position himself at night so he can kind of stay busy and stay working during the day. Jeffrey, let's go ahead and get you started.
All right, sounds great. And let's see, can't access my camera. Wonder why. Well, the camera was working, but I'm not going to spend much time worrying about the camera then.
Yeah, it was.
You saw me. It's strange. And I want to put you on this screen, which I believe is screen 2. And so just starting to share.
Okay, I'll let you know as soon as I can see it.
The little circle thing going around. Uh-oh, we apologize. Difficulties with video conference and are able to share your screen. Try that.
Let me try something on this end. I'm going to go ahead and make you an organizer real quick.
Okay.
Well, actually, no, you are an organizer. That's so funny because everything just worked.
It worked now. Okay, so you'll close so I can maximize mine.
Yep, I'll go ahead. I can see your screen. Almost. almost had a little bit of a concern there, but it worked on the first try.
Yeah,
So,
who knows why. All right. Well, thanks everybody for joining today. As you heard from Jeff, my name is Jeffrey Scott. I am an oncologist, cancer doc, but my real passion is trading. And what I'm going to talk to you is about how I look at the markets. And as Jeff mentioned, sort of my shtick is that I actually, well, you'll hear I quit practicing. I have a company with over 3,000 employees that I'm involved in running, and there's no way I can trade during the day. So I had to develop a style that I could continue my passion of trading, being in the markets, but doing it while working full time. So I changed up my presentation a little bit because of the current markets, and I think that's the theme today. Now, this in the lower left-hand corner, and Jeffrey, I put this link in the chat box, is actually my slides. So tinyurl.com/Scott, and then 32026, basically, the month and the year that we're in, and you can get a copy. If you don't get them, they're in the chat box now. So I'm going to go forward. And let's see. That's what I need to do. All right. So this is for educational purposes only. You already heard the disclaimer for MetaStock. It's the same thing. If I talk about any stocks, it's in the spirit of education, not investment advice. I like to show you how I use my tools to look at the market from a top-down perspective. I'll talk a little bit about why. Obviously, trading involves risk, and you are solely responsible for any decisions you make, and you should always be consulting with your financial advisors. Now, I basically took screenshots of everything that I wanted to show today, and they're in the PowerPoint. Now, I've got MetaStock loaded, and I prefer to go through that. But what I'll do is I'll go back and forth, and I always try to have it in the PowerPoint, one, so you have your notes, but also because in case I have technical difficulties, which has happened before. Now, I do have a couple of ways of communicating with people. One is through a Google group. These are great because I don't really keep a mailing list, which is always fun when I try to invite people to come to MetaStock. But what I did is I started a Google group. It's free. Every night I post something about the market. I post it in the Google group, sometimes on YouTube. And when I do, I like to do education, which you'll talk about. Much of it's free. I invite people in the Google group. So just go to Google group, sign in, go to all groups. And then my group's called Top Down Trader without the hyphen, or I guess whatever that's called. And just let us know how you want to be contacted. I'm also on YouTube. You can see either my name's Jeffrey Scott. Just either search for Jeffrey Scott Stocks or at JAS Cancer Doc, which is what I am. And that is a picture of me from 25 years ago. So I am a board certified cancer doc. I've been trading since the 90s. I quit practicing in 2001 and was fortunate to be able to start up a number of companies that have been successful, sold them to public companies, including big companies like AmerisourceBergen, now called Cencora, Cardinal Health, and others. And so because of my day job, I've had to figure out how I can keep my passion about the markets, but not be at the screen all day. And I love to teach, and I've been teaching people to trade for over 20 years. I do it through a lot of online tools, and then I hold a couple of live seminars a year. And to keep my mom happy, I'm still active in cancer research. She thought I was crazy when I quit, but my company has a large data set of active cancer patients, and we're involved in helping people get into clinical trials, improving quality of care, and then actually studying the data and understanding where gaps are so we can make people better at what they do. So I'm a top-down trader, and all of it's about the market. And for those that don't understand why the market matters, you just have to look at the market we're in right now. I consider myself a swing to position trader. I can't be a day trader. So I will enter positions and hope they stay good for a while. And some of those will stay good for a long time. I have long-term portfolios, which I try and ignore from a moment-to-moment perspective, but I have a shorter-term portfolio, which is what I actively manage. I use daily and weekly charts, indicators and scans to help me find setups. and I trade equities and equity options. And my A trade, and I once went to an Alexander Elder conference, and he made us go up and talk about our A trade. And I had no idea what he was talking about. Thank God I wasn't first. But the A trade is basically what's the trade that you want to take. And mine's simple. In an uptrend, I want stocks in an uptrend that pull back to support. I want to buy them on momentum off of support. And then I have rules-based for position sizing, stop management, and I like seasonality. In a downtrend, which we're in today, I'm going to find stocks in a downtrend that retrace into resistance, and I want to buy them on momentum off of that resistance. And you'll see that my scans are actually designed for my A trade. Haven't changed how I traded for 30 years, and new things like the Market MRI tool, MetaStock, make my life easier. So I can have more time for things that are fun, whether it's grandkids, Michigan sports, go blue, and my vote. And I have to do this while I'm still working full time. There are some tools that Jeff will mention at the end, and I certainly invite people to join the Google group. I do the videos. I will have at least every other month, sometimes monthly, a support training. I do have multiple platforms that I'm in, but I trade exactly the same way, regardless of the platform. Each platform has some things that are special, and in my experience, that's scanning and MetaStock, the powerful charting, the data, and the fact that, hey, I could be trading Indian stocks, Australian stocks, things you can't do with most broker-supported platforms. And then I do almost a nightly market commentary. Training events for my people that own the products, live seminars, and I answer my own emails. I don't employ a staff. I have plenty of people to worry about with HR issues at work. So marketmripro@gmail.com. I've learned things over the last 30 years that drive me. Top-down works best for me. I'll probably repeat this a couple of times. Market direction determines most of the movement, so trade the direction of the markets. The leading industries will lead longer than you expect, so find the leading industries and then trade the best stock in that leading industry. You make the most money by holding things over a long period of time. Sometimes it's difficult. A period right now in the market is not that time. Markets are never wrong. Sometimes what we think should happen is not correct. Money management matters, and whenever you think it's different this time, it's not. Speaking again of top-down, the market's responsible for your portfolio at least 50% of the time. If you are long, you probably thought you're going to make a lot of money today, and then you're probably seeing those profits are eroding as the market eroded since the open. Industry groups matter, and somewhere between 20 and 30% is the industry group in the stock. So you could be the world's best stock picker, and if you're not trading in the market in the same direction, you're not going to do well. Market determines my stance, and my long, short, or in cash. What I've been talking about on my videos is I think there's market risk both ways here. We are going to bounce eventually. So I think shorting is tough here. Being long is suicide here. And so I'm mostly in cash. I'll look for my favorite setups in those top industries. But what I really am good at is finding bottoms. And I'll talk a little bit about that because that's where you make the money. And I use different tools to gauge what's working. So here's something I added this time. And how often have you heard that buy and hold is the best because if you miss those 10 best days in the market, your performance is going to underperform? Well, this was something that I saw on Twitter from realinvestmentadvice.com. And basically, the black line is buy and hold. The brown line is what happens if you miss the 10 best days. And I think it's the 10 best days from the start, not annually. And I'll show you why in a second. And this gold one, the great looking curve, is when you miss the worst 10 days. Isn't that interesting? So it's not about being in for the 10 best days. It's really about being out the 10 worst days. So then, being a modern fella, not really, I went to Gemini and I said, what if I'm out the 10 best days of every year and the 10 worst days of every year? So not over 35 years, just out 10 good days and 10 bad days. What if I was able to be out the worst days and in the best days? And this is what the curve looks like when you look at 10 days per year. And isn't it interesting that if you miss the 10 best days of every year and you put $10,000 in 1990, that it'd be worth 2.5 to 4 million today. Buy and hold 250,000, and missing the 10 best days, you do horrible, but you do a whole lot better avoiding the worst days. So if there's not a better reason to understand the market than to avoid those worst days of the year, I think this is great proof of that. Another proof of why top-down matters is look at how you do during the market based upon the characteristics of that market. This is from a group I participated in the 90s. It still holds true today. If you look at really smart, good stock pickers, and you look at how they do based upon performance at 20 days, aka 1 month, 40 days, 2 months, and you look at by type of market, you could see that good stock pickers are really good in a strong market. They're very bad in a weak market. Now, these were about 20 of us. I participated as much as I could. I was practicing in Atlanta, and the meeting was in Palos Verdes Estates, California, on a monthly basis. But good stock pickers, growth stock pickers, who went in each month and tried to pick the best stocks, less worried about the market. And then retrospectively, we would go back and define what the market was, and then look at performance based upon the market. Now, you heard me say we went back to define the market. Sometimes it's not easy. I think, a month ago, I probably thought we were in a mixed week. We're clearly in a weak market here. And the message here are twofold. You're not going to win by picking stocks in a weak market. So be very, very careful. The second thing is, if you're in a strong market, there's reversion to the mean. So take profits. So I like to take a portion off. And then the other thing is, if you're in a really weak market like we are today, take your money off the table. Don't expect it to revert to the mean. Now, we're going to bounce. I thought maybe it was today. It doesn't look that way, although I haven't looked in a few minutes. Now, drawbacks happen. Again, it's important to know the story of the market, what the market does historically, so you can put a given day into perspective. So as of Friday, the S&P's drawdown was about 8.47. I think the NASDAQ was closer in the 10 area. Since 1980, the average intra-year drawdown, so this is 45 years, the average drawdown was 14% in the S&P 500. So to me, there's nothing abnormal right now. We are in an average drawdown period. It can get a lot worse. Okay, and you could see here drawdowns in the 30s and in the 20s and 49% in the great financial crisis, 34% in COVID. So it can get worse. The average annual gain since 1980 was 12%, and that was despite the drawdowns of 14%. So don't give up. Don't think you can't win in the markets ever, and don't bail from this awesome thing that we do of trading because you're going through a bad period. That's why I'm sitting mostly in cash. And we have weathered so many storms. I remember the dot-com happened a little later than I thought it would. The flash crash, one day, massive reduction. The great financial crisis, COVID, and more. And it turned out I love those things. And I'm going to show you why in a few moments. So first I want to teach you one of my indicators. And this is one that is not crazy hard to create. It's called the bongo. And the bongo is my interpretation of a trending indicator. It came out of one of my mentors asked me and 4 or 5 guys to develop an indicator to time the market. And one of the 5 of us was a mutual fund, was a money manager. And he used to run an ETF portfolio using the weekly timing model to get him in and out based upon the bongo. So the bongo really looks at 2 different things. It looks at price versus a 9-period simple moving average. And then it looks at 3 different Wilder RSIs, 8, 14, and 19 periods. And it looks at the order of those, with the 8 being above the 14, above the 19. Now, the first day that you trigger the first bar, because it could be a weekly or an hourly chart, the first bar that both of these occur triggers a long signal. The first bar, and we would say this differently, that signal will stay in effect until the first bar does the opposite, where the 19 is on top, then the 14, and then the 8. And so I've actually developed ways to scan for pullbacks and retracements by looking at 2 different time frames of the bongo. So it has been a very effective signal for me. It is slow to develop. It may get you out a little late, but my goal is to minimize my what's the word I want to use? The shrinking of my portfolio, and I want to capture most of the gains. And in an uptrend, that weekly bongo will stay green for a long time. And when the shorter term bongo, perhaps a daily bongo, goes red, that's signifying a pullback in that uptrend. And I can develop scans with those bongos to find those pullbacks and those retracements. This is a very smart person in the lower right. And just like me, we don't look anything like our pictures anymore. The faces are similar, but the hair is a lot more white. Stan Weinstein wrote a book, I think it's in the 80s or early 90s, called Secrets for Profiting in Bull and Bear Markets. And he uses something called stage analysis. And in stage analysis, you have accumulation here. You don't want to be buying here because it may go on for years. You have markup here. This is when you want to be long. You have distribution here. And then you have markdown selling pressure here. And what you want to do is you want to get in early on a buy signal here, and you want to get out up here. It's simple, right? Well, that's the battle that we fight every day as traders. And I don't care if you're a day trader, if you trade Bitcoin, commodities, stocks, your charts are going to do the exact same thing over and over again. Now, where it gets tricky is if you're in a big uptrend, you'll go up and then you'll pause. And you won't know if this is a stage 3 that resolves higher or if you're rolling over. But you should know where the markets are, and you should know where your stocks are. And right now, I feel pretty comfortable in saying we're in a stage 4 markdown right now. So here's just a little guide, if you get my slides, of how I find the pullbacks in an uptrend. And I'm looking, for example, that weekly bongo still long, and I'm looking for the daily bongo, the shorter term, switching from a sell to a buy. Now, I want to show you in the program a timing model that I created by combining my bongo, let me get the right, with Weinstein's 30-period WMA. So this here is a weekly model, and of course you can't see anything there. So let's change the windows and let's look at it tabbed. And you be the judge. This is a weekly model. I will tell you that there is no trending model that I've ever seen that works well in a choppy market. Therefore, in a choppy period of time, and you don't need a indicator to tell you that this is choppy. Just like you didn't need early February an indicator to say it was choppy. But look at what happens when we start to trend. And so in MetaStock, you actually have the signal. And that signal looks for the first day I'm above the WMA and my bongo is green. And the signal is very helpful because there's a long distance from here. And if you look at the current markets, you could see that this was the big pullback that resolved April 7th. And that day I will always remember, and I'll show you why in a few minutes. And the timing model is a weekly model. It didn't get you in right away. It got you in May 9th. You don't have to wait. I have a daily model that I layer on top of this. But what this did is it kept you in the market until March 6th, when the market started to truly roll over. And that's the goal here. You want to capture big gains. Now you notice that we do cross from time to time below the WMA, but the signal didn't change. And that's the benefit of combining the trending indicator with the WMA. So I can look at, and we're not going to do that because we'll run out of time before I get anywhere, but we could look at the Qs, got you out up here. You can look at the diamonds, and you can look at the Russell, and they all got you out of the market before most of the damage was done. Now, to be truthful, I didn't necessarily wait for the weeklies to get out. The daily model is a pain in the, because it is very volatile. But I use the daily model, and I can show you this clearly here, to front run the weekly, both to get back in and get out. And what do I mean by front run? When that weekly went to a sell, I went to essentially 100% cash, and I'm going to put quotation marks around 100% cash. 100% cash means to me that I've either sold things or bought a put at the money at the current strike price, so that no matter what happened to that instrument, I'd be able to sell it for a value, what it was, not when I decide to sell, but what it was when I bought the put. But you could see that the dailies, and just to get the dates, I'll bring up the dailies. I actually put these all together last night so I wouldn't get into have to wait for things to load. Let me, oops, wrong way, make this easier to see. So again, trending indicators are not great during chop. This is pretty obviously that this is chop. But I think we said April 6th is the day that the weekly candle got us out. So this was when the weekly candle got us out. Yes, you still avoided much of the downturn. I start raising cash when the second and third of my 4 signal ETFs went to cash or went to sell. And you could see we've been in a sell for a long time. So I fine tune with that. So if you look at the Qs, you'll see a similar thing. Like 1, 2, 3, 4. Choppy market that resolved to the downside, and April 6th is somewhere over in this area here when the market finally turned down. So I'm using those signals to really guide my portfolio. And why? Because I've learned over the years that I don't want to be in the market with short-term instruments when we're going in a major correction and potentially a bear market. Now, I thought today we'd have a rally. Well, let me say that differently. When I looked at the futures last night, I thought today we'd have a rally. When I got on the phone with Jeff Gibby at 9:30 in the morning, I said to Jeff, feels like it's going to be a dead cat bounce, doesn't it? And the NASDAQ's turned negative already. A dead cat bounce is a rally that occurs in a downtrend. Those 10 biggest days of the year that didn't save you in buy and hold were typically occurring in a market that's pulling back. So I can be nimble and I can short-term trade for a couple of days in those rallies. And I want to for this reason. This is bigger or downtrend, bear markets, but you could see rallies have ranged from 9.3% in the middle, a 2-day rally, 1-day rally in 2020, all the way up to 48% in the Great Depression in 1930. So you may want to play those rallies. And what you could see in the duration column, they can be very long lasting, but they're still in a bear market. So it's okay to play bounces in a falling market, but unless you've got really great signals of what a bottom looks like, you have to be careful. And so why? Because look at the drawdowns to the ultimate bottom, 86%, 78%, 50%. Now, most of those are old, but 40% in 2001, 44 in 2073, another 23 in 22. So I am a detective for finding bottoms. I love bottoms. Now, I have to use other tools. Some of these are in MetaStock. Some my friend Sagar Nandi who follows me and I follow him. And most of the things I use that are weird names, I learned from a guy named Ian Woodward, who's no longer with us. I taught some of those to Sagar, and he built an app inside MetaStock, which I'll show you. But I use these breadth tools, which I'm not going to talk much about, to find tops and bottoms. Because if I find the top in addition to my timing model, it increases my conviction. If I find the bottom even before the timing model flips, it increases my conviction. I have another tool that I'm going to teach you called the high-low oscillator. So often you'll watch Carter Worth or somebody on CNBC, and they'll say, this is extended. We all know what that means. We know that the price is really high and it's had a big run, and extended things have a tendency to pull back and correct. But what does that even mean in math? Well, we figured out the math. So we can calculate extension to the upside and the downside, and I actually give it a number somewhere between plus 100 and minus 100. And for example, if it's minus 95, it tells me it's extended to the downside more than 95% of the other bars in the last X. Now I set X typically at 200 bars. I've thought about extending it to 300, but I can tell how extended it is in a grid without even looking at the chart by looking at these numbers. Why does that matter? Because on many years of studying markets and being in the markets, I found out that stocks reverse at the same level of extension as they did in the past. So if minus 95 to 100 is when they reversed in the past, what do you think is going to happen tomorrow if we're at minus 95? Probably going to bounce. And then I use these tools to spot key market reversals. Because it's not my webinar, I won't tell you what I did off the bottom in 2025. But if you think back to that slide that showed what you did in a strong market in 20 days, multiply that by how many months you stayed in the market. Because those bottoms are where money is made. And I published on April 7th on YouTube a video of why I thought a bottom was in. Now, I originally didn't put the second sentence in, but I figured didn't want to be an arrogant butthole. And so I added the second sentence, who knows if it's the bottom. It was the bottom, all right? How did I know that? This is one of my other tool sets, and then I'm going to show you in MetaStock. Someday, William and Jeff will help me get this into MetaStock. The challenge is with Sagar is you have to run fire to create the indicators. they're not, the data, the raw data in MetaStock apparently doesn't do it. And maybe there's a way at some point to address that. So these are a constellation of these breadth indicators. And this little triangle is one that nobody else has. I call it the defibrillator. And why I call it the defibrillator is how do we, somebody has drowned, somebody's lost their heartbeat, how do we get them back alive? We defibrillate them. And so I use a number of different breadth indicators, including the O'Neill follow-through day that I've hard-coded, so that I just have to look at this picture once a day, and it tells me if we've hit a bottom. Now, here's Sager's version of it. He's brilliant. I got to tell you, you should go and you should get these. All right. Here I am promoting somebody else. He's not on a lot of these forums. I don't think he's comfortable, or I think he's at a point in his career where he loves to do weekly videos. Now he has AI talking, which I miss his voice. But Sager and I had dinner together in Thailand. I've had his tools forever. And basically, these are the topping tools that I use, Hindenburg Omens and a number of other things that were firing as that daily bongo was going negative. And you can see this is in MetaStock. This is a tool called the Q Divas, D-I-V-A-S. He's got awesome tools, but you need to have MetaStock to use them, obviously, for the data, and you need to have fire. Now, just like I can do timing in the markets on the indexes, I do the same thing on the sectors. And this is a way of helping me find things that are working, and I should be looking for stocks inside them. And for right now, I'll just make it quick. Look at energy. Energy went positive in late December, right before the new year. And before we were talking, the program started, we were talking about Sinclair, integrated energies, refiners, MLPs, exploration and production. And with Brent being 115 and WTI being over 100, everything in the energy patch is hot. If you watched, I think with Landman, which if you haven't, it's awesome. There's a scene when Billy Joe, whatever his name is, Thornton, was talking about oil, and he talked about how, you know, it's got to be $65, I think was his number, for them to make money in some of these Permian Basin and other oil fields. And that the sweet spot's like 65 to 80, and I'm paraphrasing, I don't remember the exact numbers. And when it gets above 80, they worry about people cutting back, and then the supply goes up and the price goes down. Imagine if you are an oil producer and 65 is where you make money, and now you're charging in the States $100 to $115 a barrel. Anything that touches that is going to make money. Natural gas hasn't flown in this country, but it's 8 to 10 times more expensive in Asia and Europe if we can get it there. And so that's pretty much my approach from a top-down perspective. And just because I'm sitting here and I don't have the ability to look at the markets, let me close off a couple of my windows so I don't have to worry about speed. Oh, I closed them all off. Well, I'm going to close that one. Let's see. I didn't want to close that. And let's see if I left the rather. Yep, I did. Let me close off that market timing, and let me pull this up. I do look at the indexes, of course, and I look at them with traditional things, with moving averages, etc. And I'm just going to show you my tool set on them. So let's just open up this guy, which is the spiders, I believe. Yep. Whenever I have too many windows open, and all right, that was perfect. So let me just show you. Here is the high-low jump. When it gets down here at minus 100, we had a little bounce. We didn't bounce much here. We are back to minus 100. We are in an area that we expect a bounce. Now, we are in an inside bar today. It's not pretty. I mean, I certainly had hoped for a lot more. It's above the low of the prior day, which I guess is a good thing. We'll talk about my indicators in a moment. Here's on-balance volume with the moving average. On top is the daily bongo and the weekly bongo, and you could see during chop, the daily bongo is all over the place, but notice the weekly bongo never changed. Right now, daily and weekly says I should be short this market. Let's kill this one just to free up memory, and let's go back in here. We talk about my charts that I look at for stocks, and then a little bit about my indicators, and then jump into a couple of the scans. So think about what we've done. I just spent half my time talking about the markets. Why? Because half of what your portfolio is going to do is determined by the market. My stock charts have a lot on it, but I created them intentionally. I don't do EKGs anymore, but you have to be an internal medicine doc, board certified, before you can be a board certified oncologist, which means I had to rotate through things like cardiology, which means I had to learn about EKGs. And you think about it, somebody's lying there. Often they can't even tell you anything. You put these things on their body, these little sticky things with a wire attached, and then we're able to take the small electrical impulses that your body's producing and look at a piece of paper and tell you whether or not you're having a heart attack. How cool is that? Well, why can't we do that with stocks? I think I can. So here is one of my favorite stocks in the market right now to the long side. And why would I be buying anything to the long side? Because there's another thing besides oil and gas that can't get through the Straits of Hormuz, and that's fertilizer. So you've seen some nice runs in the fertilizer companies, and this is a Chilean one. So you could see the bongos on the stock. It tells me short term went bullish 4 or 5 bars ago, and the weekly bar, and this would have been, I took this shot with the data from Friday, the weekly turned positive on Friday. So we're now in an uptrend. The high-low oscillator is 50, so I don't have to worry about whether or not I'm extended. The 17-day is crossing above the 50. I like that. The 50 is below stock price. I like that. The 200 is down there. Those are the ones that I use. Now, on IBD Live, they use the 21-day exponential. If you overlay a 17-day EMA, which I learned from my mentor, Ian, with a 21-day EMA, a 17 simple 21E, they kind of overlap. So it's not that much different. So I'm assuming today the 17 is above the 50, which is above the 200. This is an automatically generated trend line, which we've broken above. Down here, I've got 8 dots, and they're labeled. 0 is nothing. The first dot is a single candle reversal called the green candle low, and the red dot is a red candle high. These typically form at reversal points. Then I use a Wilder PSAR, which I obviously didn't invent because my name is not Wilder, but the Wilder PSAR is a timing model that people use for stop loss. They'll use it for a buy or a sell signal. So if people around the world are using it as a long and a short, why don't I just put it on my charts and make sure if I'm going long, it's green. Now, in most programs, it's going to be plotted above the price when it's in a sell. It'll be below the price when it's in a day. I got enough junk on my charts. Then I have 4 dots that are my impulses. These are my EKG. All right. Before I get to the dots, we have the traditional squeeze, which is the Bollinger Bands contracting within the Keltner channels. Why do I care? Because typically after you're in a squeeze, and the longer the better, it doesn't tell you if you're going up or going down. It tells you when you break out, you're going up a lot. And look at what happened after this squeeze. And notice essentially almost all the dots as we came out of the squeeze were green, and we broke out above a trend line here. All right, well, I've got scans for breaking above a long-term trend line. I've got scans for breaking above a short-term trend line. So I look at the first dot's called momentum, and don't overthink them. The second's a breakout. The third is a big volume day. The fourth, which doesn't occur very often, is a big gap day. And then the fifth spot on top is called, which is number 8, is a, I call it my EMS. And there's actually blue ones here, which are buys. And you can't see it, but there's a blue one right here and a blue one right here. That's probably my fastest indicator. And when I was in between jobs with our companies with non-competes, I day trade, and I use that a lot during day trading. So again, download my PowerPoint, you can see that. And then the piece de resistance, as far as I'm concerned, in MetaStock is the scanner, expirations. So when we go into the program, and when you go into Explore, and you could see Q is Sagar stuff, and I love his stuff. And you know, alphabetically, it's right up at the top. I have a number of scans. All right, I have long-term downtrends, long-term uptrends. I've got momentum, pullbacks and uptrends, pullbacks and retracements and downtrends, short-term downtrend bounce or breaks, or short-term uptrends. I run these scans every night. I run them on way too many stocks. I run them on 2,152 stocks. It takes close to an hour. So I don't basically sit there and wait for it. I'm typically eating dinner. Now let me show you a couple of things you need to know. Do not leave it on load minimum records, or you'll be sending me an email, which is fine, and I'll be happy to answer it, saying, your scanner's broken. We're not getting any results. Well, load minimum must work somewhere, but it doesn't work here. The default number in here is 1250. I had played around and I still get most of my signals at 800, and that shortens the time to run. If you want to run it on today's candles or today's signals, make sure you check this. If I'm running it intraday, that's great. If I want to run it against yesterday's end of day, I'm going to have to uncheck it and put the prior day there. I run it on dailies, but no one says you can't run it intraday on hourlies, 15 minutes, etc. I don't trade that way, so I can't really say that that works. So typically, I will come in here and click them, and there's 7 of them. Now, of course, Sagar actually has this tool called Finder, and he creates a list with Finder, and I like that list. So I use 2152. If I didn't have Sagar's list, you can take the NYSE, the NASDAQ, the Russell 1000 and 2000, and run them against this watch list, and it allows you to set your price and volume targets. But since my list is made, I run that, I hit start expirations, and I run my expirations. Now I ran them again last night so I could see the 329. I gotta be careful with the dates here. And then let me just show you the power of what you're looking at. In a pullback in an uptrend, it's telling me a couple of things when I look at this. And I didn't go over the bottom of the slides, which I need to do, because that's a secret weapon. It tells me the names of the instruments that passed the scan, how many up dots they had. Remember, those are my impulses, my EKG, the more the better. It tells me how many bars they've been positive in volume and how many bars they've been positive with relative strength. And let me tell you about that very quickly. It's incredible how good this is, and it's simple. Notice this period of time when we were in the squeeze here. Notice I talked about predominantly green dots coming out. These green dots, end of the squeeze, I just call that squeeze release. I don't want to buy when I'm in the squeeze. I want to buy it when it comes out of the squeeze. So by definition, I color the next 3 bars with dots so I could scan for them. This here, what happened at the same time that I came out of the squeeze? The blue line moved over the yellow line. Well, that blue line is a ratio of the instrument I'm looking at, SQM here, I think. Yep. Versus the spider. When this stock is exceeding the strength of the spider, that blue line will cross above the yellow. Notice this entire uptrend until it peaked, it stayed above the moving average. The weekly, the same, but the weekly will take longer for it to cross over typically. So I'm going to look for a constellation of signals that includes the relative strength above the moving average on the daily, close on the weekly because I know it can take a little bit longer, and the volume over its moving average. And so when I look for signals to buy, this was my buy, okay? What do I see? I see that we've got 3 volumes here. We got a bunch of breakouts. We had a couple of momentums. The PSAR flipped from red to green. My relative strength of the stock was exceeding that of the market, if the market's defined as the spider, on both the daily and the weekly, and my volume was moving up. So these are very important to me. So to make life quicker, let's talk about the scans, and I ran these last night. So they would be the same thing I'd show you looking at the scans in MetaStock. So my A trade is simple. It's not so easy to find in a downtrend. Oh, I want to, okay, stop. A stock in an uptrend, I want to buy it when it pulls back and starts to go higher. So I want to buy it here. I want to buy it here. Why don't I want to buy it exactly here? Because no one's that good. Sure, that's great, but how do I know it's not going further down? I want to make sure I'm out of it if it breaks support. The beauty of buying it here is my support is here, and I'm not going to risk a lot on my stop. If I buy it here, and I want to put my stop below support, that's way too much money. So I want to buy them here when they're moving up off of support. I talked about my chart, and in this case, my support was a trend line that I crossed over. I could have bought it down here, and that would have been a good trade as well, but I didn't see it down here. So scan number 1, daily momentum bullish. I have found that some of my best performing stocks have a simple finding on the impulse indicators, and that at position number 4, which is momentum, it fires 2 green dots in a row. Okay, how common is that? It's not common at all. And when I look back retrospectively, and I've traded it prospectively, it has been a very positive signal if my relative strength is above the moving average on the daily, doesn't have to be above on the weekly, and my OBV is moving up over its moving average. I have the same scan to the downside. We're in a downtrend, we retraced, and now we're breaking down. And I'm looking at relative strength breaking down and volume breaking down. Pull back in an uptrend. So this a little bit too far for me to chase, but this bar is perfect right here. And the stock is in an uptrend. It pulled back to support, and it moved up with momentum. And on that day, it flagged with momentum and volume. Relative strength was heading up, so was OBV. All right, and you can see here, now it's getting extended. It wasn't extended on that date. Retracements and downtrend, same thing. The stock is in a long-term downtrend. It's in a short-term downtrend. It retraced into that 50 and it broke down. Okay, so I would look down here for red signals in my relative strength. How about long-term downtrend breakout? Whoa, I love these in a good market. We're not in a good market. Doesn't look like it's much of a downtrend, but it is. Here's a long-term trend line. I want to find it when it breaks out, and my scan will find it when it breaks out. Long-term downtrend bounce. This is that retracement trade. Somehow this is considered short, this is considered long. William programmed it, it works. And basically I traded up into the trend line and I bounced and I went further down. Long-term uptrend, here's my long-term trend line. I want to find it. Remember that chart of the that I hand drawn? You buy it when it pulls into that trend line. It's perfect. How about a long-term uptrend breakdown? Here's the long-term uptrend. It was supposed to bounce. It didn't. It's a sell. And this was run on Friday. So what was this? This is a pretty good looking sell. Western Union. I can't even believe they're still in business. Short-term downtrend. So just the trend line is shorter. Trade into it, bounced. Short-term downtrend, breakout. This is how I found SQM. It showed up on 2 scans. Short-term uptrend bounce. Here's your short-term uptrend. Pulled into this and bounced. I basically, through the brilliance of William and the massive value of MetaStock, I've been able to recreate my A trade. Short-term uptrend here. I failed at it. I broke down. And I'm able to find my stocks. So actually the first time I've ever finished on time. So my involvement doesn't stop with purchase of the tools. Join my top-down trading group. Look, if you buy my tools or don't, if I make you a better trader, I'm happy. And why would I say that? Well, you did hear the part about selling businesses to public companies. I'm not doing this for the money. I'm doing this because I like helping people. And why would I say that? Because that guy, Ian Woodward, the guy was brilliant. He was an engineer at Xerox. He retired. He studied O'Neill and CanSlim. And don't tell anybody IBD this. He improved CanSlim. And then there are very few of us left alive that learned from him. And his slogan was, Jeffrey, I'm not a guru. I teach you to be your own guru. And I like to play it forward. So come to the Google group. I invite everybody to the trading events, regardless of platform or no platform. And the only things up here that I charge for, besides the tools, are the live meetings. And Orange County, I don't run. It's questionable this year. My friend John Person and I are going to hold a meeting in November in South Florida, which is lovely. Any questions, concerns, thoughts, marketmripro@gmail.com. And look, I found that trading with a top-down approach has been best for me. My timing model works for me. It captures most of the big moves. It does not repaint. Now let me put an asterisk on that. It does not repaint after the bar closes. A daily bongo signal is not closed until the day is over. A weekly bongo signal is not closed until the day is over. Once the day is over or the bar is over, it does not repaint. Use the expirations to find your favorite setups and don't trade against a major trend. And so at that point, I am going to, like I said, first time ever, I think, finish on time. And thank Jeffrey for letting me present. And I'll stop sharing it and turning it back to you.
Hey, Jeff. Thank you for that. Do you have time for just one quick question?
Yes.
Neil wanted to know, what is the difference between this decline and the one in April, March, April of last year? Do you have a good answer for that?
Well, if you look at my signals, they formed almost exactly the same. If you follow cycles, the market cycle, bottoming cycle ends on the 6th, and both of them had an exogenous event. One had a tariff tantrum, and one has a war with oil pricing. They've been very similar.
Okay.
And the signals I follow on the bottoming will have a typical finding when this one bottoms as well. And I saw none of them on Friday, which is why I figured today would be a dead cat bounce.
Right on. Thank you very much, Jeff. I appreciate it.
Thank you.
All right. Very good. I do want to talk a little bit about the add-on that Jeff just talked about. I want to thank him for his time. Thanks for coming in. Obviously, there's a lot of tools that have been kind of custom built for this, and they're really, really good. So I love the framework where Jeffrey does from a top-down analysis. I love how he talks about how you should really be looking to really invest when the market's going up and why that's helpful. But I love the fact that he's got it fairly straightforward in terms of the way things work, the top-down analysis and looking at the best performing markets, the best performing industries, the best performing stocks. And that's all kind of incorporated and put together here. You have your bongo timing indicator, the dots, the high jump, the relative strength versus the S&P 500, and all the timing signals, all of it are put together. In total, the add-on has 11 custom indicators, 8 different scans, 3 expert advisors, a system test so you can go in and test and see how well it works, professional templates. And one of the things that Jeff did a really, really good job at is putting together some training videos that are available as soon as you get on there. So you have 3 online training videos that are there, help you get started, help you get running, help you get up to speed, so to speak. So normally this add-on is only $9.97 as a one-time cost. At the event today, we're doing a special where it's $5.97. We always back our products with a money-back guarantee. You'll get 30 days to actually evaluate this, try it out, see how well it works, see if it's helpful for you. And if you don't have MetaStock, I did mention a little bit earlier, MetaStock has been the top-rated software in its price category for 30 years in a row. So we'll give you a free trial to MetaStock with data, everything you need to get going. It's a very, very, unlike the market right now, it's a very, very low risk, high return opportunity. So go to metastock.com/MRI to get that. You can also give us a call, 800-882-3040. And you can also chat with us at metastock.com/saleschat. Again, Jeff, big thanks for being here. Big thanks for kind of.
Thank you all. I'm going to sign off. Thanks.
All right. Thank you. All right. Let me go ahead and actually do this. We're going to be talking about all kinds of really cool products today for MetaStock. We do have them all bundled into one package. You can get all at the same time. You can get the Market MRI, the Liquidity IQ, which Daniel is going to talk about in just a minute, Greg Capra's Master Trader Method, JBXC Complete, and then Steve Primo's Dynamic Duo. Normally, that's a package that costs about $8,000. At the event today, if you want to call in and get the Summit Action Pack, it'll only be $4,186. You can do that if you call us at 800-882-3040 or metastock.com/saleschat. Everything's discounted so much you can't do it online. You have to do it through the phone. So in any case, before we go to Daniel, I want to say thank you to Stocks and Commodities Magazine for sponsoring the event today. We really appreciate all the work they've done. If you're watching us on YouTube right now and you haven't yet, make sure to go to metastock.com/Traders Summit. And Greg is going to put that in the chat for YouTube for me right now. If you're registered today, you can get a free issue of Stocks and Commodities Magazine. And they've been a great sponsor of MetaStock. It's a great magazine that you get on a monthly basis. Lots of stocks and commodities, technical analysis tips that come in there. So our next guest is Daniel Sinnig. Daniel is a prolific developer of software, algorithms, and the like. I love kind of the thought that he puts into the methodologies that he's created over the years. And he has some of the best indicators that are out there, in my humble opinion. I like to call Daniel the mad scientist of indicators. He does a really, really good job. What he's going to show you today is a brand new product that we literally just got done with called Liquidity IQ, featuring MA Rush, and it's pretty cool. So Daniel, that's how I'm going to introduce it. Let me go make you the presenter.
All right. Thanks, Jeffrey.
Yes.
How is everyone doing today?
I'm good. How are you?
Very good. Thanks. Greeting from beautiful Montreal today. It's Yeah, it's warming up today. It's a spring-like day. It's been felt like an eternity here. Winter has been going on for a long time, but today there's some hope on the horizon. So let me see if I can find the right screen. Just give me 1 second. And Jeffrey, if you can confirm that you can see my screen.
I can see confirm something's coming. I can see. Are those beautiful MetaStock charts that I'm seeing?
That's right. Yeah, perfect. All right, perfect. And everybody can hear me well so far? No cutting
Yes.
off? Perfect.
You said
Excellent.
great. I'll get out of
Okay.
the way.
Yeah, let's do it. Yeah. Well, thanks everyone for tuning in. Also for my presentation here at the Traders Summit with MetaStock. A big thank you once again to Jeffrey and his team for organizing this. I know how much work it takes, and what a great lineup of speakers once again today. Now, what I will be bringing to the table today is a brand new indicator, which we just released, as Jeffrey has mentioned, for MetaStock a couple of days ago. So it's hot off the press, as one may say. And this indicator, and I'm not exaggerating, this indicator has transformed the way I trade. It is on every single chart I'm opening up, no exception. It's on a chart when I do day trading. It's on a chart for swing trading, longer term trading. I have it on the chart for trading stocks, for futures, for cryptos even, no exception. It has become indispensable in my trading. Now, before I talk about this indicator, let me just back up a little bit to break the ice just a bit, because I want to ask a question to everyone in the audience. And you may have seen this scene from a movie. It's a great movie. If you haven't seen it, I recommend it. It's from The Wolf of Wall Street. And the guy here on the right-hand side, he said the following line. I had to turn it down a little bit to keep it within PC, but he said, nobody, I don't care if you're Warren Buffett or Jimmy Buffett, nobody knows if a stock will go up, down, sideways, or in circles. Now, my question is to everyone out there, do you believe that is true? Do you think that nobody can predict of what is going on in the stock market? It's impossible, basically. So if you believe that's true, I think you are at the wrong place here at the MetaStock conference, because I personally do not agree with this statement. I believe it is possible, especially if you use the right tools to predict with some degree of certainty. There are no guarantees in trading. We all know this. But there's some degree of certainty that a stock, a crypto, an FX symbol, a futures contract will move in a certain way in the future. All right, now let me get back to this in a second to show you which tools I use to make these predictions. Now, real quick, who am I? So Jeffrey has introduced me already a little bit. Well, my name is Daniel, and I am one of the founders of tradingindicators.com. And as our name suggests, we are an online store specializing on developing and offering innovative trading indicators. That's where our name comes from. This is really our bread and butter. And we've built thousands of these trading indicators for clients all over the world. Most of what we do is based on what is called technical analysis, which basically is a mathematical pattern analysis of your price chart. We believe, and let's face it, let's be honest to each other, trading, in fact, is about forecasting the future to some degree, right? Where and when price may be in the future. And technical analysis is to use historical price data, to use information which has happened in the past, which is available on your price chart to predict what may happen in the future. And how this works, we're going to see together today with the right tools. And we believe that technical analysis is so much easier and oftentimes also more accurate than fundamental analysis. Because a fundamental analysis, like news events and geopolitical events and so forth, you never really know what is already priced in. And the market really moves only on surprises. But since nobody really knows what's priced in, it makes it super complicated. Technical analysis, on the other hand, we look at reoccurring patterns on your price chart. First of all, it's so much easier. You don't need a PhD in finance to figure out these patterns. Oftentimes, they can be spotted, especially with the right tools. And oftentimes, technical analysis is actually even more accurate, at least in our view, than fundamental analysis, because it's based on hard facts on your chart. No more second guessing what is already priced in. All right, now, enough about me, enough about technical analysis. Let's talk a little bit about trading. But before we do, A quick reminder that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance or really anything based on historical data on your chart, keep in mind that this is not necessarily indicative of future performance, and any setups and trade ideas and strategies discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so what do we have planned for today? Now, before we talk about the indicator, which has transformed the way I trade, I do want to talk a little bit about the concepts behind this indicator, because I think it's important to understand why it works in the first place. Then, of course, we're going to talk about which are some setups that can be spotted, and we're going to talk about the indicator, which makes all this possible. And of course, at the end, there will be some time for some Q&A. All right, now, but let's talk about landmarks on every chart. Now, you may agree with me that when looked at with the naked eye, when looking at the naked chart with nothing on it, charts at times can be quite unpredictable. Like this chart here, where an uptrend shortly reverses into a downtrend, only then to reverse once again into an uptrend. So seemingly there's no discernible pattern on this chart. And things get even worse, and please keep this in mind, things get worse when you go to the smaller time frames. Look at this 5-minute chart here where price first goes down and up and down and up and down and up and sideways. Basically, it's quite chaotic, almost untradeable. But here's lesson number one. It's going to become important in just a bit. Once we zoom out, once we go to a higher time frame, things tend to become a bit clearer, a bit more structured, a bit less chaotic. Look at this 4-hour chart here. In fact, it's the same chart, just zoomed out. Things are just a bit more, rational, a bit more straightforward. So please keep this in mind. Once we zoom out, once we go to a higher time frame, things will become clearer. We're going to use this concept later on again. All right, so that was observation number one. Observation number two, which is just as important, is that every chart, it doesn't matter what it is. It could be a daily chart, it could be a 5-minute chart, it could be a tick chart, could be a stock chart, a futures chart, a crypto chart, an FX chart. Every single chart has what we call landmarks. These are sometimes hidden levels of price or certain areas of price to which price will react in the future in a certain way. And see here, once again, the principle of what will happen in the future. Because in trading, just as a reminder, it is about forecasting what may happen in the future, where and price may be in the future. This is what trading is all about. Now, if we are able to identify these certain landmarks, which have a future effect on price, once we're able to do this, we can predict what price will do once it hits these levels, these landmarks, and then profit in the process. But of course, the precondition for this is to find these landmarks. So what could these landmarks be? Well, there are numerous reasons why these levels of price, these landmarks exist. For example, just some examples of this. An historical high, like a high made perhaps many years ago, could create such a level of price, such a landmark on the chart. And let's look at this chart here. It's oversimplified, but it gives you the idea. So this landmark was created back here at this historical high point, and then later on in the future, once again, trading is about the future. In the future, price came back to the proximity. It's not an exact science, to the proximity of this level, and it bounces off this level as if there was like a secret level of resistance right here. Another landmark that could be created is this series of swing lows. You see price like swings down and up again, price swings down and up again, and later on, once again, in the future, price comes down to this level, comes close to it, comes to the proximity, and then bounces off this level towards the upside. These are the kinds of prediction I like to make in my trading. And of course, these predictions are possible once we know where these secret or sometimes quite obvious levels of price are, to which price will react in the future. Now, these landmarks, they have different names. Some may call them liquidity levels, some may call them support or resistance levels or zones. It doesn't matter what you call it. The important point is that these levels exist on every chart. Now, you may wonder, why is that? What's the reason for this? Why is price, reacting to certain price levels in a certain way? Why is that? Who's responsible for this? Well, if you zoom back and think about it, it's really about supply and demand, and excess of supply and demand, which prevents price, for example, to trade higher instead it will bounce to the downside, or to trade lower and it will bounce to the upside. It's really a question of supply and demand. The beautiful thing about this is that we as traders, as you'll see in a bit, we don't have to worry about this. All we need to worry about is where these levels are. What's happening behind the scenes, it's not so important. For example, whether a support level is created by an excess of supply, we don't really care why that is and why these levels exist exactly at this level here. What we need to know as traders, as retail traders, is that these levels exist and price will react to these levels in a certain way in the future. Same for resistance. A price comes up to it, bounces to the downside, comes up to it, bounces to the downside. These are created when supply exceeds demand. But in the end, as traders, we don't have to worry about what's happening behind the scenes. All we need to know is that these levels exist. All right. Now, who is creating these almost magical points on your chart? Well, it's definitely not us retail traders. We don't have the buying power to do so. It's the big traders, the big institutions, the big money traders, the culprits out there who have the buying power to create these levels. And while the big players are calling the shots, what we can do as retail traders is we can follow the footprints. We can follow the patterns. And if we are able to spot these levels and identify these levels on the chart, we can find promising trade setups in the process. Now, what these setups are, let me show you right now. And I promise you, very soon we're going to switch over to MetaStock and the price chart to show you right now in the market where some of these key levels are for some interesting symbols. Let's build up to this. So what are some of my favorite setups which I like to trade over and over again? I trade these from a day trading point of view, but also from a swing trading point of view. Setup number one, I call this the bullish bounce trade. What is this? Well, first of all, a bullish trade typically happens when price comes down to a landmark. So it comes from the upside, from a higher price level down to a key level on the chart. And then this level oftentimes acts as support, preventing price from trading further downwards. And instead, price will bounce off this level towards the middle in between support here and resistance above. We call this the bullish bounce trade. And this setup, and this will become important later on, this setup is further supported if at the same time the overarching trend is also bullish. Why is that? Well, you may have heard it before. The trend is your friend. For a trending stock or a trending symbol, the chances that the trend will continue is simply bigger and greater than the chances of the trend to reverse. And why not take advantage of this? If you combine these two things, we are bullish to begin with, and we're coming down to a key support level. Two things are now supporting a bullish bounce to the upside. This is where I like to trade because it's the bullish bounce trade. All right, so that's one setup. A second setup, which I also like to trade quite a bit, is the zone break trade. Now, a zone break trade is exactly what the name suggests. It's the break of a level. Nothing lasts forever in trading. Like in life, at some point, everything comes to an end. At some point, every support level will be broken to the downside, and every resistance level, this green line here, may be broken to the upside. But when this happens, new opportunities are opening up for us once again. Because in this case, we can simply take the breakout trade, anticipating the price will continue in the direction of the breakout for quite some time after the breakout occurred. You can see it here. Support was broken, price broke below this red line here, and then it continued further down to the bearish direction. This is the zone break trade. And once again, this trade is further facilitated if the overarching trend is bearish to begin with. Once again, two things are coming together. We broke a key level to the downside, and the overarching trend is bearish to begin with. Two things are coming together, supporting this continued bearish move afterwards. And we have one more trade. Once again, I trade all three setups, but one more setup, which kind of is a mix of the bounce trade and the zone break trade. We call this one the breakout retrace trade. What is this? All right, so what do we see on this chart here? We can see that price broke above this green line here. It broke above resistance. Price initially then, this would be our breakout trade, initially goes up, but then it stalls. It stalls and retraces, that's where the name comes from, retraces back to the broken resistance level. But since this level was broken, it has now changed its role. We've heard it before. Resistance can become support when broken. Exactly this is what happened here. This line now acts as support, prevents price from trading further down, and the actual breakout move continues from this point on. Once again, a trade which is further supported if the overarching trend is bullish to begin with. So once again, two things are coming together. We have this breakout retrace setup, where first broke above resistance, came down back to the broken level, now acting as support, preventing price from trading further lower, and the overarching trend is bullish at the same time. Two different indications forecasting the same price move. In trading, we call this confluence. All right, now, you may say now, okay, Daniel, this is all nice. These setups sound good in theory, but they depend very highly on correctly identifying these levels. Because if these levels, we get them wrong, like these support levels, these resistance levels, and so forth, if we get them wrong, well, then these setups don't work. And I agree with you. It is key to be able to identify these levels on your chart. Now, we've asked ourselves the very same question. How can we do this? And you may say, okay, perhaps we could do this manually, looking at some swing points on the chart, some events on the chart, trying to draw these levels manually on the chart. But you know what? This sounds tedious. And everything, to me at least in trading, which is tedious, is something which, again, to me, is not sustainable. You'll do perhaps once or twice, maybe 3 times, but over time, if it's too tedious, it takes too much time, you will eventually give up on it. And we agree with this. This is why we have created an indicator which will spot and detect and print these zones on the price chart for you as soon as it is applied to the price chart. And this indicator is called Liquidity IQ. It only has one purpose: to identify these key levels on your price chart. That's the primary purpose of this indicator. But it's a powerful purpose, because once you know where these levels are, you can predict with some degree of certainty, of course, no guarantees in trading, but with some degree of certainty, where certain price moves in the future will happen. Whether we're going to see a bounce to the downside, perhaps a bounce to the upside, a zone break, and so forth. This is also why we call Liquidity IQ, this indicator, the instant charting assistant, because it will find these levels automatically for you. It will basically do an instant technical analysis for you on your price chart. And as I mentioned in the very beginning, when I start this talk, we at Trading Indicators, we highly believe in, or strongly believe in, the power of technical analysis. The things that have happened in the past in your price chart, they still have some significance moving forward. All right. Now, without further ado, let me introduce to you our Liquidity IQ indicator. For this, I'm going to go over to MetaStock. All right. There we go. And yeah, what do we have here? Here we have a chart of the SPY on the daily time frame. And just to preface this indicator, it will work on any time frame. I'm going to show some daily time frames first, but later I'm going to zoom also into some intraday time frames as well. It doesn't matter what time frame it is. All right, so what do we see here? Well, first off, the indicator is already applied to this price chart, and you can see on this chart of the SPY, the ETF that tracks the S&P 500s, we can see, all right, that several things. First off, you can see this little green line up here. It's a bit hard to see. It can be made a bit thicker, perhaps in your styling options, but this green line up here, that's a resistance level. So green is resistance, and look what happened to price when it approached this level. It had difficulties bouncing higher. Came up, bounced below. Came up, bounced below. Came up, bounced below. Came up, bounced below. Why is this? Well, the reason lies in the name. Resistance oftentimes prevents price from moving higher, and instead we may see a bounce off this level to the downside. Look at the support level here. This is a little red line here. By the way, these are not printed after the fact. These are printed in real time as these levels are spotted. What we can see here is that price came down to this little reddish area. I hope you're able to see this. We can make this a little bit bigger. It doesn't matter. So you can see this little red line here. It's there. Our price came down to this level and bounced to the upside. Couldn't break support. All right. All right. Now, what has happened recently here on the SPY? Well, recently we can see that price once again came down to this level, this red line here. And in this case, we saw a little bit of a bounce here, a very minor bounce. But in this case, we actually lost the level. The level was broken. And does this remind you of something? This is the classic zone break setup. We lost the key level. And oftentimes, after out, in this case, the bearish direction. Yeah, and this is exactly what we saw here. Price came further down. Today we opened up a bit higher, but now prices are coming down further. And my prediction, perhaps very similar to the previous speaker on the chart, my prediction is that we may see price levels as low as this green line here. This green line here was former resistance. And I believe it will ultimately prevent price from moving further down. We may get close to it, and then we may see some recovery to the upside. Perhaps another V-shaped recovery, similar to what we saw in the tariff wars. You can see it here. Price came down. We lost one level. Then we came further down to the next level below, a green level, and then the V-shaped recovery. And oftentimes trading and technical analysis is about finding these patterns and expecting their reoccurrence. So what do we see here? Very similar. Price lost the level, just like here, lost this red level. Breakout move further down and all the way down potentially to this green level here, just like here, and then we may see signs of recovery. This at least is my prediction at this moment for the SPY. Okay, now let me explain two more things on this chart. You may ask, hey Daniel, what are these weird lines here? These like squiggly lines here on top of some of these levels or below some of these levels. These are special events that the indicator picks up. You can see this one line here. We call this liquidity capture events. We explain all this in our bootcamp, but what this really means is that here at this price level, price came close to this level, couldn't fully break it, and the volume of the candle, which comes close to the level, or the candles in this case, is abnormally high. And oftentimes, this can be seen as, hey, if something is up, somebody's interested in this level, at trading at exactly this level, pushing the volume up. And to us, in our view, it's oftentimes a sign that, hey, the chances of a bounce are greater than the chance of a break of this level. There's no guarantees, but we can see it oftentimes. Price came up to this level, bounced off. Then all the way down here, squiggly lines, bounced off again. See this series of squiggly lines here, bounced again. Down here to this level, another bounce, but here we had a break. So there's no guarantees, but oftentimes it heightens and increases the chance that we're going to see a bounce rather than a break. Okay, so let me go to a different sim. Let's change it up a little bit. Let's talk about intraday for 1 second. All right, this is a chart of the Russell 2000 futures. All right, what do we see here? Well, in fact, this has happened this morning. This is a 50-minute chart, an intraday chart. What happened here? And I was about to trade this morning when I came to, when I logged in, because I saw the Russell coming up all the way to this key level here with a liquidity capture event. Do you see this candle here, which came close? It actually flew up a long wick here to this key level. It stopped exactly at this level, and then it came down again on this 50-minute chart with a liquidity capture event. Oftentimes a sign that, hey, price will have difficulties breaking this level, and the chance that we're going to see a bounce are actually going to be elevated. These are tradable, whether they occur on the daily time frame or the smaller time frames, the 50-minute time frame, the 1-minute time frame, or whatever it may be. Okay, now one more example. What about Tesla? Just flipping through some charts here. What do we see here? Well, let's take a look. So, in fact, what I want to point out here is, first of all, these levels are drawn automatically immediately when they occur on the chart, or when they apply, the indicators apply to the chart. But there's one more thing which is important. Let's have a look. So what do we see here? Look at this little ribbon below the chart besides these price levels. See, here it says bullish, but if I zoom out a little bit, if I go back a little bit, You can see here it says bearish. Before this it was bullish again, then bearish. This is an indication of what the current trend is doing. Why is this important? Because you can use this information as an additional filter for your setups. All right, how would this work? Let's check it out. Let's have a look here at price coming up to this green line. Okay, we're coming up to this green line, and we may anticipate, okay, price is coming up here. We may anticipate a bounce off this level. Let's see if this really would be the right prediction here. And for this, let's consider what is trend actually doing right now. Okay, so for a bounce of this level, price would need to come down, which is a bearish setup. Bouncing off resistance, it's bearish. But the overarching trend is bullish. Two things are not agreeing with one another. And in this case, I typically shy away from the trade because I like to trade when things are actually lining up. Yeah, when we, for example, come down to a level and we're bullish, that's something I'd like to trade because then both setups are for the bullish direction. Two different indications forecasting the same price move. Instead, what has happened here? Well, price broke the level. We have a breakout signal. You can see it here, there's a little arrow here. A breakout signal, and then price flew further up. And this actually is tradable. This would be our breakout trade to the upside. Why? Because it coincides with the overarching trend, as you can see here. All right, so one more thing to be pointed out. First off, we have equipped Liquidity IQ, the indicator which draws these key levels on your chart and points out these key events. We have equipped this indicator with what's called an expert commentary. You can activate MetaStock, as you probably know, via expert advisor here in the menu and go down to commentary. Once done, you can see here, okay, what is the current setup at play? I'm going to talk about these in a bit and some explanations as well, along with some trend information. For example, here, we are currently bullish for 432 bars at Tesla. Of course, if I switch this up, if I go to the SPY here, we can see, okay, we are bullish for 687 bars. Of course, the SPY, despite the current downwards move, has been bullish for quite some time. All right, let's change it up one more time. Let's talk about gold. We're going to come back to the expert commentary just a bit later. Let's talk about gold, GLD, because gold is interesting for me right now. Why is that? Let's have a look. Okay, so gold, of course, is bullish. We all know this. That's not a surprise, and we don't need once again, a PhD in finance to figure this one out. The trend has been going up for a long, long time. But why is gold, to me, at this moment, really interesting? And this, once again, has to do with our Liquidity IQ indicator. What do we see here? Well, let's have a look at this event here. On January the 5th, price, you can see this little arrow here, price broke above this green line here. You can see it here, price broke above it, flew up, but subsequently, and we know this, it came back down. And where did it stop? At this former resistance level, now acting as support. Does this remind you of something? Does this remind you perhaps of exactly this setup here? Price flew up, came back to the level. And oftentimes that's a launch pad for another move higher up. If you take this premise, along with the fact that the overarching trend in gold is bullish, one could say, okay, perhaps at this price level here, GLD on the daily chart might be an interesting setup for a long trade after this big retracement here. Now getting into this symbol at a much lower price point. Two other factors which I like about this is that we also came down to this psychologically important number here at 400. Price basically stalled out there. And we have several down gaps which are screaming to get filled above us. Of course, for these gaps to be tested and filled, price would need to come up to these price levels. So multiple things here forecasting a bullish continuation of this trend here after this bigger correction to the downside. All right, two more examples. Let's talk about oil. USO, of course, everybody talks about oil. The theme of this conference is about oil. Let's look at oil. For this, I'm going to open up USO, the United States Oil Fund. All right, so what do we see? I'm going to zoom out a little bit. Let's go back just a little bit on this price chart here. There we go. Okay, what do we see here? And before we talk about this huge move here, let's just see what did we see prior to this. Look what the indicator had found prior to this big breakout move. It found you this parallel channel. You can see this green, we have green lines here and these red lines here. And look how price reacted every time it came to the upper end of this channel. It bounced off, came down, bounced off, came up, bounced off, down, bounced off, up, bounced off, down, bounced off, and then eventually we had this breakout. Of course, in trading, nothing will last forever. Eventually, a pattern will be broken. What's important as a trader is that you can recognize this and then change your trade accordingly. So what has happened here? Look, once we broke above this key resistance level, we even got the arrow here, the zone break arrow, price flew up to the upside. Of course, politically motivated, nonetheless visible on your price chart. This indicator does not know anything about geopolitical news. It finds these trades based on historical price data. Based on the premise, hey, this key level has been now broken. And there might be a follow through after the breakout move. Of course, could we have predicted such a big follow through? Probably not, but a follow through nonetheless. And this setup, once again, was supported by the fact that at the same time, our momentum, look here, was bullish. Once again, two things coming together, forecasting the same price move. All right, perfect. One more example. Let's look at GE. All right, there we go. GE, 1 second. GE Aerospace, great symbol. Traded many times. Let me just quickly apply the indicator. And by the way, I'm going to show you right now how you can apply a template that we ship with the indicator to apply all these tools directly in the price chart. Oh, sorry, wrong option. So right click, you go here to apply template. You pick our trading indicators. Just go down here, Liquidity IQ and MA Rush template. You apply it, and once done, so you'll see the chart will reload, and the indicator now is applied to the chart. This is an interesting symbol. In fact, this was our trade of the week in our newsletter last Monday. Why is it the case? Look what happened here. Huge uptrend. This has been, it's a very bullish symbol for many, many years. Price came up, made all-time highs in February, but now the retracement down to this key support level. And I believe at this price level, this can be an interesting moment to potentially think about a long trade or get into a long trade, anticipating the price may bounce off this level towards higher price levels. Why? Once again, two things are coming together. We have a key support level here, and the overarching trend is bullish. All right. So, but you may say, okay, Daniel, this all sounds great, but how do you even find these symbols? Well, let me talk about this now a little bit. For this, I'm going to go back to my slides, and let me quickly summarize what we've seen. Then we're going to talk about how we can spot these symbols automatically. Now, what have we seen so far? Well, we have seen our Liquidity IQ indicator, the instant charting assistant, the indicator which will draw these key technical levels on your price chart as soon as it applied. And as mentioned before, this has transformed the way I'm trading because it does all the heavy lifting, all this tedious groundwork for me, so I don't have to do it. It's a great help. We have also seen, by the way, I forgot to mention, this indicator works completely out of the box. There are no settings for you to be adjusted. All you need to do, simply apply it to the chart and you're done. You see these levels. No guesswork, just insights where these levels are. Now, what else did we see? We saw our MA Rush indicator, the ribbon below the price chart, which shows you whether we're currently bullish or bearish. It's our trend indicator. And I use it, or we use it at Trading Indicators for filtering our setups. I like to trade when things are lining up, when multiple indicators are forecasting the same price move. For example, if our trend indicator is bullish and we have a bullish technical setup on the chart as well. Two things, forecasting a move higher in price. This is when I like to pay attention. This is when I like to trade. And these two indicators, Liquidity IQ and MA Rush, we call this the dynamic duo, because they work so perfectly together. One indicator, the Liquidity IQ, to find you the key setups, like a bounce setup or a breakout setup, and MA Rush to confirm your setup, to be able to filter your setup further. Perfect combination of taking advantage of overarching trend direction together with a key technical setup on your chart. All right, but now back to my question which I asked before. How did I find these symbols which right now have interesting setups? How was I able to spot this? Of course, we are talking about MetaStock here, and the answer seems to be quite obvious. Of course, I ran some scans. Now, MetaStock is probably the most powerful scanning platform out there. So I was not simply flipping through charts, hoping to find a setup. No, this is too tedious. Once again, I don't like tedious work. What I have done is I ran a scan this morning before the market opened to see which setups are currently present on some of the symbols. So here, for example, are some results which I got by scanning through the S&P 500s. In this particular case, I scanned for long bounce setups. We're gonna see in a second how this works. Just to remind you, what is a long bounce setup? Two things need to come together. First of all, price needs to come down to a key support level. And secondly, the overarching trend needs to be bullish as well. All right, let me show you now how this works on MetaStock. So I'm going to go back to MetaStock. I'm going to go to Explore here. All right. And in the list of your explorations, you will see a whole bunch of predefined explorations for you, all prefaced with the word trading indicators here. For example, one scan, they're all shipped with the indicator, is called long bounces. Trading indicators, long bounces. So I'm going to open up the report. I'm not going to rerun the scan right now. It takes a couple of minutes to complete. No big deal. I actually started all these scans this morning. It took, I don't know, maybe 50 minutes to run all these 8 scans, which shipped with the indicator. I had a cup of coffee. Once I came back, it was all completed. Very easy. All right, so let's have a look at the report. So I'm going to open up these scan results. See, let me just drag this in real quick. Okay, what do we see here? Well, first off, we can see all the symbols by running this scan here, the long bounce scan, which came down to a key support level like this one here, and the overarching trend is bullish. And then I did one more thing. I also sorted by trend duration. Why did I do this? Well, in my book, the longer a trend has been going on, like for GE here, the more stable it is. And as a result, at least in my view, the higher the chances that the trend is going to continue because it's very stable. And look what showed up here as our second result. GE Aerospace, second hit, the chart which I just showed you, picked up by the scan. A symbol which has been bullish for 686 trading days, currently at the key support level, and the overarching trend is bullish. Let's look at the first one here, Cardinal Health. Open up the chart. I open up the chart here, and the stock will open. Just drag this out of the way here. What do we see here? All right, so bullish trend, you can see it here. Let me just zoom in a little bit, and price is coming down to this key support level. And the key here is the scan will always give you a heads up. It will flag the symbol once we are in the proximity of a key level so that you can prepare for your trade ahead of time. Let's look at some other examples. Broadcom, third one here. Bullish for 686 trading days. Let me open it up on the chart. AVGO is the symbol. Okay, it's loading. You can see automatically the indicators are loaded. And we can see here, all right, look, it's a thing of beauty. Broadcom is exactly at this key support level. We even had a liquidity capture event at the very last bar, and the overarching trend is bullish. And if we go to our expert commentary, you can see it here. Let me just drag this up here. 1 second. It's hiding here. There we go. Okay. It actually tells you, okay, right now in Broadcom, we do have a long bounce setup. Price is bouncing off the 295 support level. This is exactly where price is right now. If you look here at the chart, just go here, a little bit back here. Go to the end. 1 second. Come on. Is there a trick to go all? That 295, that's the level here. That's the price level here. Price is bouncing off the 295 support level, and the indicator even goes one step further. It even tells you, okay, if you were to take this trade, it will recommend to you, okay, put your stop at 267, just below support around here, and your target at 387, just below this resistance level up here. Why there? Because price may be hitting resistance then, and you don't want to give away your profits. because it may bounce off resistance to the downside. The indicator will tell you all this. In addition to information like for how many trading days the bullish trend has been going on, in this case for 676 bars. This is how I find my setup. These are the scans I take every single day, or I use every single day to find interesting symbols. You can see there were quite a few of them this morning when the market opened, like AFLAC, Energy, Williams Simona, and so forth, Ecolab, Life Nation, AbbVie, Fox Corp, and so forth, Charles Schwab, Boeing. Now, all these have interesting setup. But one thing to note, look at the duration column here. That's the trend duration. I like to sort my setups by this trend duration from highest to lowest. That way I can focus on the setups which have been going on for the longest time, or at least in the symbols which have been trending up for the longest time. Because in my view, the longer a symbol has been trending, the more stable the trend is, and the greater chance that it will continue in the future. All right. Now, before I'm going to show you how you can take advantage of this package, one more example. Remember short bounce? But price is coming up to a resistance level and may bounce to the downside. We can also scan for this. Of course we can. Here's an example for a very sign. Let's check it out. So I'm going to go back to my expiration. I'm going to close this one here. Go back to my Explorer window here and select short bounce. This one here. I'm going to open up the report. What do we see? I ran it. We can see here we had only one setup this morning. Very sign. It came up to resistance and has a bearish trend. Let's check it out. So opening up this chart, very sign. All right. It's loading on my chart. What do we see here? Look at this. This is tradable. Price came up to resistance. You can see it here. Came up to resistance. We even had liquidity captures prior to this, and we may see a bounce to the downside. Supported by the fact that we are bearish to begin with. So these scans can be run for both, for the bullish case and the bearish case. And one more example, going back to my slide one more time. Remember this setup here, the long break retrace, where price first broke above a key level, then came down to that level, the retracement. I also ran a scan for this morning. And here's some examples of some stocks which were found by this scan. So one more time to explore. I'll select long break retrace here. I'll open up the report. There we go. All right. And the first one that comes up here, CME Group, the Chicago Mercantile Exchange. Let's open it up. CME is opening up on the price chart. The indicator is applied. And what do we see? Let's zoom out a little bit, or zoom in, I should say. Initially, the break above resistance, we can see it here, price came up, and then the retracement down to the broken level, which now can be a launch pad for another move further up, especially when supported by an overarching bullish trend. These are the scans I run every single day for both swing trading, like in this case on the daily time frame, but also for intraday trading on smaller time frames. This has truly, this indicator and the ability to scan for it has truly transformed the way I trade. Let me give you an extreme example. It's a bit of an exaggeration, but it's actually a true story. Back when I first started trading, that's a long time ago, but back then I thought trading should look something like this. This is what would be required to make money in the markets, like a plethora of different screens all showing some stuff on the chart. That's what I thought trading would be like. And I actually tried to rebuild the setup. But of course, I stopped eventually for various reasons. This is awfully complicated, at least for me at the time. And to me also, I believe it's a complete and utter overkill. I don't believe this is current anymore, because now we have indicators which can summarize all this different information here on the chart into a few simple things. And now the way I trade looks something like this. One laptop, one chart, one indicator on the chart. That's all I do. All I need to know for my trading is where these key levels are. I also look at trend. I put these two things together, and then I execute my trades. And especially with MetaStock, my workflow for finding interesting setups is really, really simple. This is all I do. I run an exploration. Step number one, I run a scan in MetaStock. I let it run while I'm drinking a coffee or do something else. I come back to my computer. I look at the results. I open up the chart for the results which I find most appealing. Of course, I sort them by trend duration first. And then I validate the setup by manually overlooking it. And if I like it, I execute my trade. That's it. Trading does not have to be complicated. Trading can be simple. And I believe trading should be simple. And of course, it is only simple if you have the right approach and if you use the right tools, the right indicators with the right supporting platform. All right. Now, how can you guys take advantage of this indicator package, which has transformed the way I trade? Here's how. First of all, this is a package which we call the Liquidity IQ Super Package. It includes our Liquidity IQ indicator. The lifetime license just for this indicator alone normally is 1,697. The indicator, which will show you directly in the price chart where key support and key resistance levels, where are liquidity capture events, and where are zone break events. But as a big thank you to MetaStock and as a celebration to celebrate the release of Liquidity IQ for the MetaStock platform, we decided to make this offer truly special by, first of all, adding 6 bonuses to this package. And bonus number 1 is our MA Rush indicator, the perfect complement to Liquidity IQ, the indicator which will show you directly on your chart what is the current trend direction. We use this indicator as the filter to filter out signals and to focus on these setups which are supported by trend and which do not go against the trend. Okay, this will be included. Bonus number 2, you will be invited to our live bootcamp where you will learn everything you need to know about these indicators. I already mentioned these work out of the box, but there's still some stuff that you should be knowing about how to run explorations properly in MetaStock, how to configure some of the styling. You can ask questions, we can talk about setups and so forth. You'll be invited to this live bootcamp. Bonus number 3 is you will also be invited to our exclusive members-only trading session, which will take place every single Tuesday at 12 p.m. Eastern Time. And of course, these are recorded. So should you be able to not make it, you can watch the recording afterwards, no problem. And on top of this, you will also get our ebook on trading with our MA Rush indicator, our trend indicator, and 2 video guides on how to trade with Liquidity IQ. All this will be included. But it doesn't stop there. There's one more thing. Because to celebrate the release of Liquidity IQ for MetaStock, we decided to slash down the lifetime price, this is all for life, from 1,697 to only 997. That's a one-time payment, and then the indicator is yours forever. No subsequent payments for the indicators are required. All of this will be yours forever. But of course, this is a limited offer. And if you want to take advantage of this offer, all you need to do is to go to tradingindicators.com/metastock. This will redirect to a MetaStock page where you can see all these special offers of today, by the way. So tradingindicators.com/metastock. And Jeffrey, perhaps you can put this link as well into the chat box. Now, real quick, what's included? First of our Liquidity IQ indicator is included, the one that draws these key levels on the chart. As mentioned before, I cannot trade without it anymore. It's on every single chart I open, no exception. Secondly, our MA Rush indicator will be included, showing you directly on the chart whether we are currently bearish or bullish. We use this indicator as a filter to filter down our setups, to focus only on the ones which have the most promising setups. Third bonus, you will be invited to our live bootcamp. We're going to learn everything you need to know about our Liquidity IQ and MA Rush indicator. You will learn how to trade with the indicators. Everything's going to be step by step, very slowly. We're going to have plenty of time. It's not just going to be 1 hour. We'll take our time to walk you through everything. And of course, you can ask live questions in this bootcamp. This will also be included. And then bonus number 4 is you will be invited to our exclusive live trading sessions. They happen every Tuesday. No exception at 12 p.m. Eastern Time. They're all recorded. So if you don't make it, no problem. You can watch the recording afterwards. And I forgot to mention this before, you will also get access to our Discord channel where you can, get instant questions answered, where we're going to share trade setups, trade ideas, where traders are helping other traders. Also, this will be included. All right, now to summarize, special offer today, $9.97 for this unique package. We call this the Liquidity IQ Super Package. All right, so Jeffrey, I think we have some time for some symbol requests, if there are some out there. Could you, let me just see if there are any. Go back to my MetaStock here. Are there any questions that came in? I don't see. Just have a quick look. All right, so I don't see any symbol requests here. In that case, I think I'm just gonna, flip through some charts to see what else is out there.
Hey, Daniel, we do have a question in YouTube. Can you use this with options?
Oh yeah, all the time. In fact, let me go back to MetaStock 1 second. All right, so one trade, that's a great segue, and this was not rehearsed, which I recently just took as a credit spread, was on CLS, Celestica. Great symbol. Let's see if I can find it here.
Coincidentally, Elizabeth wants you to look at CLS. So.
Oh, really?
Yeah, it just came in chat.
That's funny. Okay, let me just quickly go to the expiry. I think that's easier here. I'm gonna go here and go to my instrument search and find Celestica, CLS. I can never remember if there's an O at the end or not. No, this one is just CLS. Perfect. I'm gonna open it up. It's gonna come to my chart. And of course, as you know, my template, which applies Liquidity IQ and MA-Rush directly to the chart, is auto-applied. So every chart, I mentioned this before, will have these indicators on the chart. Oh, it's here. That's why it didn't open. Perfect. So CLS is opening up. And this, yeah, it's still a great symbol. So it's a long-term bullish. So we can see it here. Long-term bullish. Our MA-Rush column here is bullish. And it trades recently at this key support level here. You can see this little, let me actually make this a little bit bigger. You can change the styling of the indicator here. Let me just make this a little bit more so it's a bit more visible. There we go. Perfect. I think now maybe even bigger. Now you can see it here. That's the level here. So it came down to this key support level, this I guess pink line down here. And when it came down here at this point, I actually, or maybe it was here, I set up a credit spread for this particular symbol. Why credit spread, which is an options, a combo option strategy, is because for two reasons. Options were relatively highly priced, so really expensive. So selling options for credit, that's where the name credit spread comes from, was a good idea because option prices were high, premiums were high. Selling into that is oftentimes a good idea. So I sold some puts. I bought a put to make it a spread, and which I closed recently. When price came up, it bound to this level towards the middle, in between support and resistance up here. So I closed out this trade, and now it might be a rinse and repeat scenario as prices came down one more time to this level, and potentially this could be another long setup here. Anticipating price may bounce off this level, and we have to look at options prices, how you could play it. But if premiums are still high, maybe selling puts or perhaps setting up a bull put credit spread, perhaps not the worst idea. Anticipating, okay, this overarching uptrend is going to continue. Prices are going to bounce off this T level, at least towards the middle, in between support and resistance up here. So yes, so in short, sorry for the lengthy explanation, absolutely. So we look, especially with the scanner MetaStock, you can find really interesting options trade. But of course, the precondition for each option trade is to have a forecast of what the underlying may do. So here my forecast would be, okay, this underlying could be bouncing off this level, support by the overarching uptrend here as we are approaching support. All right. So one more time, a quick reminder that this package is available for a limited time, the Liquidity IQ Super Package, and all you need to do is to go to tradingindicators.com/metastock to take advantage of this very special offer. All right, Jeffrey, I think this brings me up to the top of the hour. And if there are no more questions, please take it away. Jeffrey, just go back here.
I really need to unmute my microphone, don't I?
We may have missed that. There we go. Hey, Jeffrey, perfect.
Daniel, I want you to look at one more stock on behalf of Kevin, if you don't mind. And I'm next, so don't worry. PANW.
Repeat that name, please, again. PN?
PANW.
Oh, Palo Alto Networks, is it?
Yep.
Let me just, okay, let's have a look. All right. Oops, sorry. PANW. All right. Let's see. It's this one here. Open. Okay, it will open up on the chart. I hope it's opening up on the chart. Maybe I lost my connection here. Just give it one quick second. Maybe just type in like this, PNW. There we go. Okay. Slipped. I think I lost. Oh, there we go. Oh, okay. There we go. Not sure why I didn't open up the other way. Okay, let me apply the template to it. Apply template. There we go. And let's see what's happening of Palo Alto Networks. Once the indicator is applied, the Liquidity IQ and MA Rush template, I'm going to apply it. It will now reload, and let's see what's going on. Oh yeah, interesting one. Look at this. First of all, what do we see here? So for the longest time, Palo Alto Networks was in a bullish trend. You can see here this bullish ribbon below. But in February, it switched to bearish. So now the momentum is bearish. To me, that's always a precursor. I do not like to trade against the trend. So like now, if I were to look for bullish setups, I'll be careful. I would only consider bearish ones because the momentum is bearish. This has worked really nicely for me. Look at this period here where we were bullish at this time. We came down to support. Beautiful bounce. Liquidity capture to the upside. Once again, down to support. Beautiful bounce. But now we're bearish. So let's see what's going on. So I'm going to zoom in a little bit more. And yeah, I would definitely not go long right now. Two reasons. First of all, we are bearish. The trend is pointing onto the downside. And look what we're coming up to here. This red level here. This used to be support. It has been broken. And now we're coming back to this old support level. But since support was broken, guess what? It will now act as resistance. So prices are coming up to this resistance level. I'll be careful going along here. Would I go short? Yes, the momentum is bearish, but for stocks, typically, because they have this overall bias to the upside, I'll be more careful with the short direction. But definitely, at least according to the techniques on the chart, I'll be careful for going long Palo Alto Networks at this particular price point here. Two reasons: we are bearish and we're coming up to this resistance level here, which used to be support.
Okay, one more. PSLV, very quickly. Elizabeth just said, please, I'm a sucker.
Repeat the symbol one more time.
PSLV.
PSLV. All right. PSLV.
Yeah, .K. The very top one.
.K. Okay, cool. Silver. All right, let's see. Okay. PSLV loading up on the chart. Okay, what's going on? Yeah, silver, of course, huge jump up. Very exponential move. And look at this beautiful breakout signal here. You could have jumped into this move right here. Yeah, huge move up, now trading low. And honestly, I am a bit skeptical with silver. Two reasons. First of all, we lost this red line here. It's a bit hard to see. I should make this a bit more prominent, but this is, if we go to properties here, open this up. Let me just make this a little bit thicker so we can see it a bit better in our settings. There we go. A little bit thicker. This is fine. Okay. So we broke the support level here. We came down and now we trade back up again. This reminds me a little bit like a zone break retrace setup to the downside. If you go to the chart, just to feel free to see, look at this setup here. Just 1 second. This one. Here. Break the level. Came down. We come back up to it and then another move further down. This looks a little bit like this. Not as extreme. But nonetheless, we broke the level, came back up, maybe another move further down. At least I would be a bit careful. I didn't like the fact that we lost this key support level here in silver. And silver has been so volatile. So of course, overarching trend is still bullish, but I would be a bit hesitant to jump in right now for a long trade in silver. I think we need to clear this level first to the upside, potentially even fill this gap here, and then I'll be looking for longs. Right now, right at resistance, I'll be also a bit careful with it. All right.
Very cool.
Perfect. All right. That's it from me, guys. Just real quick, right. Here's the offer. Yeah. Thank you, everyone, and have a great conference.
Yeah, thank you, Daniel. I'm going to go ahead and I just want to kind of recap everything that's included in here, but I do really appreciate your being in here. And another great add-on. I loved how you showed the S&P and where it exactly broke and where you're expecting support. Really
Thanks.
breaks
Yeah.
things into a way you can really see them. So thanks for that.
Perfect. Thanks, guys. Have a great conference. Bye, Jeffrey.
All right. See you later, Daniel. Okay. Let me go ahead and share my screen. And give me just a second while I kind of okay, do exactly that. There we go. That should be very, very visible. Okay. Again, just to kind of break down what's included in this package, you get Liquidity IQ. It's really good at detecting structural support and resistance. You have the bounces, the breaks, the setups that are all kind of built around that. And in addition to that, you get MA Rush, which is designed to help you determine whether you're bullish or bearish and give you those support and resistance levels as well. Does a really, really good job. I love the examples that were shown. And just to kind of recap the things that are included in this, you've got your bounces, which are your long and short setups. You've got your breakouts. You've got your retracements. You've got your magnet zones. Daniel really didn't have a time to talk a little bit about the magnet zones too much, but they're designed to find stuff that's in the middle in case you're looking to play option plays with them. So all of those setup types are identified, they're shown on the chart for you. And of course, it's going to take advantage of one of the tools that we do best here. That's the ability to find opportunities. And out of all the tools that exist in the MetaStock program, the one that I use every single day, no matter what, well, every day the market's open, is the scanner, or what we call the Explorer. And with the Explorer, you can scan through whatever instruments you want. The data that we have covers North America, it covers Canada, covers about 200-ish global markets, London, Singapore, India, regardless of the market that you're interested in, you'll be able to implement this. India is a really, really big market for us. So you can scan through all the stocks. It allows you to focus on the ones that have an opportunity and ignore the ones that don't have an opportunity. And I love that because there's always an opportunity somewhere. You'd have the expert advisor. The expert advisor does a really, really good job of showing you those liquidity capture zones, explaining things to you in plain English so that you can understand them, gives you stops and targets that you can work with. And those are updated every single day that you're in a trade as well. So this is a brand new product. For everybody that buys in, kind of like in our launch window, they're going to get a special discount. They're going to get a money back guarantee. And they're going to be able to come and do a special boot camp that we're going to do with Daniel. Daniel's going to sit down and he's going to do probably an hour of training on how to use Liquidity IQ, how to use the different patterns, the symbols, all that kind of stuff. After he's done, I'm going to come in with a little bit of a bonus session to show you what I would recommend that you do with MetaStock and how to set up like the list of the stocks you're interested in so you can focus on just those, how to run scans, how to save lists, all those things that are going to be helpful for you to understand and utilize the software to the best. So as Daniel said, the normal cost on this is $16.97. If you do it today at the summit, we're doing a $9.97 discount. That does include Liquidity IQ, it includes MA Rush, it includes the explorations, the system tester, the expert advisor, and that boot camp, and a money back guarantee. So you can try it out. If it's helpful for you, you can keep it. I love this. And the products that Daniel develops are so good. This might even be my favorite. So you can go in and you can get metastock.com/summit deal. You can get set up for that. You can give us a call if you have any questions. We'd love to talk to you. 800-882-3040. And you also can visit us at metastock.com/saleschat. So big thanks to Daniel. Elizabeth says, thank you, Daniel. Kevin says, thank you, Daniel. And I say, thank you, Daniel. Thanks for coming in here, Daniel. Really appreciate it. Thanks for designing some really cool tools that work well with the MetaStock infrastructure. So let me go ahead and I do want to make just a little bit of an adjustment to my screen here so that I can see both the chats for YouTube and MetaStock. So if you have questions, I'll be able to answer them because I am talking next. So let's go ahead and get into that a little bit. I do want to first, though, thank a couple of our sponsors. I want to say thank you to Stocks and Commodities Magazine. Stocks and Commodities Magazine, such a great magazine. They've been publishing since 1982. I'd say the leading authority on technical analysis of stocks and commodities. And I love, ever since I started here, they started MetaStock about 30 years ago. They started sending magazines to me. And I love every month being able to get something in the mail that talks about technical analysis, talks about trading, that kind of stuff. So a big, huge thank you to Stocks and Commodities Magazine. They've supported all of our events since we started them about 15 or so years ago now. They've got 1.3 million subscribers, and they've been publishing since 1982. If you haven't yet, you can get a free issue just by registering for the event today. If you go to metastock.com/traders-summit, you can register. All of the speakers today are offering free bonuses, including our sponsor, Stocks and Commodities Magazine. So there you go. Also want to encourage you to join the Traders Forum. The Traders Forum is a growing group. It's a growing trading forum where you can go and discuss trading ideas, do live market chats with other traders. You can learn about the markets. Like last week, we did a class on Bill O'Neill's canceling methodology. No, actually, we didn't. We did Warren Buffett last week. We'll talk about different technical trading strategies, setups, and we do free classes every week. In addition to that, we have special guest speakers that come in and they speak with us as well. All of this stuff that I'm talking about is free, and you can join at thetradersforum.com. I'd encourage you to join. I've learned more there than I haven't. I'm going to really quickly come in here and just kind of put the right URL on here. And then I'm going to remember after I'm done to actually do this on all of them. We have been rated number one in the for MetaStock in our price category. That we won again this year. That's 33 years in a row. MetaStock's been rated number one. I'm going to show you kind of a little bit about MetaStock in just a few minutes here, but mostly my goal is to teach you a lesson. But for MetaStock, some of the things that we do really well, scanning the markets, I alluded to that earlier. Testing trading ideas, we do that really, really well as well. We'll talk about that. We have a patented forecaster. All in all, for the MetaStock Toolkit, it's been rated the best software in its program for price category for 33 years in a row. We do have subscriptions to MetaStock that start at $75 a month. That includes MetaStock and all the data in basically the world, everything you need to get started. You can do a buy one, get two free trial. So you can try it out until June 30th right now for $75. That's $25 a month. You just have to go to metastock.com/summit. You can give us a call at 800-882-3040, or for more information, metastock.com/saleschat. Right? Okay. Let's go ahead and get started with our next speaker, which is me. Oh, also, before I do that, we do have all of the products that we're talking about today in a special super big discount. So you can get Jeffrey Scott's MRI, which is new. You can get the brand new Daniel Sinnig's Liquidity IQ. You can get Master Trader by Capra, JBXC Complete, Steve Primo's Dynamic Dumo, and 3 months of Learn MetaStock. Normally, all of that would be like $8,082. Here at the summit today, it's only going to be $4,186. To do that special offer, call us at 800-882-3040 or metastock.com/saleschat. So now let's go ahead and get to me. We recently updated my photo because somebody wanted to know where the speaker was, and it was me. It was just a really old photo of me. So there we go. This is my new photo. And I do want to go through the legal disclaimer real quick too, just because I'm supposed to, but for some reason I didn't include it here. It should have been right at the front. That's okay. I got it right here at the front anyway. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software. Any trading strategies or any information provided in connection with the company, MetaStock and its employees do not endorse a purchase of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. So now that I've got that recited for the second time, let me go ahead and come in here, get back to where we're at, which is right here. Okay. And while I'm kind of getting the screen situated, I'm going to go ahead and put the chart of the S&P up as well, just so we have that when I'm ready for it. All right. Looks like I do have. Jim asked, does Liquidity IQ work in Trading View? It does, Jim, but it doesn't have scanning. So if you want to go ahead and pick up actually email me. I'm pretty sure it works in Trading IQ, Trading View, but I'm not sure. So email me, I'll find out the answer for you. My email is right here in the chat. So I'm 85% sure that it is available. Of course, it doesn't have the scanning because it doesn't have a scanner in Trading View, but if you email me, I will get that answer for you and find out. So in any case, all right, my name's Jeff Gibby. Welcome, it's good to see you. Today, I have a couple of goals for you. For the whole day, I want you to learn some things. I hope it's a beneficial day for you. Appreciate your coming in and spending some time with us. Really do. Okay. The second goal that I have is I've been talking for a few minutes about how MetaStock's been rated the best software in its price category for 32 years in a row. My goal for you is to learn enough about MetaStock that you try it out. To tell you a few things about MetaStock, you can read this side if you want to. I don't usually. MetaStock is a software company. We're located right here in Salt Lake City, Utah. It was formed in 1980 by Steve Kailis. Most of our employees have been with us for decades, and most of our customers have been with us for decades. I like the software because it's very, very good at helping identify setups, triggers, help you get into the market, out of the market. And it's a huge toolbox. We've literally been making it since the 1980s. And I think it's helpful for people, and that's why year after year after year, we keep getting rated the best software in our price category. So for those of you that have been using MetaStock for decades and using it to do the scanning and the identifying of trends, great. Thank you for using MetaStock. If you haven't heard of MetaStock before, if you haven't decided to pull the trigger on it today, I kind of talked a little bit about the offer today. If you buy a month, we'll give you the second and third month for free. Okay. And we'll talk more about that. I don't want to spend the whole time talking about MetaStock. I could do a sales demo for like a while, but I want to make sure you learn something. And so what I wanted to talk about today is, I think I have a slide for this. 33 years in a row, it's been rated #1. The importance of a trading plan. When it comes to technical analysis, the idea behind technical analysis is to help you design a trading plan. And really, that's it. A lot of people come into the market. They're not sure how they're going to trade. They're pretty much going to listen to their Uncle Greg. They're going to go ahead and get some ideas that way. They might be listening to kind of people on the internet, Jim Cramer, whatever it might be. But a lot of people, which I find funny, will come into the market and they have no idea why they're going to buy a security, why they're going to sell a security. They basically just come in and they lose a lot of money. Is generally what happens. The statistics on the amount of traders that fell is surprising when you're playing with a market that generally goes up, and it also goes down as well, as we're kind of seeing right now. So what I want to talk about is the importance of trading with a plan. I want to kind of teach you a little bit about the schematics of a trading plan using Gerald Appel's MACD. And then we'll talk about how that compares to maybe some other methodologies, other indicators. The thing that I like about technical analysis is it's completely objective. So we're not trying to guess what's going to happen in Iran, or before that, what's going to happen with interest rates and inflation, or before that, what's going to happen with the housing crisis, or before that, I guess after that, the COVID virus, or before that, the dot-com burst. Generally what we're looking at, and a pure technician will say that when you're looking at technical analysis, they're going to say all the fundamentals are based on the perception of price. They're all built into the price. And one of my favorite mentors, Steve Bigelow, would always say fundamentals don't matter. It's the perception of fundamentals that matter in the marketplace. So let's go ahead and get started. We're going to talk a lot about that, and we're going to have plenty of opportunity for you guys to, well, I wouldn't say plenty of opportunity, but I would like you guys to give me some symbols if you want to look at them, and we'll teach you how to use MACD on some of your own symbols. So the first question, though, that I have, and I like to encourage you to interact with me. It makes me feel like I'm not talking to myself. But for the next question, the first person, and Greg, I want you to help me get this right. The first person that answers this question correctly, I'm going to mail you a copy of Candlestick Profits, Eliminating Emotions by Steve Bigelow. It's a physical book. I'm going to take it to the mailbox. I'm going to send it to you. And you just have to be not only the person that gets the next question right, but the first person that gets the next question right. Are you ready? All right, we'll have some fun with this. So, what is the best previous profession for a prospective trader? Okay. What is the best previous profession for a prospective trader? Is it a teacher or an educator? That would be answer A. I've made it as easy as possible. All I had to do is type in a number. Would it be an engineer or an architect? Would it be a psychologist or a psychiatrist? Would it be a pilot? That would be D. A performer, which would be E, or an artist musician. And I think I might put E and F together for the next one. So out of these, is it going to be A, B, C, D, E, or F? Okay. And for a free book. Okay. And as we talk about this, I've had some experience in the market. I kind of skipped a little bit about my bio, but I've actually worked here at MetaStock for next year will be 30 years, if you can believe that. I can believe that. I've got a lot grayer here, but I love it here. Okay, we have a winner already. Okay, good. I don't know if she got the right question though, but she got the first answer, so we'll go ahead and go with that. Okay. As part of my job when I started here, I had the ability, or I started in sales. So if you had questions about MetaStock or questions about your trading, or if you're struggling with trader, a lot of people would reach out to us because they didn't have the right methodology for trading. They just didn't know what they were doing, or they had no way to find the right trade at the right time, or there was something else. They wanted to be able to kind of educate themselves of the market. And coincidentally, all of those three things are things that are very, very good. So the first 10 years I worked at MetaStock, it was in inside sales. I love that. I talked to people that were looking to buy the software, and I'd help them buy the software. And there's still people that I sold MetaStock to 30 years ago that are using it to today. So it was a great opportunity there. After that, I moved into kind of our business development, and I run all of our business development internationally here and overseas. And I've had the pleasure and the privilege to work with some great experts. Everybody, obviously, that we're talking here today, and a lot of them fall into different categories. Coming up after me, for example, we have Jake Bernstein, who was a clinical psychiatrist and has some very, very interesting stories about the psychiatry that he did. Started trading in the late 60s, and his first trade was around eggs, of all things. So another person that I have a lot of respect for in the market, Dr. Alexander Elder, he wrote a book that's called Come Into My Trading Room, and I think that should be required reading for people. He was also a psychologist. Pilot is actually the correct answer. And I don't see any real guesses of D, but pilot is actually the correct answer. And I know a couple people that Chuck Hughes is somebody that we work with very, very regularly, I'll say. And he started as an actual jet fighter. Greg Morris, a big, huge friend of ours who did a lot of stuff with us over the years. We include his JCPR candle recognition into MetaStock 20. He was a literal Top Gun and before he became a trader. And He ended up at the end of his career, before he retired, actually managing $19 billion for a company called Stadium Money Management. So that would be Greg Morris. So, but the correct answer is Pilot. And over the years, I've kind of thought about why. And I believe the reason that actually psychologists and psychiatrists might be is they had to have an insight into the fundamentals of human emotions, because really when you're trading with emotions. Fear and greed are huge. The reason I would think Pilot actually wins out is because of discipline. So many people, when a pilot takes off, they're going to get on a runway. They're going to follow a very specific checklist to take off. When they go to land, they follow a very specific checklist to land. When there's an emergency, they follow you get a specific checklist to handle that emergency. I believe it's actually the discipline that's going to help people when the markets are a little bit rough, when they're maybe not going the way that they expected them to, or, and I don't even think the market's rougher. The last little bit have been some of my best trading all year, the last few weeks or so. But I believe that it's discipline. I have a little bit of a quote to go along with that. This is Richard Dennis. If you don't know who Richard Dennis is, I will tell you. Richard Dennis had a friend by the name of Bill Eckhart. Richard Dennis believed you could teach people how to trade. Bill Eckhart believed you could not. Richard Dennis was named Prince of the Pit. They were both futures traders. They were very, very famous futures traders. Richard Dennis was called the Prince of the Pit. They ended up forming a group called the Turtle Traders. They did thousands of applications. They brought in and did interviews. They funded 23 or 24 traders initially and taught them very specifically, here is a methodology that you should trade with. Here's when you get in, here's when you get out. It was a breakout methodology. It exists in MetaStock. But what they ended up doing with the turtle trading method is it wasn't as successful an event. It was hugely successful. It had really big net aggregate profits. Do I have the notes here? Oh yeah, here we go. I can tell you very precisely. They traded a group of 23 traders. In case you're curious, it was 21 male traders and 2 female traders. Funded with this money, they made an aggregated profit of $175 million over about 5 years. And the thing that he had to say about this is, I always say you could publish my rules in a newspaper and no one would follow them. The key to trading is consistency and discipline. So that's all we're going to talk about when it comes to discipline today. What I mostly want to talk about is trading rules. Okay, we're going to do a little bit of a lesson on the MACD. And I'm just taking a look at the time so I can kind of make sure my timing works well. Elizabeth, congratulations. I probably have your book or your address already because you are registered, and I will get this book sent over to you. Congrats on them. All right, so today we're going to talk about MACD. I'm going to teach you about MACD. I'm going to show you how it's calculated. It's a very, very simple mechanism. We're going to talk about the signal line, how you read 3 different readings on it: bullishness, bearishness, triggers, overbought, oversold, and divergence. So those are the 3 things that we're going to talk about it today. And everything I'm going to talk about is going to be objective and not subjective. At this time, if you have a symbol that you want to look at, type the symbol in the chat box, because we can do this on SPY. We can do this on any symbol you want. And I don't know why it doesn't. You're welcome, Elizabeth. Actually, automatically do this. We won't have a lot of time to talk about a lot of symbols, but give me some symbols. We'll look at the symbols you're interested in, and we'll talk about MACD and how it applies to those. If you're not familiar with Gerald Appel, here's his picture. He developed the MACD over 40 years ago. He wrote, during his lifetime, he wrote 17 books on investments and published systems of forecasts for 46 years. Something else that I think is really cool is, in addition to the books that he wrote on trading, he actually published 5 about photography. I think that's pretty cool. The reason I like to talk about, and Gerald Appel I believe he died in 2000. It wasn't Corona related, as far as I know, but he just barely died about 5 or 6 years ago. The reason I like to talk about MACD in specific is a lot of people use it, but not a lot of people understand it. I'm going to help you understand it. So let's go ahead and get to that. We're going to look at, I guess, a VSAT and back when we get into a chart, which won't be too much longer here. The reasons I like MACD is the reasons I like technical analysis. This is objective. We're not going to be trying to guess what's going to happen geopolitically. We're not going to guess what's going to go on with gas prices. We're not going to try and guess how that impact is going to translate to the rest of the economy. What we're going to be looking at is very, very measurable. We're looking at the chart. Technical analysis is the study of prices and charts. Okay. Also helps you figure out and evaluate the overall trend with its trend management. Okay. Disadvantages to MACD: if you get in an area where you're very, very sideways, it can be prone to whipsaw. Okay. It's also a lagging indicator because it's using moving averages. So let's talk a little bit about it. When Gerald Appel developed the MACD, he did not use whole moving averages. He used 0.075 and he used 0.015. These don't line up with whole numbers, but the closest and the ones that I'll show just to kind of talk about how it's actually calculated is 26 and 12 exponential moving average. All right, let's jump into a chart. I've got the spider. Let's go ahead and switch over to VSAT. JJ, thanks for the symbol. Okay. I do have to spell it right, though. Okay. We'll go ahead and select this as an instrument. And just because you wanted to, we'll do back to. Go ahead and do BAC. I want to do this as a clean chart. Well, actually, for Bank of America, I'm just going to load the MACD already preloaded because that way I don't have to set up the chart too. Okay, let's go ahead and open up this chart. Okay. I'm going to jump over back to VSAT. I very purposefully made this chart plain. It's just a bar chart right now. It's a candle chart right now. It's by default it's a bar chart, but I really prefer to read candles. I'm just more used to candles. You've got volume at the bottom. I'm going to add the 12 and the 26 period exponential moving average. To do that, I'm going to click into this what we call our indicator quick list. There are several hundred, I'd say hundreds of, and I think it's between 300 and 400. There are hundreds of indicators that I can pick and I can add to the chart. Okay, what I'm going to do is I'm actually going to type in moving average. Okay, that'll show all the moving average options. We're just going to grab the moving average. We're going to go ahead and apply it to VSAT. And I'm going to make this one a 12-period exponential moving average. And you'll notice that it's very easy to kind of manipulate and run this around. I'm going to basically make this a blue line. I'm going to make it a little bit thicker so you can kind of see everything. And there we go. We've got did I do the 12 or the 26 or the 12? Okay, we've got a 12-period exponential moving average. I'm going to grab the 26 as well. I'm going to remind you, Gerald Appel didn't actually use 12 and 26, but it's very, very close. So for this one, I'm going to leave it as red. I'm going to also make it a little bit thicker. And there we go. We've got our 12-period and our 26-period exponential moving average. I'm going to move quicker because I'm a little bit behind. Okay. If I wanted to tell you how to calculate this, I take the 12-period, the shorter-term moving average, and subtract it from the longer-term moving average, and that'll give me my MACD. Let's go ahead and put a MACD on the chart. So I'm just going to grab MACD. I prefer to look at it with a histogram. So I'm going to grab the histogram version here, and I'm just going to drag it and drop it on the chart. Start of the chart, and in the purposes of going faster, I'm just going to make all of these lines a little bit thicker so we can see them pretty good. Okay, go ahead and click on OK. Okay, if I wanted to tell you how to calculate the red line here, this is the MACD, the MACD part of the MACD, the main indicator. What I would do is you're going to take a shorter term moving average and subtract it from a longer term moving average. I think it's important for you to understand that because a lot of what we're looking at, when we understand we're looking at the difference between two moving averages, a lot of the rest of the stuff that we're kind of looking at makes a little bit more sense. For example, if we're in an uptrend, we call this an uptrend, although it's been kind of sideways just to eyeball it. But if we're in an area where the price of the securities moving up. What's going to happen is there's going to be your moving average, your shorter term moving average is going to be above your longer term moving average, as you see right here. And the faster that it's moving up, the faster, the bigger the difference, right? So when we're looking at MACD, we're not just looking at the trend of a stock, we're looking at the momentum of a stock as well, because the faster we're moving in any specific direction, the more it's going to move. And so that's why when you kind of have this little bit of a spike up, you have a bit of a bigger move. Okay. If you get sideways, I'm going to call this area sideways. What's going to happen is the difference between those moving averages are going to shrink. They're going to come together. The moving averages are going to, and what you're going to see is a much shallower MACD. Okay. If we go back in time, you'll see we had a very, very big move up on VSAT here. Here you had a big initial move. Your MACD exploded upward here, came back a little bit here as we went sideways, and then jumped up again. MACD is a measurement of not only trend, it's a measurement of momentum, which we're going to talk more about because you can use MACD as an overbought, oversold indicator as well. Okay. So that's the first sign. It's just the difference between a shorter term and a longer term moving average. That's it. Okay. Right here, what you've got is you've got a signal line. That's a 9-period exponential moving average. And the reason Gerald Appel called it a signal line is when it pops up above, when the MACD pops up above its 9-period exponential moving average, that gives you a buy signal. Okay. When I should say it a little bit differently. Let me slow down just a bit. It's important that we kind of get these details right. When the MACD is trading up above its signal line, it's in a bullish phase. When it's trading down below its signal line, it's in a bearish phase. When it's trading up above its signal line, it's in a bullish phase. So generally it switches from, actually not general, it generally will switch from a bullish to a bearish phase based on the MACD and its signal line. And I can illustrate that if I use a tool in MetaStock that we call our Expert Advisor. I'm going to go ahead and come into the Expert Advisor. And in here, there's several hundred systems. There's even one in the Turtle Trader. For the purpose of time, though, I'm just going to jump to MACD. I'm going to go ahead and attach it to the chart. And then you'll be able to see, go ahead and move this up here. When the MACD comes up above its signal line, it comes into a bullish phase. When it comes down below its bearish, it comes into a bearish phase. Bullish, bearish, bullish, bearish. Very straightforward, right? Now, if our anticipation is that we've just went from bullish to bearish, and I moved that back down on purpose, our primary signal, the reason that Gerald Appel called this a signal line in the first place, the primary signal is when the MACD crosses above its signal line, which it did here. Okay. When it comes back up here and crosses down below its signal line, MACD enters a bearish phase, that would be a MACD sell signal. That's the first way that we look at the MACD. Is it giving buy and sells? I forgot one thing. I'm going to step back just a little bit before we get into the second and third way to look at MACD. But what I would like to do right now is actually talk about the histogram. Gerald Appel did not invent the histogram. That was actually put together a little bit later by Thomas Asprey, I believe. I'm pretty sure that I'm right there. Hold on. Okay. Yeah, Thomas Asprey. Let's not throw our water over there. Thomas Asprey. And he basically is just the difference between the MACD and the signal line. That's all. Okay, so you can look at the MACD. It's just this histogram is just the difference between this and its signal line. When the MACD goes down below its signal line, the histogram gets bearish goes under 0. And that's why it's a histogram. You're just looking at the difference between these two levels. It can help you identify bullishness and bearishness on a chart. Okay. All right. So we already talked about one way to interpret the MACD, buy and sell, right? The buy signals and the sell signals. And I want to get a little bit closer in the chart here. I'm just going to kind of zoom in on these ones right here, this activity here. Okay. Here we crossed up above our signal line. The histogram went positive. We got a buy signal. Here we got a sell signal. Here we got another buy signal. Here we got a sell signal, but then we got a buy signal. Then we got a sell signal. Then we got a buy signal here. It can be prone to whipsaw, okay? But we have a very visual way to look at this. If we would have bought here, we all understand why we bought here. It's objective. That's my point. Here we would have sold that. Would that have been a good trade? Sure, that would have been a good trade. We would have gotten in long at around 940-ish. We would have gotten short around 14. That's a 5-point move on a $9 stock. That's pretty good. Okay. If we would have went short here at 14 and sold here at 20, that would have been a losing trade for us, right? So we can see very, very visually how well this would have worked, and we can also see how well it worked objectively as well. Okay. I'm getting a little bit ahead of myself, and I don't see really any huge examples of overbought or oversold here on this chart. I'm kind of looking back in time. I'm not really seeing. Let me make sure it's turned on because this isn't my computer. Yeah, it is. Okay. Well, actually, what I want is, let me just change the color of this real quick. Because red and green are actually the colors I've got the chart at. So I'm going to change these highlights a little bit so they stand out on the chart and so I can see them. Okay, we do have some examples here. The second way you can actually use MACD is to help you determine overbought, oversold. Okay, so let's kind of zoom into this area again. I believe this is the area we're looking at again. The idea behind an overbought, oversold is it's a reversion to the mean play. So right here where you see MACD kind of hitting this really prominent high, what we're doing is we're looking at that and saying, hey, this might be in an overbought, oversold territory. And that comes with a little bit or a big caution. Comes with a big caution. If we're just because something's overbought or oversold doesn't mean it's going to reverse, right? The market can stay in a trend for a lot, or what is the saying in the market? The market can stay unlogical or illogical for longer than you can stay solvent. So just because this gets overbought, and it does actually start to pull back after this is a good example of it. But I've seen 10 examples for every good, I've seen tons of examples where just because it's overbought or oversold doesn't mean it reverts to the mean. So I like the way that we word overbought and oversold. In the commentary for MetaStock, Daniel talked a little bit about the commentary. I'm going to revisit it. Let me go ahead and click on view here. We'll go to view expert commentary. And what I want to do is I want to click on this blue bar because we'll get a warning on this blue bar. Okay. When I move this commentary is now looking at 10/29 of 2025. This is great if you're trying to figure out what a methodology is doing. You want to look at previous buy and sell signals. You can come in here and it'll literally tell you. So for example, if I just ignored all of everything else that happened on the chart up to this point, I'm going to scroll back a little bit here. This is what it's looking at. I could come back here and see what it said during the buy signal and all that kind of stuff. But right now, we're bullish because we had that crossover of this signal right here. You can see it on the chart. But currently, the MACD is bullish since it's trading above its signal line. The MACD crossed above its signal line 17 bars ago. Since the MACD crossed above its moving average, the price is up 18.66%. Okay, so right here, we got in here, the price has gone up 18%, and we're saying, hey, wait a minute. We might be in an overbought, oversold area. In this case, it's overbought because the price has been going up. It took me the longest time to I'd always say oversold when I meant overbought and all that kind of stuff, right? Right here is where the warning comes in. The MACD is in an overbought range. Prices may continue to move higher for some time. You should wait for prices to move lower before considering any short position. That's a message it's giving us. So in this case, they do start to move lower and we do get a sell signal here. But when I start to see something overbought, oversold, it might be like a yellow traffic light for me. And what I mean by that is I might move my stop up. I might start to kind of pay a little bit of closer attention to the stock. It's not a signal to drastically change what I'm doing. It's a signal, hey, we're going pretty fast here. This is going in the direction I wanted it to. But we're starting to get overbought, oversold. So maybe we're a little bit more protective right now, or maybe we're looking for that reversal, which actually did happen on this particular instrument, but won't always happen. What we want to do when we're trading is we want to put the odds in our favor. We're never going to be right 100% of the time. We're never going to be wrong, hopefully 100% of the time. Sometimes it might feel like that for you. But what we want to do is we want to go in and identify those moves. And for MACD, the goal is it's a trend following system. Or it's a trend following indicator. And as a trend following indicator, you're never going to get in at the exact bottom and you're never going to get out at the exact top. What we want to do is identify where these trends exist and take good chunks out of the middle. All right, let me kind of zoom out a little bit, and I want to talk. So we've talked about, and I just want to reiterate what we've actually talked about. Talked about the main primary buy signal for MACD, how it works. We talked about overbought, oversold, how it applies to a chart. I want to talk to you about a third very popular method that you can use with MACD, and that's to determine divergences. I mentioned Dr. Alexander Elder before, and he's somebody that I have a lot of respect for in the markets. Again, wrote a book called Come Into My Trading Room, and another one that I don't really, another one that's really good, but I can't really think of the name right now. But one of the things that he talks about, we'll do events with him very, very regularly. One of the things that he talks about is MACD divergence, and he calls indicator divergence in his book. He calls it one of the most powerful signals in all of technical analysis. I put it in this slide so I didn't mess it up. So if we come in here, A New Trading for a Living. In his book, A New Trading for a Living, Dr. Alexander Elder states divergences above the most powerful signals in all of technical analysis. When prices make new highs and MACD fails to make new highs, this is called a bearish divergence. Conversely, if you have the other thing happening where they're making new lows and MACD is not confirming that, they're diverging, that's another thing that you would call a bearish divergence. So let's come back into the chart real quick here. And we'll take a little bit of a look about what's going on. When Dr. Elder looks for divergences, he typically looks at the histogram. So I'm going to look at the histogram too. If I look at the histogram here, what I'm going to be looking for is a peak in the histogram. Okay, and then I'm going to be looking for to go down below zero. Dr. Elder thinks that's very important. He says that's very important in the work that he does. And then I look for another peak. I'm going to say this peak was slightly higher than this peak. So I'm going to go ahead and take my horizontal tool here, or my trendline tool. Actually, I'm going to use a measurement tool. And what I'm going to do is I'm going to take a line, I'm going to draw it from this peak to this peak. And the difference between this peak and this peak, it went up about 42% between this peak and this peak. Okay. Now what I want to look at is what price did during those two peaks, or around the time of those two peaks. So I'm going to take the same measurement tool. I'm going to take the high here and the high here. And I'm going to say that those are going in the same direction. This is up 42%. This is up 28%. And even though we did have a sell-off, we didn't have a divergence. Okay. These are pointing in the same direction. They're converting. They're not diverting. What will happen, let's say that this peak was a little bit higher back here, maybe a little bit lower back here. Okay. MACD made a new high. Let me say this again. Price made a new high, while MACD failed to make a new high. That would be what Dr. Alexander Elder called the most powerful signal in all technical analysis. It's not happening on this chart, but I think it's important to kind of, if I'm going to talk about MACD and it's the most important signal in all of technical analysis, Dr. Elder literally calls this the breaking the backs of the bulls. And in that case, we would be anticipating a sell signal there. Okay. In this case, they were pointing in the same direction, but hopefully that's enough to give it to you, give you an idea. Okay. Whew. We don't have a time to look at back. Not more than just briefly. Unfortunately, these hours go quickly, but we'll just kind of eyeball it here. There's a couple of things that I want to point out with this. Okay. If you understand how MACD works, you're not doing a lot of guessing. Okay. I want to zoom in just a little bit here. Bank of America, we've obviously had a pretty big sell signal here. if we would have shorted Bank of America here at where it gave its last signal, 51, notice it got oversold here. Okay, now we're getting a little bit of a buy signal, but it's been a little bit flat then. The thing I love about technical analysis is it's completely objective. So I can come in here and say, okay, well, if we sold here and bought here, that was pretty good. But if we bought here and sold here, that was pretty good. This was a bit of a buy. We could go in and eyeball those trades, take a look at each single trade, see how they performed on the chart, and see if we wanted to trade them, and see how well MACD, one of the most popular systems, worked on both Bank of America and VSAT. It's very easy to do. This is all objective. We're not trying to guess what a regime change might do. We're not trying to guess what an interest rate hike might do. What we're looking at is, and this is built into the chart, in the last several years, we've had all of those things, right? We've seen a housing crisis. We've seen COVID. We've seen inflation. We've seen interest rates. What we're looking at is, what is the price doing? We're studying the price to see what it does. And we could go and figure out over a bull market, over a sideways market, over a bear market, what type of methodologies work over time. I'm going to do that now. What I'm going to come in here and we'll just figure out what works well. And I think what I'll do is I will use Bank of America as the example. I could do both of them. In fact, I will do both of them. I'm going to go ahead and go into those stocks. And just for the purpose of showing you, I'm going to go in and say, okay, well, if we traded MACD, how well would that have worked? Okay. I'm also going to choose a good chunk of, not all of, because of, I just don't want to spend the time to find them all. But I'm going to go check a whole bunch of methodologies in here, because what I want to do is I want to see how well this works compared to other indicators. I spent way more time than I should have talking about MACD. But really, what I want to focus on as a trader is what's working. And that's what MetaStock does a really good job with. Let's do the expert system as well. We'll just start there. To give you an idea of what we're doing, I'm going back about 500 days. I'm going to test Bank of America against the MACD every time it gets a buy signal. But I'm also going to compare it to the other methodologies. I'm going to start with $10,000 US. I'm going to trade half of my trades. So I'm going to start it, because I can talk about what it's doing while I'm doing it. We'll go ahead and start it. And it's going to be done before I explain it, but every time it gets a trade, it's going to take half of my account, and it's going to buy into that trade, and it's going to tell us how well MACD worked. It's also going to compare them to the other system, and it's already done, the other systems that are in there. So if we were been trading Bank of America and VSAT, I don't remember the name of the stock, over the last 2 years, which includes a pretty good run up, and we'll call it a pretty good run down so far, and maybe even another good run down last year. If I would have traded just those two stocks, I could do the whole S&P 500, but just those two stocks over the last 2 years, our best performing system would have been what's called the PS pattern trading system number 1. And then we had our long sell, short sell, 5 days. That was our best and second best. In fact, out of those two systems, if I would have traded every single buy signal, would have made about 62.57 average between the two stocks on the trading system 1, and 6,000 or 60% on the second. I don't like either of those systems just from this screen, and the reason is how often they're trading. We have about 2 years of data in our back test. You could go back to the 1980s if you want. But in the 2 years that we were testing, it traded it traded on average 58 and 56 times. Now, in 2 years, that's 24, 25 trades a year. That's a couple times a month. That's a lot of trading. This pattern trading system 4, somebody's got a live mic. This pattern trading system number 4 actually would have traded only 8 times, and over those two securities on average. So that's 4 trades a year. That's a trade every quarter. That's a little bit more palatable for me. Okay, so let's take a look at it. And the idea here is we want to figure out what works, and then we can learn about what works. It worked actually best on VSAT. And I'm not going to spend a lot of time just because I don't have a lot of time. I'm going to go ahead and click on the view. There's tons of stuff that's available on this report. You can look at what your drawdowns are. You can look at your winning trades versus your losing trades, your number of winning trades, your number of losing trades. You can compare your profit loss index to your buy and hold index. You get a lot of really good information here. And it's all very well documented in the help files and in the training that's included. Okay, but I'm going to jump a little bit here. Let's say we looked at all of this stuff. We really do like it, but we want to understand how it works. I'm going to go ahead and plot this on the chart. This is the pattern trading system number 4. I'm going to go ahead and open that up. I didn't open. I must not have clicked the right button. Let me go ahead and do this. I'm going to go ahead and kind of delete this. I do remember it was the pattern trading system number 4. So if I wanted to learn more about that, I'm going to come back into this Expert Advisor, the tool in MetaStock, and I just want to learn a little bit more about what it's doing. Go ahead and attach this to the chart. We'll go ahead and click on Close. Every time we get a buy signal, it'll be annotated on the chart. We got one here. Every time we get a sell signal, it'll be annotated on the chart. We can see where that happens. Go ahead and click in here a little bit. Okay. If I want to learn a little bit more about this, I can go back into the expert commentary. I'm going to come to this buy signal that we had here. If trading short positions, we'll want to do a market on close order. We'll want to go long. We'll enter long on a market on close. This system works with a very simple pattern. So this is called the pattern trading system number 4. It enters a long position when the price closes above the high of 2 days ago, and it does more than 75% of the average volume. It closes on a long position and enters a short position when the price closes below the 2 days ago on 75%. So it's looking for a breakout of a high with strong volume to support it. When that happens, that's when you're going to get a buy signal. Okay. And the reason we were able to kind of figure that out so fast is we just went to the Expert Advisor and it told us. The last thing I want to talk about, and I have 4 minutes, the last thing I want to talk about is all of these methodologies have matching explorations. So we've talked a lot about the importance of scanning. I run a scan every single day. And well, every single day that the market's open. So I love scanning. The ability to go through thousands of stocks and find the stocks that actually meet the criteria is, I think, one of the best tools in MetaStock. And as somebody that's been trading, well, been looking in the markets for 30 years and trading actively for I don't know how long, scanning is one of the tools that just day in, day out, something I use. So let me kind of recap. It's actually 33 years in a row now. It's been rated, MetaStock has been rated #1 in its price category 33 years in a row. Best software. So I want to say thank you to all of you guys who have been using MetaStock over the years. I appreciate you. We do really appreciate it. We do have 2 versions of MetaStock. There's a RT version, the MetaStock Real Time. It's only $210 a month. It includes everything I showed you today, but also one of the world's most powerful news platforms. We call it MetaStock Zenith. It's backed by Reuters News. It'll give you all kinds of information about, commitments to traders or news. All the news comes from the Reuters News Network. There's about 3,000 reporters in 300 different news bureaus. It's literally an institutional strength news feed that doesn't cost $27,000 a year like Bloomberg. It's $210 a month, a much more retail friendly price. You get all of that. You also get MetaStock. And you can do this with our MetaStock Real Time. You can do it for 3 months for $210. We also have a DC version. DC stands for daily charts. I don't want you to get confused. It's not end of day. It updates all day long. It's got a 15-minute delay. You can look at your charts. It'll do daily, weekly, monthly, yearly, all that kind of stuff. You can scan during the day. I typically run my scans right before the market closes, and it's only $75 a month. So again, just to recap, $75 a month. There's all kinds of methodologies. These are just bonus streams, bonus things. There's over 300 different methodologies that are included as part of MetaStock. We are going to include a training course. It's called Unleash the Power of MetaStock. It's got 14 videos in it to help you get started, show you how to open up charts, give you indicators and line studies, show you how to use all the power tools. It's a home study course that's built around getting you up to speed with MetaStock. And Greg Lewis actually just finishing all the recordings for MetaStock for the version 20. So big thanks to Greg for doing that. In addition to that, it's only $75, but we want to make sure it works well for you. So we're going to have you do a white glove appointment. You don't have to do this. Obviously, we can't make you do something, but we're going to have you sit down with one of our onboarding technicians, and they'll walk you through the program. They'll answer any questions you have. Those appointments take about a 2-hour block, and I'd really encourage you to get it going because it's included with your subscription. And it's what we found is that if MetaStock works well for you, if it helps you identify those trades better, you're going to keep it. And we want you to keep it. We want you to be one of those customers that have been with us for literally decades. And the offer that we're doing today, of course, you do get unlimited access to our support, all that kind of stuff. The offer we're doing today, it's March 30th here. It might be March 31st if you're in Asia. But it's March 30th here. If you set up an extended trial, you pay for a month. We'll give you the second and third month for free. On the DC version of MetaStock, that gives you MetaStock for $25 a month. You pay $75, you get it until June 30th. If it's not helpful, if there is a June 30th, I think there is in June. If it's not helpful, you can just cancel. There's no commitment to keep going. There is a reason it's been rated #1 in its price category for 23 years in a row this year. You should give it a try. You can give us a call. We'd be happy to answer any questions you have. You can call us at 800-882-3040. You can go to metastock.com/sales chat. If you have any questions at all, we'd be happy. We'd love to talk to you. Just give us a call. Chat with us. Metastock.com/summit deal. You can do it right there on the page as well. So that's it. I do want to reiterate, we do have the special with all of the add-ons we're talking about today. That's normally $8,000. You can get up $4,186. 800-882-3040 or metastock.com/sales chat. As we get on to our next speaker, who is one of my favorite, want to just say, join our community. If you go to thetradersforum.com for free, you can chat with other traders. There's a growing community of about 1,400 traders right now. You can learn about the markets. We do lessons on all kinds of different fundamentals and technicals and patterns, macroeconomics, all kinds of stuff. We did a class on options. All of that stuff is free. You just have to join us at thetradersforum.com. So in any case, Jake, I think I can hear you. Elizabeth wants my email address. It's just jeffrey.gibby@metastock.com. There you go.
You should be able to hear me now. My mic is on.
I can hear you. Oh, thank you. Thank you, Elizabeth. Okay, let me go ahead. Yeah, great. Jake, I can hear you. I didn't get a chance to check to see if Brian was here with us yet. Brian, you here?
Brian is here, but the link you sent me didn't work, so he gave me his. So
okay.
There's two Brians here. You're gonna have to change one of us.
Oh, I don't think I can, but I can see both of you. So if you want to click on your name, you can change your name.
I don't need to change my name. I just want to make sure you guys can hear me.
Today? Yeah, I can hear you. I'm going to call both of you Brian.
but I can't share a screen.
Jake, I just talked to you, or I just talked about you. I don't know how long ago you dropped in, but I said not only were you a psychiatrist or a psychologist, but you had some really interesting stories around that. I'll also say a few things. Jake has written a prolific amount. I used to say the number, and then I was always very, very small on the number. He's written a prolific amount of books on trading. He's very, very, he really looks a lot at seasonalities. There's specific parts of the commitment of traders he really likes to talk about. He did his first trade in the late 1960s, and it was eggs, I believe. And in addition to that, he always comes to the market, or he always comes to a trading methodology that always has 3 key elements that I think are important for every trader. That would be setup, trigger, and follow through. And that's something that he does very, very religiously. Brian took some concepts that Jake designed, and he wrote the JBXC with combination with him and Jake. And it's a very, very elegant indicator that does a whole bunch of stuff. And I'm not going to spoil it because that's what they're going to talk about. But these are two really, really good traders. Jake, Brian, let's go ahead and get you on here presenting. Let me go ahead and
Thank you very much. Thank you, Jeff. Jeff, is there a way you can make me a presenter so I can share my screen?
Yes. I was actually going to do that with Brian, but I'm going to do that with you right now.
Oh, good.
If I guess the right Brian.
Okay, let's see.
It should just ask you if you want to share your screen.
It's not asking me that. It's giving me a Chrome tab.
Okay.
Choose what you want to share. Okay. Hold on 1 second. It won't let me, but I'll try it again.
Yeah, up at the top of that, it should say, do you want to share a screen or a tab? And you can say, if you click over to screens, you can share a whole monitor. Just by clicking
let's try that. Let's give that a shot. Okay. Third screen. And hang on 1 second. No, it won't let me do it. But you know, I can proceed without a PowerPoint because Brian is going to do most of the PowerPoints.
All right, let me make him the presenter then. So
yeah, good idea.
So that we don't have so that we have something to look at least. That's not me. All right, Jake, Brian, I can see your screen. Jake, I can hear both of you guys. I'm going to go ahead and turn off my camera now, but I'm here if I'm needed.
Thank you.
Okay, very good. Thank you so much for letting me be here today. And for letting Brian and I be here today. We really appreciate that. And I want to emphasize a couple of things. Number one, we're not getting paid to do this. We don't want to be paid to do this, and we don't want to have to pay to do this. So it's not pay for play and all the rest of that stuff. Brian is a great guy, fabulous researcher, great options trader, and a fantastic coach. It's been my pleasure to be associated with him for a number of years. And of course, Jeff Gibby, MetaStock, perennials in the business, been here forever, and continue to put out great quality information and care about the people they do business with and really wants people to succeed in this business. From my point of view, it's been very difficult to be in this business for more than half a century and continue to see people losing money. It's just not what I signed up for. It's very, very painful to me to see people lose money working so hard at their job all day, coming home, studying the market, pulling up charts, putting lines on charts, drawing stuff on charts, and then trying so hard and still losing money. The goal that I have had, aside from the money that I've made and the notoriety that I've achieved, is to teach people how to trade the right way. There is no one right way. There are many right ways, but most of those ways are specious, by which I mean if you go to the internet and you punch in a search for teach me how to trade, you will get, and I exaggerate not one bit, you will get literally hundreds of millions of hits. And so the new trader is confronted with a sea of claims and promises, with a sea of theories and methods, and they're confused. If you watch television, you'll see the guy sitting in his kitchen watching a screen. Evidently, you see on the screen, he's looking at a chart. There's lines on the chart. He's punching in the keyboard orders. He's smiling. He's happy. Meantime, his kids around him are going crazy, throwing stuff around the room, throwing stuff at him. But he's happy because he's making money, or at least you think he is. In my experience, most traders don't make money, never have, never will. But it's not about the money. Making money is not about the money. It sounds a little contradictory, but it isn't. The fact of the matter is, there's things that work and there's things that don't work. We know after many years the things that don't work. The key is, obviously, to avoid doing things that don't work and to do things that do work. So people say, If you lose money, it's an expensive lesson. It's tuition. You're giving your tuition to the markets. Learn from every loss. Well, I agree. You want to learn from every loss so you don't make the same stupid mistakes over and over again. But very few traders spend time listening to or understanding their profits. When they make a winning trade, do they say, what did I do right? What did I do that worked? What made me money? How could I have made more money by keeping this position? Could I have used a profit maximizing strategy? Most people don't. They're just happy to get into a trade, get a tummy ache, give a sigh of relief when they make $100 and then get out. And then 2 days later, see that same trade, had they kept it and not paid attention to it, they could have seen the trade worked 10 times what they made. So the behavior, and I'm not calling it psychology because I believe it's behavior, not psychology. The behavior of making money is very simple. We know the rules, but people seem to think they can break the rules. There's a famous movie called Putney Swope. You might want to watch it. The key line in that movie is, you got to know the rules before you break the rules. I say that because if you ask most traders, what are the rules of your trading strategy? They won't know them. They won't know if they work. They won't know how often they work. They don't know their odds of success. They don't know their stop. They don't know their trailing stop. They don't know their profit maximizing strategy. They know nothing. And if they know nothing, that's exactly what they're going to get. So Brian and I are here today to help you overcome that obstacle by using the powerful resources in MetaStock, by learning the specific rules of the strategy that we developed. Now, one more thing I'll say to you, and I'm sure that you've heard this all 1,000 times before. Bottom line is this. If you know the rules, they have to fall into a trading model. As one moment, please. My computer is going a little crazy here. As Jeff said, I use a strategy called setup, trigger, follow through. That's setup, trigger, and follow through. If you have a trading model that gives you the information, setup, trigger, trading, follow through asks for, you are almost assured to make money in spite of yourself if you follow the strategy. I'm going to break that into the 3 parts. Then I'm going to turn it over to Brian, and he's going to show you how we can do that. Part number 1, setup. Every trade needs a setup. A setup is a pattern. We know that everything in the markets, everything in life, everything all around us is a pattern. It's going to be either a seasonal pattern, a cyclical pattern, a planetary pattern. It's going to be a behavioral pattern. Certain things happen when certain things happen. If you know the patterns of the markets, you know that you've gotten at least 1/3 of the way there to your goal. What is a pattern in the markets? Example, we know that the bigger patterns, for example, in the Japanese yen versus the US dollar, there's a pattern 7 to 8 years in duration from low to low. We can go on that historical data and find that pattern and say, look, that was 7 years ago, that was 7.5 years ago, that was 8 years ago, that was 7.5 years ago, that we bottomed against the US dollar or so forth. Those patterns are real, they're statistical, and they're numbers. So patterns are all about the numbers. How often did the stock market go up during the last 2 weeks of April? How often has the market closed higher on the day before Christmas? How often has that happened? The good news is we have the numbers. We know the numbers. Everybody has access to the numbers, but most people don't use the numbers because they'd rather believe in the fairy tale. So a pattern is a number. Example, further, reversal, key reversal, inside day, outside day, trailing stop, moving average, ADX, RSI. These are all based on numbers. Most traders don't want to know the numbers because their numbers don't work. They can go on the computer. In fact, maybe Jeff remembers this. Jeff and I gave a talk at the Silicon Valley Options Group, and I was showing a strategy. And I said to the group, and remember, this was a group of engineers, very smart, educated people. And I said, so here's a pattern. Now what we want to do is find out if the pattern works. Does anybody in this room know how to determine if a pattern works? A few people kind of grumbled. A few people kind of raised their hands, and one said, how can we do it? I said, well, we can do something that's very near and dear to your heart for every one of you in this room here today. We can use a computer. And they said, well, we didn't quite think of that. Well, I'm exaggerating the story a little bit, but that was about 10 years ago, maybe more than that. So the bottom line is we find patterns. The next step, trigger. We ask the question, has there been anything in this pattern that's helped it be more correct? In other words, we know from back testing, using powerful software like MetaStock, using a powerful application, we ask the question, how often did this pattern predict the trend of the market? 1 day ahead, 2 days ahead, 3 days ahead, 5 days ahead? Ask the question. And now with AI, the question is easier to ask than ever. You can actually ask the question and the computer will answer it. But be careful. AI ain't what it's all cracked up to be, because sometimes it will give you totally bogus answers and can give you a bunch of BS depending on how you ask the question. So the second step, if the pattern has been correct 77% of the time, can we use a trigger to help it be correct 81% of the time? The answer is yes, and that depends on the strategy that you're using. The next step, follow through. And let me say one more thing. Unless this pattern with these elements are part of what you're doing, contained within your rules, the chances are slim to none that you'll ever make any money. And if you do make money, you won't keep it. So step number 3, follow through. There are 3 things involved in follow through. And by the way, the good news about what Brian and I are going to show you, actually what Brian's going to show you, is the strategy we're going to show you, which has been coded into MetaStock, gives you everything you need. So the third step is follow through, consisting of 3 parts. Part number 1, where are you wrong? Part number 2, where are you right in terms of profit target? Part number 3, how are you going to take that profit and turn it into a big profit? Why do you need a big profit? Because we know for a fact, not fiction, but for a fact, 80% of a trader's money is made on 20% of their trades, which means the 20% that you're making money on had better be pretty damn big, because you're never going to be able to compensate for the 80% of the trades that are losers unless you've got some really big winners. It's that simple. It's that factual. It's not a theory. It's not the Elliott wave theory. It's not the Gann theory. It's a fact. So if you like to deal with facts and you like to look in the mirror and say, I believe what I see, I'm not going to lie to myself, you're going to use setup, trigger, and follow through. And if your strategy won't fit into setup, trigger, follow through, don't use it. Advice from a person who knows. Don't use it. But having the powerful capabilities of being able to backtest and even forward trade by letting the computer tell you what to do is a great, incredible tool, which is what computers, in my view, were designed to do. So setup, trigger, follow through. Let's talk about something else. Setup, trigger, follow through is based on the concept of the moving average channel and Williams accumulation distribution. Brian is going to get into detail about that. But let me say one more thing before I shut up. Very important. It doesn't matter how sophisticated your computer is. It doesn't matter how many screens you've got. It doesn't matter how fast your computer is, up to a point. It doesn't matter what kind of lines you put on your computer. The more lines and the more colors you have, the more indicators you have, the more confused you're going to get. The simple fact of the matter is that 98% of all indicators are derived from one thing, and that is price. So they're all going to look the same. Depending on how you use them is what differentiates the winners from the losers. How do you use ADX? Is there a manual for using moving averages? How do you use the triple moving average crossover system? Are there specific rules, or do you just look at the chart and say, it looks like the market wants to go up. It looks like the market's going to go down from here. Those are cheap, worthless opinions. 10 people looking at the same information can reach 8 different conclusions. Unacceptable. It has to be all black, all white, or nothing. So I'm going to turn it over to Brian. Let me say one more thing about Brian. Brian is a true gentleman, soft-spoken, with a great, strong voice, and youth on his side. But he's also a great thinker. He'll come to me after looking at my stuff and say, what if you did this? What if you did that? Might it improve it? And of course, we're always looking to make things better. So Brian, it's been my pleasure to be associated with you. You're the options guy and a great teacher as well, great tutor and coach. I'm going to turn it over to you. And I want to thank you, Jeff, for giving me a couple of minutes here.
Thank you very much for that, Jake. So I'm just going to pop a little bit further forward here as we take a look at the presentation and just get over into the disclaimer, because I am going to show some performance as we have been walking forward with the trade results of expansion, contraction, and swing trades. And I'm also going to show some updated rules and results on some intraday trading on that. Then Jake has already been on, and I think that got a pretty good introduction already. But again, people around the world, corporations, trading businesses, and such are Jake's major clients. And again, so you might see that here with the online weekly capital markets report and analysis. And of course, he's been publishing all of this stuff since 1972. You can see that. I was about to say turn of the century, but he's gone beyond that. My background is a little bit different. I didn't get started till later in life, but I am drawing from some background on work experience in Silicon Valley in the 1980s, working in reliability assurance for an electronics company, and was taught statistical process control. So at that point became quite proficient in databases and spreadsheets and analysis on that, tracking photolithographic wafer stepper performance over the years, and turned back around and started to apply that into Jake's process. And in the long run in there, I've also been developing traders on that, because again, we need more traders on that. If you have a business that's trading, you can't clone yourself physically, but you can turn around and increase the number of people who understand systems trading, as the original slide said, fact-backed, rules-based trading on that. So I popped up to the simplified introduction of expansion contraction. For the last several years, Jake and I have been doing these calls, and so it's been explained a lot more and thoroughly in the past. But I'm going to at least touch here. You can see it's non-lagging at the top, and it really only takes one bar to plot information, unlike most other bars that are lagging. And ideally, we're using non-lagging information in our systems trading on that, as basically lagging indicators have shown to be a bit problematic, either in being late to get in or out, or having too much whipsaw problems on that lag. So we have also added a trend filter into that in the second paragraph, and those two unique measurements are actually identifying, well, I can say higher probability, but the reality is that's been in the 57 to 72% win rate on the low end to high end, and basically right around 65% on average, traded in top weighted stocks in strong trending markets on that. So the expansion contraction indicator on MetaStock charts are shown here with the short-term swing lines. On that, as you can see, I've marked out the green line and the red line as two of the components of this. The short-term lines are measuring how fast price is moving up or down through Jake's moving average channel on that. And ideally, what we're doing is identifying when we want to be in, how long we want to be in, what's the strength of the market, and when to get out. So like on setup, trigger, follow, the rules to get in, rules to get out at a loss, rules for taking profit are all predetermined here and also available in the expert advisor. And so on that, when we're taking a look at the lines, when the red and green lines are showing green above red, that's short-term bullish. And the second part of this is the longer term trend, which creates the background shaded area, either the cone, Jake likes to call it, and I have a tendency to call it the cloud. And it just means the same thing on here. So expanding cloud, either red in this instance or green, is showing a strong move up when it's green, and a strong move down when it's red, meaning the cloud in the background long term. And what happens for the buy and sell setups, we're just looking for when the short-term lines are crossing, where we're short-term bullish or bearish, and the long-term trend has changed to short-term bullish or bearish, and that's going to trigger a buy or sell setup that the expert advisor also shows, as well as the price to get in and price to get out at a gain or a loss, as all that's been predetermined. So as you can see at the bottom, short-term swings, this identifies up or down, strong or weak, or going sideways or consolidating. And in the long-term trends, which are the shaded areas, we're also either bullish or bearish, strong or weak, and we may not be trending. And the non-trending patterns are like far right on this chart, where both the lines and the cloud are basically staying inside either the half or one standard deviation horizontal lines we'll get to in a second. But we can see strong trends, we can see not trending, all in the same indicator. It also shows major supports and resistances as identified up at the top. If you're in an uptrend and we start to contract with the indicator, we've hit a resistance, and that'll show up in the charts on that. And also on that, if we're in a downtrend and we hit major support in the downtrends, we're going to start contracting with the indicator. So hence again, the name expansion, contraction. Expanding markets are strong trending up or down. Contracting markets are weakening in that particular instance. And we just want to have a single indicator give us the indications again of up or down, strong or weak, long term, short term. These are also coded onto the charts so that the. Sorry,
Brian,
Jake, go ahead.
Brian, can be used in any time frame?
It can be. I've traded this back on systems on weekly charts to daily charts to intraday charts, like the 15-minute, even down into range bar charts, which I'm going to show a little bit later if we're just trying to trade breakout strong up or down. So any time frame on that, any instrument, all of the different markets. Jake's expertise obviously is futures and stocks. And my expertise is in options and currencies. So when Jake and I do some small group coaching, you get basically the best of both worlds, how to apply a rules-based, fact-backed trading system shown to be positive outcome over time. As I'd certainly say, if you haven't seen previous sessions that Jake and I have done, go ahead and subscribe to the MetaStock channel and watch some of these in the past, as we've basically been walking forward results for the last several years on that. So I did mark out on the indicator again, the median, basically the center line. That's where everything posts above or below. On all of that, that should be pretty obvious. The horizontal lines, again, are marking out using moving standard deviation, at least giving us an idea mathematically when we're breaking out or overbought or oversold. Two terms in a person I like, I might prefer that with limited upside. When we've hit a resistance and start to contract on that, we would be over 2 standard deviations, which you can see on these labels are just marking out the small dashed gray line, the dashed dot gray line, and the large dashed gray lines are showing us long-term and short-term 1 or 2 standard deviations, which is a mathematical strength and overbought
Question
or
for you,
oversold.
Brian.
Sure, Jake, go ahead.
Is it necessary for anybody to know the definition or application of standard deviations in order to use the strategy?
No, not at all. Right? Just the fact that when it exceeds a certain deviation, that's either gone above normal, we'll call it above average, or strong, and or beyond what might be the limit to these pricing. As this indicator is not only zero lag, but it's also not limited to a scale that it can go up or down. So like MACD that was shown a little bit earlier, that has no limitation in the right vertical scale. So if we kept going up forever, expansion, contraction would be expanding as long as we had strength in the market.
So because, as you know, Brian, the way I use expansion contraction is very simple because I'm a simple guy. If there's a trading strategy system available anywhere, I've probably tested it and rejected it. So I've kept very few strategies because most of them don't work. My simple use of the expansion contraction is when the expansion contraction cone is green, I'm long the market, or I'm swing trading, buying the bottom of the moving average channel, getting out at the top. When the cone changes from green to 2 consecutive red postings, I'm out of my position or I'm short. That's the way I like to keep it simple for me because that's what works best. But I found that it works in any time frame very effectively if you keep it simple, or at least if I keep it simple. Very, very simple. One more thing I wanted to say about the expansion contraction is I don't look at the lines in between in the cone for the short-term change or the long-term change. I'm trading the big cone because that has given me the best results. But it's up to every individual to use it on their own and to determine ways that works best for them. I'll give it back to you, Brian.
Thanks for that, Jake. And yeah, I mean, each of us have our own unique ways of using it, but simple is better, right? Keep it simple and no simpler. I know I have a tendency to overcomplicate things and keep coming back to simple, but I think that's just a learning process that we all go through. If something simple works, then we can overcomplicate it and screw it up. So, but again, if you at least come back to what did work and why, you can keep improving that system. And that's what I'm going to show a little bit later is some improvements on the day trading process, which previously I'd shown 1-minute charts with expansion contraction. And we're going to take a look at some tick charts for breakout, strong up or down. But
can I just explain one more thing? Can I just explain one more thing before I give it back to you?
Sure.
What is so special about expansion contraction? What does it mean? I'll tell you what I think. If you look at any chart, you will see that as a trend continues, whether it's an uptrend or a downtrend, as the trend becomes stronger, the range of the trading expands. It becomes wider and wider. So traders are willing to chase markets higher and pay more and more money for them. As long as they're willing to do that, the trend continues higher. But as traders get skittish, they say, I don't think it's going to go any higher. I'm a little bit nervous. I don't want to spend money taking risk and so forth. As traders do that, the range of the trade of the day begins to narrow. And as the trade narrows, you'll see the market begins to top. So expansion and contraction are leading indicators. They give you a sense, at least for me, to give me a sense of what's going on. The more a market expands, the better it is. And let me give you a further example. Trading is like an auction process. If you go to an auction, what happens? The auctioneer, and I love that because I collect antiques. So the auctioneer holds up a stained glass window and says, here we've got a 1920 Tiffany stained glass window. Can we start the bidding at $5,000? Do I hear any $5,000 bids? Nobody puts up their hand. Do I hear 4,500? Nothing. 4,000, nothing. 3,000, nothing. 2,000, nothing. Now the auctioneer is down at 1,500. He's getting ready to call the auction off because no one's participating. Suddenly, 16 people put up their hand and are bidding on this $1,500 window that the auctioneer thinks is worth a lot more. Suddenly, the market is open and the trading range is beginning to expand. Now the auctioneer is up at $4,000. There's 12 people raising their hand. He's at $6,000. There's 18 people raising their hand. The auction is expanding. Now he's at $25,000 for an item that nobody wanted to bid on at $1,500, and it's getting bid on at $25,000. Go figure. Why does it happen? It's about perceived value. Joe is looking at Stuart, and Stuart is an auctioneer and an antiques dealer, and Joe knows that Stuart is willing to pay a lot more money for this window, and he's bidding $25,000 on it. So he easily must think he can sell it for $50,000. So the range expands further. And that's very important to me in understanding expansion and contraction, to view the market as an auction process. And now I promise I'll shut up.
No, that's okay. No, I always appreciate your insights on that, as after all, I am the student and have just taken your process and continue to refine and define on that in order to keep making systems better. And I would certainly say to everybody here, if you are using somebody else's system or if you have your own system, keep working on it, gather the data, track the trades. It is in that data that you can find a smaller stop rule or maybe a bigger profit target rule. So in everything that Jake's talking about through the setup, trigger, and follow-through process, there's also the backtesting process that he had gone through, where you look at 15 years of data and walk it forward for 10 years to pull up some results and optimize all that, and then walk it forward for the next 5 years to make sure the test results from the previous 10 years are stable. So in lieu of not being able to test certain things with the limitations in some trading platforms, and then sometimes things just have to be done manually, but it is in that manual work. Certainly when I'm teaching students and I ask them to go back and replay the past and force them to take the trades, walking it forward and learn from the past. It's a way to speed up your learning curve by continuing to test the past. I'm going to pop up on the paint bar definitions on the charts, expansion, contraction. We'll code the bars on that. Dark green bars identify strong uptrends in this case, and the dark red identify strong downtrends and swings. And of course, if we're light colored, light green or light red on that one, then we're just in a weak bullish or bearish pattern. And again, this is non-lagging and clearly marked on the chart. Ideally, we're trading reality at the right edges of chart, and it just is what it is. And you can sure eliminate thinking about the future in this process, because as each bar grows and you know whether you're staying in or getting out in advance, then that's the key on there. Not so much chasing price, but predetermining where you're going to get in and out by calculations, testing that and seeing that it has a positive win rate and a decent profit to loss ratio. At that point, you could just wash, rinse, repeat, and over and over and over, follow that same process. So expansion, contraction, as I said, does measure the normal range of pricing, and that helps us with either the above average or below average, as Jake was saying, as price is trading into the range or above. or below the range, then we want to know that for sure at the right edge of the chart. And again, most of the people are worried about what's going to happen, and we can just focus on what is happening at the right edge of the chart. So as I said at the top here, it does mean that you'll know what to do and when to do it, especially with the expert advisor that also includes the actual pricing of entries and stops and targets and such. Of course, that's because those rules were given out last year again, and do watch the replays, as that is probably one of the fastest ways to learn. As I said earlier, we've been walking this forward, so even if you haven't traded before, you've got to follow some set of rules, and Jake's rules-based trading actually is several choices, from Jake's 6 timing triggers to expansion, contraction, and what will likely be more as we continue to refine the process. So as I said a little bit earlier, I've been refining the timing triggers for day trading just because it is so popular. These days, everybody thinks I just need to get to the computer, trade for a little bit, make some money, go to the beach, blah, blah, or even worse, get up in the morning, go to the beach, and then try to trade and make some money. I'm going to sit there and say that this really should be considered a business.
Trading at the beach.
I've seen other people do it. I don't think I would take my laptop to the beach. But then again, it takes all kinds.
Yes, let me interject with one more thing.
Go ahead, Jake.
I always tell people it's not the strategy as much as it is the trader. It's the trader who screws up most of the time. The strategy is what it is. It's going to be right a certain percentage of the time. So I say to people, look, if you're having a discipline problem, you're having trouble following the rules, either you have no confidence in the rules or you have no confidence in yourself. How are you going to build that confidence? Easy. Take the 10 trade challenge, by which I mean make a commitment to take the next 10 trades 100% by your rules and see what happens. And so then when I said that, Brian said to me, how about 3 trades? Because most people can't even take 3 trades in a row strictly by the rules. So if you want to build discipline and you want to build confidence, follow the rules absolutely religiously for 10 trades. And if you can't do it, pay somebody to do it for you and see what happens. I submit to you that if you have a strategy that's even partially successful and you take the 10 trade challenge, you will change your life, because there are very few people out there that I have met, and believe me, I have met literally hundreds of thousands of people. I've been all over the world, traded in front of thousands of people with real money in real cities, spoken at major exchanges throughout the world, in Asia, in England, everywhere, you name it. And I have found that most people cannot follow even 3 or 4 trades in a row without finding a way to screw it up. So I don't mean to insult anyone. I'm sure that everyone here is perfect, but just a little advice from me. Now, truly, I'll shut up. Back to you, Brian.
No problem. I'm not insulted at all, although I have been there, done that. So those are things of the past. Hopefully that one learns. If you keep repeating the same mistake over and over, it's starting to border on a little bit of insanity. So, right, ideally, you're back to saying, I absolutely have to have a process, A, B, C, D, like this, rules to get in. Refined the high frequency trading a little bit to slow that down. And that's basically going back to 4-point bars at this point on the range bars instead of 2-point, in order to, as it says up on top, improve the tradability, as after all, range bars can plot very quickly. And if you're not at least semi-automated or fully automated, might have a bit of problem. But the 1-minute bars that I showed on the January session are actually pretty close to these 4-point range bars. And again, I'm just going to show breakouts. I just went ahead and decided to plot giant boxes on the chart so you can see when we're significantly bearish or strong down or strong up, and their initial risk rules, 16-point stops. I had to double the size of the stop on increasing the size of the range bars. And in running through 8-week test that just ended last Friday of all the stats that I'm about to show, looking for first and second profit targets and having some alternative profit targets that are in essence whatever happens first for that coding. So let's at least pop over to a chart on that. And since I've got most of my original coding just to develop systems on Trade Navigator, I have shown that chart service here. Where I've gone ahead, there's my typical S for sell setups and B for buy setups. So basically the only BS I have on my charts are the buy and sell setups. And also the large rectangles would show where we're in that strong down situation or breakouts. So some breakouts are fake outs. We don't continue to trade lower. Some breakouts extend down and give us an opportunity for at least a single or maybe more than one trade on there on additional setups. If you're looking to take additional setups, the previous trade is out with 2 targets on there, and then a buy trigger on here, which shows with the B setups and the targets, as well as the entire range, where that's showing it is bullish. So ultimately, the idea here was to just mark something that said, if you're going to be doing something in here, it should be bearish because we've broken out strong down based on the range and pricing short term. And the same thing with the buy setups. Ideally, if you're saying we're breaking out of the range strong up, that we would want to stay bullish in this case. And what I did at the bottom, as Jake was mentioning before, I also took just the long-term expansion contraction at the bottom. And so we can see when we're long-term down below the deviations or whatever, and where we might get oversold here at an extreme low or limited downside at that value. And of course, where things reversed along with Williams accumulation distribution, another non-lagging indicator to help us identify when a general trend lower is rolling over and reversing and becoming an uptrend. The other changes I made were to the average range of price with the Keltner channel. I previously used a 20 period on the high frequency trading and slowing that down to a 32 period range chart on this one helps not only with longer term moves that can go further. If you're looking at the points here, this was 65.85 approximately, all the way down to 65.25. That was a 60-point drop on that one. And so here we are looking at range bars short term that may plot approximately every minute to few minutes, and still can see some long-term trades in here with some breakouts. So in order to also show how you're going to track things, because if you're not willing to track the results, you're not going to know the specifics of the data. And in taking a look at the very bottom in here, where it's a kind of accumulation of all of the net results on there, since we're looking at the data and this is just a lot of information. What it basically did was split out the week by green, white, so you can really see for the weeks what did happened on that, and every trade plotted, kept track of the net gain up 121% on that in 8 weeks on 218% gains and 97% losses. So basically on a $80,000 account, the losses were actually almost $80,000, but fortunately the gains were over 2 to 1 on that in that 8-week process. And on this yellow bar here, I basically also just kept track of the net gain for the week 1, week 2, all the way through week 8 on that. And this is averaging about a 15% return on 2% risk on $80,000, which was just 16,000 risk on 2 contracts in the ES. And that ended up showing a win-to-loss ratio of 70.3 on over 400 trades. And I went ahead and included like the biggest run up and biggest drawdown. There's been one stop out, which also then says that the 16-point stop could be reduced a little bit. The results would be similar, but again, that would be an edit that could be made based on seeing results. Max wins in a row, 12. Max losses in a row were 5. the day where there was 5 losses in a row, which was in the second week. Actually had
Nice
7
interval, Brian.
losses on that day, but was net up slightly. Go ahead, Jake.
Yes, very important. As I said before, 80% of your money is going to be made on 20% of your trades. So you need to catch the big moves. And the one thing I can tell you for sure about expansion and contraction is this. When and if the big moves happen, expansion and contraction will let you know and have you on the right side of the market. And if you have the imagination that the move is going to end, but the indicator continues to say it's going up, and you act on your emotions, you're going to miss that big move, and then you're going to look back and you're going to say, wow, look at that expansion contraction, caught this big move in crude oil before it started, but I didn't have the wherewithal to stay in for the big move. I say that because I picked up a new student a couple of weeks ago. The first trade he ever made was to be long crude oil on a seasonal trade. Literally overnight, he woke up $7,000 richer per contract and decided it was time to get out. If he had not gotten out, he'd be 4 times higher than that right now. I'm not saying that this is a typical example, but what I am saying is this. You have to get the big moves. If you're not getting the big moves, you're not going to make money. Don't waste your time. Back to you, Brian.
That's absolutely true on that. Unfortunately, some of the statistics on expansion contraction do show some 24 to 32 consecutive periods in up or down trends. On average, that could be more or less in certain situations. And even here, some of the benefits of trades on here, there were almost 10% of the trades over 2% gain and 1 stop out at 2%. On that one. So with the average loss to average gain being about 0.95 to 1, 70% win rate, 0.95 to 1, and showing a better than 2.2 net profit to net loss, does show that this systematic process has shown some stability over time. And I'm going to show some quick chart examples. If you were curious, I'm showing like losses on here when they happen, a breakout to the downside. Jake, do you have a question?
Nope.
Nope. Okay. No problem. You jump in anytime. Some breakouts go a little bit. And again, that was a part of the process, learning that a lot of the trades, most of them, in fact, more often than not, were small gains. But way over to the right, when we did break out and we can get bigger winners, as Jake said, well, I had 10% of the trades made up 82% of the losses in this one. So in that case, as he's saying, you've either got to get bigger winners or a higher number of big enough winners to cover the risk on that. Just in the interest of time here, I'll probably slip through a few more of these chart examples because I've just done Monday from the open, Monday through the close on the trades there. And you'll see in here that these trade results, whether up a little or down a little, here another loss trade, will actually match up in the spreadsheet to run through all those numbers. So on Tuesday, top left this last week, also had some more losses in this initial than the gains, but even taking a look at that 30 plus day period, or actually 40 days, there were only 3 lost days, and the worst lost day was a loss of about 2.30.
John, Jack, your camera's on.
Cent. And on the upside, we had seen gains in the 7, 8 to 9% on the win days on that. So again, I've just put up every chart, and I'm going to scroll through those again a little bit quicker, just in the interest of time. That was Wednesday, early session to late session. Again, the breakout boxes are showing gains and losses on there. Not all trades are winners at 70%, but that's still acceptable on this. And ultimately then Friday, early in the day, a couple of small winners at the beginning, a bit of a mixed market there through this first half of the day. And through the end of the day, we sold off pretty nicely to see some positive outcome on these coded
Hi, Jack.
breakouts.
Your camera's on.
And microphone. on that. So anyway, on that one, I just came back to the overall. You do need to track what you're doing. If you're not tracking what you're doing, you're not going to see some subtle things on that, as I said, where you might be able to put in this case, I've said you could really use a 14 point stop instead of 16, and you still only would have had 2 losers in that instance, as most of the average winners, average losses were still quite small on that. So I do want to put up, as we've been covering this, using expansion, contraction, buy and sell setups in this basket. The swing trade, buy and sells, which are previously defined, and bullish divergence trades if they've happened on there. Where I reposted 2025's annual results on that small basket because there were some trades right at the end of the year that added to that, and also posted up the 6 currencies on that basket. Did have the one loss in the Aussie dollar for the year. And other than that, the net result on currencies last year was about half of the year before and the year before that, and so on. But we're just going to have to take the fact that it is what it is, and not all performances will be stellar or triple digits on that, but that's okay. Here are the 2026 current results. Apple's daily buy-sell setups are down a little bit, and Apple's the worst track record right now with 1 win and 3 losses this year. Amazon up slightly, Nvidia off slightly also, Q's up slightly, Tesla up a little bit more, and Palantir down on those daily setups. But there are floating some gains in here, so almost 8% on those, floating some gains currently on these trades from the expansion, contraction, or swing trade setups. And this is the same basket we've been tracking for years. And yes, it's a little bit tech heavy, but we are willing to be bullish or bearish on that. And currently also the currencies are also underperforming a little bit, but have some decent gains out of there. Euro Aussie has got no gains this year because of a big run into the end of the year. The Euro Aussie ended up doubling its gain last year with a end of year trade that went over 1,156 pips, and that helped that one become a big winner right at the end of the year. So on those results, and just being sure when you're using the expert advisor in the MetaStock chart service, we do have clearly defined setups and triggers with the setup trigger follow through process that identify the rules to get in and to get out at a loss, and when to take a profit, and rules of when to add to a position, and of course back tested. And now we're like 3+ almost 4 years walking it forward on those results, and good or bad, we'll just still keep posting the results as some markets trend well and we have stellar results, and some markets are consolidating or correcting and the results diminish a bit. But that's typically the process we see on that. Not all years are big winners, and that's just going to have to be okay also.
Jack,
And just to tie,
can you hear me?
Yes, Jake, go ahead.
No, sorry, I wasn't. Someone's got their camera on. Never mind. Go ahead, Brian. Sorry about that.
Yeah. I'm sorry. This is Greg. So everyone knows, we cannot turn off for the other presenter his camera or his mic, and we've tried to let him know. So we apologize for the distraction, but please continue. And Jack's up next.
Oh, not a problem. Understand completely on that. So, but to tie it back to
apparently
energy,
got the signal.
Tying it back to energy, at least on previous option rolling spread trade setups on the debit spreads, just to, as I said, tie it back into energy. Energy broke out strong up on the weekly charts last November, and the previous ExxonMobil buy trigger on November 28th is currently sitting at 1,618% up on $113 risk per contract. So whether you're longer term position trading with rolling spreads, or short term day trading, or shorter term swing trading between Jake's 6 timing triggers and the processes here with the JBXC expansion, contraction, buy and sell setups, and the expert advisor, you should have most everything you need there to see some consistent or similar results in the future. Jeff, are you there in the background?
I am.
Brian, you did a great job, Brian.
Yeah, you did, Brian. Appreciate it. Let's see, and my camera's on. All right. I want to kind of just thank both of you guys, Jake, Brian. Appreciate both of you guys. If you want to reach out to Jake and Brian, there's the contact details right there on the screen. Jake at Trade Futures or Brian at thebookontrading.com. And phone numbers as well, 800-678-5253 or 209-620-6403. I want to spend a few minutes talking about expansion and contraction and how to get that. Thank you, guys. I appreciate both of you.
Thank you, Jeff.
All right. I'll go ahead and share my screen. And you guys should be able to see both of your faces again. Let's go ahead and do this. Thank you very much, Jake, Brian. Appreciate it.
Thank you, Brian. Thank you, Jeff.
All right. Okay, very good. Let me go ahead and do this. Here's a picture of the box. Just a real. I like this box. I think it's cool. I did, as we started, call the JBXC kind of the Swiss Army knife of indicators. It helps you determine long-term trend and the strength of that trend, the short-term trend and the strength of that trend, whether the range is expanding or if it's contracting, what your support and resistance levels look like, whether you're overbought, oversold, if you have divergences, short-term breakouts, all that kind of stuff is built into the indicator, and it does a really good job of actually identifying those. So I'm going to kind of skip a little bit ahead. Then I'm going to sneeze, and then I'm going to talk about the expert advisor because I like the way we push this together. One of the things that when we're looking at the expansion contraction is it does a good job of identifying this, and I thought it would be good to put in a dashboard view. So right here you've got your long-term strength, you've got your short-term and the trend and the strength, your range, whether you're contracting, expansion, the strength of that. Do you have a short-term breakout or not? What's your major support and resistance levels? Are you overbought, oversold? Stop losses, all of that kind of stuff. Put right in a place where you can find them, where you can see them, where you can have that literally put right in front of you so you don't have the opportunity to forget stuff. So all of that stuff is put together. It's in the expert advisor. It's in the commentary. That's one of the things I love about MetaStock is the way that you can actually put all that kind of stuff in a commentary so that people remember. In terms of scanning, there is scanning that's available in the program. You can scan for divergences, buy signals, sell signals, long-term bullish and bearish trends, and also your short-term breakouts. All of those are scannable. Again, the ability for you to focus on what's working, on those stocks that have an opportunity, and ignore the ones that don't have an opportunity has been that type of functionality just by itself has been what's helped me be a more serious, more successful trader. And you can do it with this as well. So in addition to that, it does have the testing. You can go in and test the trading ideas, see how well that they work. All of that stuff is included. When we released this initially, and it hasn't been out for too long, but when we released it, we did a two-part training system where Jake and Brian sat down. They discussed JBXC, how to use it, how to interpret it, their thoughts, their feelings around the matter. The second part, I focused on how to use the tool, how to run the scans, how to set up your list, how to do all of that kind of stuff. And that's just included. As soon as you ordered the JBXC, that training is going to be available and part of your right on your downloads page. So normally the JBXC is a one-time purchase. It's $5.99. You can buy it as a one-time purchase as part of the summit today at $4.99. As with all of the stuff we do, it's a 30-day money-back guarantee. You can get a trial with MetaStock if you haven't used MetaStock. Want to find out for yourself how helpful scanning can be, why MetaStock's been rated #1 in its price category for 32 years in a row, all that kind of stuff. We'll include a trial. So you can do this at metastock.com/JBXC. You can give us a call, 800-882-3040. And you can give us a call. You can also chat online. We'd love to talk to you more about it, send you more examples, metastock.com/saleschat. So It is also part of the Traders Action Pack where you can get all of the add-ons that we talked about today. We're going to talk about a bunch of them. It's some of the best add-ons that we've got. If you bought them all separately, it'd be $8,000. As part of the special, we have that at almost 50% off, $4,186. You have to call in for that. The discounts are so big that you had to call in and do it through either phone or sales chat. You can give us a call, 800-882-3040, or metastock.com/sales chat for the chat. So as we move on to the next speaker, I want to say thank you to Stocks and Commodities Magazine for sponsoring all the events that we do. They've been sponsoring the MetaStock Traders Summit since we started it. I think we're on like year maybe 15 or so of doing the summits and the events and the conferences. So big thanks to them. They are offering a free magazine as long as you register for today's event. You can go to metastock.com/traders-summit. If you're watching us on YouTube, there's a pinned comment at the very top. You just click on that. All of the speakers today also have free bonuses that you can actually get. Training courses, ebooks, you name it. It's all available. metastock.com/traders-summit. So there we go. We talked a lot about MetaStock, how it can help you scan and test and find the right opportunities in the market and learn about the markets. If you want to get that, you can go to metastock.com/summit deal. Any questions you have, we'd love to talk to you. 800-882-3040 or metastock.com/sales chat. Our next speaker is John and Jack Kosar. At least John. I know John was on here a little bit earlier. John, let's go ahead and kind of get you started. John has a very, I really love the Asbury research style of analysis. It's a very, very broad market approach. They gave me we've had them on a number of times, and they've given some great advice. I remember there was a time where they were looking at, based on their research models, they were looking at European and outside of the US ETFs. That was a very, very good suggestion at the time. I'm really, really curious, given all of the, let's say, shakeup that we've had lately, to see what you guys have to say today. John, are you by yourself today?
I am. I am the Lone Ranger today. Jack is on a well-deserved vacation.
Okay, good. Well, that serves him right. Well, it's good to see you. John has about 40 years of not MetaStock experience, market experience, but I think he's been using MetaStock for probably about that long too.
Yeah,
I think he was version 1 user, if I'm not mistaken. John,
Yeah.
let me get your screen shared. So I'm gonna go ahead and do this. I need to go over to this screen, and I can pop a note over to you. I'm gonna make you the presenter.
Okay.
I should ask you to share your screen.
There we go. Can you see that?
Not yet, but it does sometimes take a few seconds. There's also an OK button at the bottom to enable it.
Okay. Well, small detail.
There you go. First try.
So
First
sorry,
try.
my face was on. This is a new. This is a little different presentation software than you had last time. So
it is.
And
unlike the last one, we could turn off your camera, but we can't turn it off. But it's okay. I enjoyed watching you for a minute.
Yeah, try to prepare everything.
All right, very good. But I can see you now, and I can hear you, and I'm going to go ahead and get out of the way. It's your turn.
Okay, great. So Jack's not here, but I am, and let's get started here. How do I move this? Let me see. So
Are you talking about?
Yeah, I'm trying to move the slides. A little different than the last presentation.
Yeah, so you should just be able to click on the slide to advance it. Are you looking at one screen or two screens?
Now I'm looking at one.
Okay. In that case, I would minimize the GoToWebinar console, and then that way you can just do it straight from your PowerPoint.
Okay, minimize the console. Huh?
So up at the corner where you have like the close, the maximize, and the minimize, if you just minimize your GoToWebinar console, you'll just be looking at just your PowerPoint, and you should be able to advance it that way.
Where is the minimize?
It would be at the very top left hand. You know how you normally close? Don't click the X, but there's a minimize. It's just a standard dot. Or a standard dash. Very over at the top. Let me see here.
Here's minimize. Okay.
Now,
There
we got it.
Good. Thank you.
No problem.
Okay, so let's get started. Those who aren't familiar with Asbury Research, and Jack and I, this is my 43rd year in the business, and I started out as a 24-year-old kid, green as grass, over at the Chicago Mercantile Exchange back in 1980. Which was kind of a wild time. The prime rate was, I think, 21%. Gold was at all-time highs. But I spent 17 years down there. I see that as kind of my college. It taught me a lot about markets, and from a little different perspective. It wasn't the typical academic exposure to financial markets, but rather a much more practical one. I did everything on the trading floor except sweep the floor at the end of the day. Started as a runner. I ended up as a floor analyst for Deutsche Bank and for NatWest Markets, and I filled orders in the pit, traded for my own account. And then when I got off the floor in 1997, I worked for a couple of small firms, and then I started Asbury Research in 2005. And the last 10 years of my exposure to the business, by being in the business, took a pretty hard turn into quantitatively analyzing markets. When I began, it was head and shoulders and double tops and all of the kind of classical Edwards and McGee types of ways of trying to understand what the trend was and where the advantageous places were to get in and out. Now it's all numbers driven. A lot of that has to do with my son, Jack. And what we've done together is I've taken all of the favorite indicators, let's call them, the tools that I used for 40 years in the markets, but I never back tested them. And unless you do back tests, the markets have a way of making you think that you've got something that's you found the Holy Grail, and you really haven't. Your mind can really play tricks on you. So we've back tested all of my favorite tools that I've used, and we use those tools to actually build models. Jack's got his MS in finance, and so that's what we do. We basically build models. We sell research, and we also lease our models out to various trading firms, and they use that to manage their clients' money. Again, I've been around a while. Right now, I'm pretty visible. I do Fidelity webinars twice a year. I'm always on with Jeff and MetaStock. I've been using MetaStock probably for 30 of those 43 years. Charles Schwab has a online financial show that I'm on once a month, and it's good to be seen. The way that I explain to people what we do is both of my kids are high school and college baseball players, and if you've ever seen the movie Moneyball, it's about a guy named Billy Beane, who was the GM of the A's, the Oakland A's. I think this is back in the 70s, and low budget team. They didn't have a lot of money, and they couldn't compete with the Yankees and all these big big city teams that had unlimited money to spend. So what he did was he hired some kids from Harvard, and I'm probably messing this story up a little bit, but the gist of it is right. I think the kid was actually from Yale. And what they started doing is studying all this data that this guy named Bill James compiled. And they ended up being able to get players for dirt cheap that nobody knew were there. Like they had a catcher who was their leadoff hitter. He was overweight. His 60 time to get to first base was probably one of the slowest in baseball, but his on base percentage was like 70% of the time he was on base. He either got hit by a pitch or he didn't swing, but whatever the reason, they found all of these players that had these unique data anomalies, and they put them together in a lineup, and they ended up going from a last place team to one of the top teams. That's kind of what we've done here, is we've taken the indicators that I used with success in my trading career, my investment career, and that Jack has back tested. So we know all the numbers on these things. We know what the maximum drawdowns are, and the standard deviations, and the betas, and the up captures, and the Sharpe ratios. And we built models in very much the same way as Billy Beane had built the lineup for baseball, for the Oakland A's. So we built all these models. We're going to look at a bunch of them today. Hopefully what you take from here will be some ideas how you do this for yourself. Everyone's got favorite indicators that they like. I encourage you to do back testing. MetaStock has ways that you can test your ideas. So we're going to look at a correction protection model, which is for wealth preservation. It's basically stayed right with the S&P 500 for the past 8 years, but with 40% less risk. Drawdown of 20% instead of 34% for the S&P 500. Our Asbury 6 model is it's for tactical risk management, but really what it is, it's a daily EKG of what the health of the market is. I built it for myself years ago because even for a guy that's been doing this for decades, when the market's up 100 today and down 100 tomorrow, and there's tweets coming out, and it's just gets really difficult to stay on your game. And the Asbury 6 helps me to understand what the internal health is of the market every day, even when it's going crazy and you're having these wild days where you're up 100 one day and down 150 the next. Our CEF model is our sector rotation model. Over the past 8 years, CEF has outperformed the S&P annualized by about 8% a year, with a little smaller drawdown than the S&P 500. That's a popular model that we had built to follow the asset flows as they move around the 11 sector spiders. We're going to look at some ETF trade ideas. I'm going to show you what I use to comb through 6,000 plus ETFs to find ETFs that have healthy internals and have good risk reward characteristics. And finally, we'll just look at our 4 model portfolios briefly, which we've built by taking the correction protection model and the CEF model and other tools that we use, combining them with specific ETFs to come up with some really good systems for investors. So we're not floor traders or short-term traders. I did a lot of that when I was a kid. We are more, I'd say, intermediate. We're trying to catch the strategic trend, which for us is 3 months out or farther. And then we use a tactical metric to get us in and out of those longer term trades. Where to find us? If you like what we're doing here, the best way to follow us is to go to the Asbury Research YouTube channel. It's right in the middle. We have twice a month, we have a Following the Money podcast that we do, and we put a lot of video in there over the course of the month. It's free, and it's just basically more of the same of what you're going to hear today. Let's go through a glossary of terms quickly, because we use a lot of, it's not really jargon, but we use a lot of quantitatively oriented terms to try to determine where value is. So the maximum drawdown is very simple. If the S&P tops here and drops to here, the max, like right now, the maximum drawdown from the top, which was a day in February, to where we were on Friday, was 7%. That's maximum drawdown. Standard deviation indicates greater price swings, a wider range of returns. So if your standard deviation in the S&P 500 is 0.8 and yours is 0.6, it means that your account is less jumpy. The day-to-day volatility of the account is less. Beta is a little bit different. Beta measures the stock market's volatility relative to the overall market. A good example of this would be beta on the S&P 500 is always 1.0 because that's the bogey. That's the benchmark. Procter & Gamble might have a beta of 0.7. Crypto or a volatile tech stock, insert name here, you might have a beta of 1.2 or 1.25. So when we talk about a lower standard deviation on lower beta, it just basically means a less volatility in your account. It's probably the best way to talk about both of those. Risk-adjusted returns. Evaluate an investment performance that takes into account the level of risk associated with the investment. Jack's the mathematic. He's the mathematician around here. But basically, what it does is it measures a strategy or a model, whatever you want to call it, by how much risk you're putting up to make how much. A lot of people say, well, I made 35% last year. What did you risk? Risk-adjusted returns are a way of doing that. Sharpe ratio is one way to come up with a risk-adjusted return. Higher Sharpe ratio indicates a better return for the level of risk. Typically, a Sharpe ratio of 1.0 or greater is a very good Sharpe ratio. Most models that I have seen, most ETFs out there, they are not able to hold a high Sharpe ratio typically for more than 6 months or so. Our models hold them for years. So again, it's just a way of making more than you risk, I guess, is a really simple way. And finally, annualized total return represents the average yearly growth of an investment over a specific period, considering the effects of compounding. So if you hear us talk about annualized total return over 8 years, we are factoring in compounding, but we're also averaging those years so you can get an idea of what it is across the whole spectrum of years that you're looking at. Let's talk about our Asbury 6. When I give these presentations, I like to try to give them, if I can, in the context of who am I talking to and what can they get out of this? And I think everybody can build their own Asbury 6, frankly. It takes some back testing chops, but everyone's got a handful of favorite indicators that they track, whether it's a MACD or a moving average, everybody's got them. What we did is we took probably 30 indicators that I had success with throughout my career, and Jack and I started to back test them, kind of like the Moneyball thing, right? In groups of 6, groups of 4. We ended up with 6 indicators that were different from each other, but they played nice together. They were like a team, like a hockey team of 6 people. And in one of your wingers falls down, and maybe the center comes and he picks up his check for him. That's kind of what these do. So we look at the rate of change in the S&P 500. We look at the relative performance of stock prices versus high yield bond prices, investor asset flows, volatility, trading volume, and market breadth. We've got certain spin on all of these that we look at, and we're going to look at 3 of them in a minute. But the purpose of this is no indicator works all the time. One sure way to lose money is to get married to one indicator, because they all have their Achilles heels. They all have environments where they don't work well. So we put 6 of them together, and we need to get 4 or more in one direction in order to come up with a signal from the model itself. The downside, it's busy. It averages about 9 round turns a year. For some of you that are day traders, it's probably nothing. It's intermediate term for you. But it does about 9 round turns a year annualized with an 8-year look back. Why use it? Because it has stayed right with the S&P 500 during that 8-year period, which is about a 12.5% annualized return. But the S&P 500 has drawn down 33.9% maximum during that period. The biggest drawdown we've had in the A6 is 13.6. So the way that I look at that, and I'm not encouraging anybody to use leverage, full disclosure, I do at times. If I can get S&P-like performance for a third the risk, well, that means I can trade a 2 times leveraged S&P 500 and still have less risk than the S&P itself. So you can see it can be really jumpy, especially in here when we had that long extended sideways period since the end of October. But generally, it does a really good job of picking the tops and the bottoms tactically. So we are currently negative here as of March the 6th. There's the indicators. It's what they look like. It's updated at the end of the day in our premium research service about 2 hours after the close. And you can see right now all 6 of them are red. How would it get to positive? 4 or more of them have to turn green. They would show up in this column here. Hopefully you can see my mouse move. But you can see these are the dates. So 2/27 and 3/5, we had 2 negative. And then in between, and then on 3/6, we had 5 negative, and then we went to 6 negative on 3/10, and they've been there ever since. So we've been on a negative bias, and the S&P has dropped about 5 or 6% since then. Let's look at a couple of them individually. The first thing that you need to do is know what your timeframes are. And again, we have our own models, we have our own business, we manage money, but I want you to hopefully take away some ideas where you can build your own. You have to know what your timeframes are. And I like to work with at least 2 timeframes. You're going to see we actually go out to 3, but you have to know what period that you want to capture in your trading or in your investing, whatever you want to call it. For ours, our strategic time period is 3 months or 63 business days. Our tactical is 21 business days or 1 business month. So we're looking to catch a 3-month or longer trade, and we're using a smaller increment to tell us when to get in and out of that longer period. So if you're looking at this and saying, okay, they use a 21-day moving average, that's the tactical time period. Know what yours is. It doesn't have to be what mine is, but maybe you're a day trader, and maybe you're 5 days for your strategic, and maybe 1 day for your tactical, or 1 day for your strategic and 1 hour for your tactical. But you need to be consistent with what your time frames are, otherwise you don't have anything. So this is VXX. VXX is an ETN that's kind of a derivative of the VIX that we use, but it measures volatility just like the VIX. So on February the 27th, it moved above its 21-day moving average, indicating increasing investor fear measured on a 21-day basis. So if we go back here to VXX, let's go forward. Okay, so this, so as long as this stays above the 21-day moving average, this particular component is going to be negative. And you can see since February 27th, S&P has dropped by 8%. That's one of those 6. Volume. We use cumulative volume. Again, there's usually multiple variations of many of these indicators. So we use cumulative volume. And cumulative volume is like on balance volume. But you could see on March the 6th, it dropped below its 21-day moving average, indicating a lack of urgency to buy on a monthly basis. That's since then the S&P has dropped 6%. market breadth. This is just a nicey AD line, simple AD line that I've been looking at for a lot of decades. On March 6th, it fell below its 21-day moving average. S&P has dropped 6% since then. How will this turn? Once these start incrementally turning positive, when the market's through going down, this will tell us. This keeps me from saying, oh, I think the market's lower because it's oversold. Who cares? It could be oversold longer than your bank account holds out. So we like these 6 models, or these 6 indicators that look at the market from 6 different angles. When 4 or more of them turn back to green, that's when we know it's time to buy. As I'm backing up here, like right here, April 24th of last year, market bottomed on April 7th. We got 4 or more green on April the 24th. That told us it was safe to go back into the water again. So let's move back to where we were. Now we're going to look at a correction protection model. Correction protection model is less active. It's meant to be a model rather than an indicator. The A6 is really an indicator for us because I can't tell anymore. Yes, what's going on during the day. The S&P's up 50, it's down 50. It's changed immensely since I first started doing this a long time ago. The CPM is different. We had customers, when I started business in 05, our customers were strictly other money managers, portfolio managers, big companies that you've heard of, that they knew of me through other firms that I worked at before launching Asbury in 05. And a lot of these money managers said, can you build a model that will give me the S&P 500, but with a lot less risk? There's a lot of buy and hold people out there. And once you get to be, I think, in your late 50s, mid to late 50s, game changes. It's like playing football. In the first half, you can throw a lot of downfield passes. You can do some trick plays behind the line of scrimmage. You got the whole game in front of you. You can make a couple of mistakes and you can take some shots. Once you get into the fourth quarter and you've got a lead, I'm a fourth quarter guy in my investment life, and I got a nice lead. I don't want to give that back. I don't want to do any crazy stuff. So this model basically gives the S&P 500. It stays right on top of the S&P 500. Right now, year to date, it's outperforming the S&P by 5.25%, but that's because the market moved. CPM moved to risk off, the market went down, and we avoided 5.25% of downside. So you can see these moves, you still got more arrows than I'd like up here, okay, but we went to risk off on March 3rd. We originally went risk on in November of 2024. Here's that April 24th low. You can see we caught the May 3rd low in 2024. Does a very, very good job of getting you the juice in the market, but playing the game with less risk. It's binary. It's either risk on or risk off. And it, on average, 5 round turns a year. Full disclosure, every penny of my own equity money that goes into the market, we're trading our own models. So we're eating our own cooking. And I've never made so much money in the market and slept so well at the same time. This is why I like the quantitative approach. When I was on the trading floor, I was a nervous wreck. I'm not anymore. I trust the numbers, and I don't make a lot of mistakes anymore because everything is quantitative. You make your best mistakes when the gun's to your head. When the market's very high or it's very low. You don't know how many people I talked to during the 08, the financial crisis, and who stayed in the market until they lost a third of their money, and then they got out right at the bottom or near the bottom, and then the market turned around and they were like a deer in the headlights and they didn't have the guts to get back in. So they lost twice. They got out at the bottom, blew a third of their retirement money in not that long time, and then they had the opportunity, they missed the opportunity of going back the other way. So this is why I'm kind of an evangelist for quantitatively back-tested models to keep me from doing dumb stuff at the worst possible times. 5 round turns a year. We don't take any short positions or any kind of options trading, futures trading. When it's risk on, it's in SPY, which is the ETF that tracks the S&P. When it's risk off, we are in BIL, which is an ETF that emulates the yield on a 1 to 3 month treasury bill. Again, annualized return identical to the S&P, significantly lower risk according to standard deviation, beta, and maximum drawdown. Maximum drawdown and CPM 20%, S&P 34%, about 40% less. CPM can also become an alpha generating model by using leverage. I do this for my own account. We're not going to get into it today, but trading a 2 times or a 3 times leverage, which I'm not advocating anybody that I don't know to do. I'm just telling you what I do because it's got a lower drawdown. I can use a little bit of leverage when I think the market's making a significant bottom, which we did back in April of last year, and tilt the odds in our favor just a little bit more. Why drawdowns are so important? I always like to use this one. If you draw down 30%, maximum drawdown, you got to make 43% back the other way to get back to where you were at the top, just the way the math works. So I use this 30 and 43% because COVID, it drew down 34%. So you probably had to make 48, 49, maybe 50% in order to come back from COVID. So as you get older, drawdowns matter, time matters. What if the market draws down 33% or 40% and you got to wait 4 years for it to get back to where you were? What if you're 70 or what if you're 65? Then it matters. So CPM yearly drawdowns versus the S&P. Started out in 2018, S&P drew down 19.8, CPM only 15.10. So 4% is 4%. It's not a world beater, but it's 4% less. Then you get to COVID. COVID was 33.9% drawdown for the S&P, only drew down 9% in CPM. 2022, little bit of difference, about 5% lower drawdown. S&P drew down 25.4, CPM 20.2. Last year was a big deal. Last year we drew down 18.9% between February and April 7th. We only drew down 9.3, a little bit less than half. So drawdowns matter. Drawdowns matter a lot. The market inherently goes up. It's been going up for 100 years. So what matters is trying to make your drawdown smaller. Here's how it's done here. This is fourth quarter of 2017. CPM in green, S&P is in blue. You can see it's kind of me and my shadow for the most part. Going back since inception, almost the same numbers, 11.96 for CPM, 11.8 for the S&P. You see the numbers are pretty similar. This year, we're doing well, but that's because the market dropped. The market's down. So the market's down 5.38. CPM is up 1.07. So it does well when the market does bad. When the market goes up, everybody's a genius. Everybody makes money. This is to make sure that you don't lose all your money or a significant piece of it when the market goes down. These are just more stats here. You can see our standard deviation is lower. Only a standard deviation of CPM of 4% this year compared to 8.5 in the S&P. Here's the maximum drawdown numbers. If you want a PDF of this, contact me. Go to asburyresearch.com, go to the contact tab, ask for a PDF of this because I know I'm going through this fast and I'm probably going to have to speed it up a little bit as I look at the clock. This is our SEAF model. SEAF is our sector rotation model. What we did is, well, I had an idea to create a algorithm that would measure the velocity of money as it moves around the 11 sector spiders, which together are the S&P 500. And then we looked at that algorithm in 3 different time periods. Trading, which is a week, tactical, which is a month, and strategic, which is a quarter. Then we came up with a scoring system. This number 2 here for energy means that last week, for the previous week, it was the second, the money was going in that sector second fastest of all of the 11. It went into financials a little bit faster. That's why it's a number 1. Over the past month, energy was number 1. The money over the past month, the fastest money going over the past month, fastest money in was in energy. Fastest money out was in industrials down here. Strategic, fastest money in was energy. Fastest money out was technology. You add these numbers together and it's like golf. The lowest number wins. So energy and utilities are 1 and 2. The materials is 3. The way we trade the model is we always invest in the top 3. Why? Because we back tested this thing, and the best performance is when you invest in the top 3. If you're a money manager, you're looking at that, or if you're an investor of any kind, you're looking at this bottom 3. This is telling you to stay out of industrials, communication services, and technology. Why? Because the money is leaving here to go here. It's quantitatively telling us where the money is going in multiple time frames. Here's a chart look back. Okay, so this is the daily CEF composite score for energy going back 1 whole year on the top. Now you can see why we call them rainbow charts. But favored is green and neutral is yellow and avoid is red. On January 13th, energy, it moved into favored status. Since then, this is relative performance of XLE down here versus SPY. Since then, it's outperformed the S&P by 44%. This is why our CEF model so far for the year, we're outperforming the S&P by 13.12%, largely because we got on top of energy very early, because that's where the money was going. Did I know there was going to be a war? Or did I know? I didn't know anything. I knew that's where the money is going. We want to be where the money is. We don't. If we're the first guy with a good idea, that's not a good place to be. I want to be the guy that's jumping on the train as it's pulling out of the station and not the first guy on the train. This helps us to follow the money. That's the name of our podcast, by the way, Follow the Money. This is real estate. This is one in the middle. It's in the neutral category here. 6th ranked sector with a ranking score of 18, which puts it, and here's the 18 right here, real estate, 18 ranking, it's yellow, it's neutral. And you can see it's been kind of yellow and neutral going all the way back to October. And it's been a relative performer versus the S&P down here. This told us we don't want to be here. Why? Because there's nothing happening. It's a neutral. We want to go where the money's going and not where it's just static, it's sitting there. Let's look at the other end of the spectrum. So this is XLC, communication services. It moved from neutral into a void status on March 20th. Since March 20th, it's underperformed the S&P by 3%. Why? Because the money is leaving there to go to other places. This is the essence of what we do. Are there other things that drive sector rotation? Sure. There's Truth Social, and there's interest rates, and a dozen other things. But one of the biggest ones, and the one that shows that investors have skin in the game, is the AUM. So we're watching the AUM here, and this is a void, and we're going to stay out of there. Note that when it went in August of last year, it moved into favored, and it stayed there until October 1st. Look what the performance did. It took off like a rocket. So we're watching the money. I'm not trying to rub my temples and try to tell you what's going to happen with the war or what earnings are going to be. It's a parlor game. Where the money is going is a business game. Here's how it's done. Middle of 2018, CEF in green, SPX in blue. You can see the gradual outperformance all the way through. Since inception, S&P up 11.85. Inception is middle of 2018. The model is up 20.52. Over the past years, 21.62 versus 10% for the S&P. This doesn't count any sort of a management fee, just FYI. 3 years, 25.4 for CEF, 17.7 for the S&P. Hell of a 3 years for the S&P. Year to date, our model's up 8.656. This is through the end of last week. S&P is down 5.3. That's why we follow the money. You don't get any extra bonus points for, knowing all of the fundamental reasons why this happened. The money went there. Somebody smarter than me knew to go there. I followed them. Here's some of, you can see standard deviation about the same as the S&P. Beta's a little less than the S&P. Sharp ratio of 108. That's a really good Sharp ratio going back almost 8 years. As an exercise, try to find an ETF that's held a Sharp ratio of over 1 going back 8 years. Good luck, and bring something to eat. I don't know that there is one. I wasn't able to find one. I'm sure there is one somewhere. Maximum drawdown's even smaller. So we're getting outperformance, and we're getting about 4 or 5% less maximum drawdown. This is our short report. And again, just hopefully putting some ideas in your head. We have a small shop, a small family shop. I don't have a team of 20 guys back there that I can have, go and run down stuff for me. So we take 6,600 ETFs every morning, and we sort them according to our own metrics, but sorting them according to trend, and we have our own criteria for trend and for relative performance and for money flows. If those broad asset classes are green all the way across, trend, relative performance, and money flows, then we know. Actually, this is a part of our Substack. We have a Substack that's $25 a month. It's a very stripped down version, doesn't have any of our models, but it has sort. And what sort tells us is that commodities, crude oil, and US dollar are the only 3 out of all these others, which include crypto and small cap, emerging markets, global equities, ex-US, interest rates, gold, US tech. These are the only 3 that are clicking on all 3 cylinders. So what does that mean if you're an individual investor? This is where you go for opportunities. This is when you pull down a list of commodity ETFs, or when you look at the various ETFs that you could buy for crude oil or crude oil futures if you're a futures trader. I was one for 17 years, or the dollar. This is where you've got wind at your back. The trend is in your favor. It's outperforming its peer or the S&P. And the money flows are good. There's money going into these things to drive them higher. That's our sort report. So again, stuff you can do. You've got to quantitatively figure out what you want to track and what your favorite indicators are, but you overlay those favorite indicators on whatever groups of ETFs or assets that you want, and you're swinging the club the same way. And this way I can go through 6,600 ETFs just like that, and I can pull out the places where there's opportunity. Let's just look at some technical analysis stuff. These are all MetaStock charts, older version that I use for presentations because I built a lot of templates. S&P 500 breaking the 200-day moving average is a big mental thing for a lot of traders. That's the benchmark that people use to determine the major trend. What's interesting to me here is you really don't have any support until we get down to 61.47. That's the old high that we made in February of 2025. That's 3%. We're down 21 right now. That's down 3% from where we are right now. So if you ask me, John, just on pure technical analysis, how far can this go? Obviously, I think for me, look at 61.47 and then see how the Asbury 6 or how your own indicators look then. But we don't have a whole lot of support between here and there. This is the weekly chart on the S&P going back to 2020. Note the pattern here. We peaked in 2020 in February. We came down. This was COVID. And we bottomed here in March 27th, I think it was. Then we raced up to new highs in January of 2022. Came right back down to that old high that we made in February 2020. This is just blocking and tackling. That was a good place to look for value. Then we ran up to the February 19th peak of last year, came down right where the January 2022 high was, 48.19. That was April 7th. That was another bottom. Now we went up and made new highs. Now 61.47 is that same level. So watch 61.47 as the market continues to weaken. Doesn't mean we have to go there, but that's the obvious place to look. This is the NASDAQ Composite Index. Broke the 200, broke its November low from last year. The next support level is the December 2024 benchmark high, which is 4.4% below the market at 20,205. That's the next big level to watch. This is the SOX index. I'm showing this chart because the SOX has been the only sign of one of the few signs of strength during this last month and a half or whatever it's been in the market going down. Note that it's been outperforming the S&P since May of last year. That outperformance is being tested right now. If the SOX starts underperforming the S&P on a 63-day basis, that's my strategic time frame that I talked about 10 minutes ago, 20 minutes ago. If this starts underperforming and we lose that outperformance from the SOX, the market is likely to get even weaker. So keep an eye on the SOX. If the SOX kind of loses its mojo, it's been kind of holding this from getting out of control. If we lose the SOX, this will speed up. Apple, second in market cap, linear correlation over 30 years with S&P and both NASDAQs. It broke down from this pattern on March the 5th. Targets have moved down to 225, which is another 11% underneath where we are. It's testing the 200 now. If we break through there, we could theoretically see another 11% move in Apple. Doesn't mean it has to go there, but that's what the read on the chart shows. Here's the MAG 7. MAG 7, it broke through its 200-day moving average, and it also broke through the high that it made on December of 2024. That's the equivalent high to those two supports that I showed you in the comp and in SPX. It's already broken through that. And look how it's just fallen apart here relative to the S&P 500. This was your muscle last year, and it's the weakest right now. So MAG 7 breaking major support's a big deal to me. Where should you be right now? Well, this is small cap. Small cap SPSM has been outperforming the 1500. Since December the 3rd, it's outperformed by 7%. This is where we went overweight small cap. It's outperformed by 7%. It's still going down here outright, but it's going there a lot slower. So relative performance to money managers is a big deal because they can't take all your money and stick it in a vault and go fishing until the market gets better. They need to invest. Small cap has been a place to be. Also, since November 13th, we also went overweight value. Value is outperformed by 5% right here. Since then, it's making fresh relative performance highs. So if you don't like to go all cash, small cap value is where the outperformance is. This is our individual stock picks, and we do that. So the one I'm the most interested in right now is IEZ. It's the iShares US Oil Equipment Services. We bought it on 320, and there it is. So we bought it on March the 20th. Buying meaning it went out as an Asbury alert to all of our subscribers. We've got a 7% lead in it. We're outperforming the S&P by 10%. Again, it's breaking out to new 10-year highs here. Previous high was a January 2016 peak of 2750. Assets are expanding on a monthly basis. It's AUM, and it's outperforming the S&P. Those are the three things. If we're getting all three of those, then I look for risk reward. The reason we do this is just shy of 3. This is just another component of our service. So we're looking at trend, asset flows, relative performance. If you take anything out of here, that's going to be worth your time today just to know those three things. 120 trades over 3 years, which is about 1 a week. Sharp ratio of 1.4. That's a crazy sharp ratio to be able to maintain for 3 years. Percentage of winning trades, 54% of them are winners. I heard Jake Bernstein was talking about that very thing and keeping track of that. Average winning trade is 5.5%, and you're in the trade for 20 days, 1 day short of a business month. Average losing trade is only 2.4%, and you're in that for 8 days or about a week and a half on the calendar. So our ratio of average winning trade to average losing trade is 2.3 to 1. Our winners are 2.3% larger than our losers, and 54% of them are winners. So these are the numbers. If you're building a system for yourself, these are the numbers. More winners than losers, and your winners are larger than your losers. That's the recipe to having a successful, repeatable process to trade the markets. Here's our model portfolios. I'm going to wrap it up here. So what we did is we took our models, we put them together, we picked out the ETFs that would perform the best under these circumstances, and this is just how they've done. Since the middle of 2018, AOR down here in purple, that's a ETF that emulates the 60-40 stock and bond portfolio. Everyone says, well, most advisors are going to put you into some equivalent of that, some iteration of that. The orange is the S&P 500 during that period. It does way better than AOR, but there's no risk control. There's risk control to a degree with the 60-40 portfolio because some of your money is in bonds. The green is our Asbury balanced model, which does have risk control. Its maximum drawdown, I think, was only 18. Look how much more it's outperformed the S&P. And then finally, our Asbury Aggressive in blue, that has less, also, I think the maximum drawdown there is 23% compared to 34. So what we're doing here, what we've been able to do quantitatively is have less risk than the market and outperform the market. It's hard to do. It's the white whale. I've been looking for that for 40 years, and we figured out how to do it with a lot of experience and a whole lot of math and a whole lot of time assembling this Billy Bean Oakland A's sort of an approach to investing. So we have investment research, fast commercial, 3 and 12 month online premium subscriptions, 1 and 12 month Substack, entry level for Substack, $25 a month. There's a free version of the Substack. So it's asburyresearch.substack.com. Sign up and you get a free Substack. Our money management, $250,000 minimum investment, 1% annual management fee up to $1 million, and then they get progressively lower from there as the AUM goes up. Custodian is Charles Schwab, feeding the lawyers here. The main thing is past performance doesn't equal future performance. And I'm saying this is because when I first started doing this, my eyes got this big, thinking, you know what? I've just, it's not a bank, it isn't a bond coupon. The markets change. We analyze our stuff every quarter, rip through it, and we have to make adjustments along the way. Do we do it often? No, maybe once every 2-3 years, we'll swap an indicator out and put another one in. But just because it worked in the past doesn't mean it's going to work in the future. But since nobody can see the future, despite what they may tell you on TV, this is the best that we've got. You can stress test your idea looking backwards, and then you can take it forward. So again, if you'd like a copy of this or you'd like to talk to us, this is how you get a hold of us. Jeff, I'm gonna give this back to you.
Right on. And, I've got all of the links put out onto the chat, so you can go ahead and click on those. And thank you very much. You did a really good job. Tell Jack we missed him.
I will. I'll see you soon. Thank you.
Right.
Thanks, everybody.
All right, let me go ahead and move over a little bit. I'm going to go ahead, turn my camera on. All right. Hey. Ooh, the screen. Okay, share. All right. Let me go back into the PowerPoint here. All right. Very good. Big thanks to John, to coming in and talking to us. Force of habit. Hope Jack is having a great break. I appreciated that great job again. Do want to remind you that we do have a Summit Action Pack that's available. It features all of the add-ons that are available today, the Market MRI, trading indicators, liquidity IQ. Daniel Sinnig talked about that at the very first of the day. The JBXC. Greg Capra is about to come and talk about the methods that he's been using for a number of years. That's going to be included, as well as Steve Primo's dynamic duo. 3 months of learned MetaStocks thrown in. Normally that's $8,082. Here at the event, it's $4,186. Comes with a money back guarantee as well, 30 days. So you can take advantage of that by giving us a call, 800-882-3040, or go to metastock.com/sales chat. We go ahead and go over here. As we go over to our next speaker, as we kind of migrate over there, I do want to say thank you to Stocks and Commodities Magazine for being really good sponsors of the MetaStock Traders Forum. They've been sponsoring us for 15 years now or something. Like, oh, wow. You can get a free issue if you haven't registered yet. Go to metastock.com/traders-summit, and you can register to win. If you just want to get a free trial to MetaStock, or I'm sorry, an extended trial to MetaStock where you buy a month and get the second or third month for free, you can do that at metastock.com/summit deal. While you're up there, you can take advantage of any of the offers that we've talked about internally here today. If you want, you can give us a call, 800-882-3040, and you can go to metastock.com/saleschat. Our very next guest is Greg Capra. Greg has been a friend of mine for a really, really long time. The methods that he created and have been using, he's been using for decades. He started trading back in the 1980s. He wanted to uncover what really drives price movements. And he undergoed a search and a study of candlestick patterns. So without further ado, let's get you started, Greg.
Awesome. I think, is my mic working? Should be.
I can hear you, yeah. Let me make you the presenter, and we'll make sure your actual screen works.
Okay. It's circling. There we go. All right. Screen. No, not that screen. Screen 2. Okay. All right.
Perfect.
So we have an hour.
Yep, you have about an hour. Do you want to have your camera on or off today? It's
I'm
off.
going to
right
leave it
now.
off. I'm going to leave it off.
Yeah. Oh, is it because you're in your jammies? I'm just curious.
All right. So, folks,
Okay.
am I ready?
Yeah, it's all yours, Greg. Let's go.
Okay. All right, folks. Like Jeff said, I started in the late 1980s, and MetaStock was, I wouldn't say it was the first, but I think it was the second platform that I began to use in my infancy to learn about the markets with a DOS-based program called The Technician. And it was the cutting edge at the time as a DOS-based program. But, and believe it or not, back at that time, candlesticks weren't even available. So, yeah, I've been doing this a real long time. And things have evolved tremendously since then, of course, to where you now have access to data at the tip of your fingers instantaneously, which for me took hours to download, type DOS commands, and transfer them from one folder to another. So yeah, it's been a long journey, as it says there. In the late 80s, I thought, how do you trade stocks or bonds, or what's the difference? How do you utilize all that? And through a trial and error type of process, actually, I met a fella through, if you've read the book Trading for a Living by Alexander Elder, he had a traders group at the time, and I used to drive down to his office, meeting with what I thought at the time were gods of the industry, specialists and market makers and hedge fund managers. And I expected to learn a tremendous amount from these people. And I didn't. The only thing I really learned was that they trade on order flow if they can get inside information. And technically, they were inept. So eventually, as I started my first business in the markets anyway, not first business ever, those people actually became customers, not the ones exactly that were in that particular group. But initially, yes, because the retail industry wasn't so involved as it is today. First customers were specialists and market makers, and I was just enjoying listening to these people talk, and just part of your education, and in these webinars, is to learn what others are utilizing to trade. And that's what I wanted to learn from them. And it was enlightening that what I learned was technically they really didn't know anything. And I think to some extent that's similar to today. So in 1994, the first service was a fax letter, thermal paper fax letters, and we had machines going out, multiple machines. I think there was 8 or 10 at the time sending faxes all night, because it was the explosion within the industry where retailing got involved, and the internet was in its infancy in 1994. It was becoming available to everyone at the time. And then there weren't any chat rooms, and we had an 800 hotline service, and we'd record things, and people would listen to the update. First chat room, you couldn't talk in the chat room. We had to type. Eventually, we had voice, and I had offices in different parts of the states, and traveled around the country and other countries, and did seminars. Today, everything happens over the internet, primarily. Master Trader used to be a brokerage firm. First brokerage firm for retail traders back at the time, and so the old company, I sold it, and the old recordings from the 90s, that company just wanted it so desperately. I was like, yeah, okay, whatever. Let me move on. And so you can see I used to do these trading challenges at different shows, and as I said, who I've educated over the time. So yeah, it stood the test of time: bull markets, bear markets, sideways markets. And you learn from all of them. And if you go to my website, you will see that there are probably a lot of names that you might recognize as my students. You can check that out if you choose to. So a little bit more about myself. This is the first Day Trader Expo in 1999. That's me in the middle. Over 25 years ago, the first company was the Pristine Day Trader. And as a Master Trader was a brokerage firm. And eventually, I eventually sold the brokerage firm, and I sold the Pristine name. It was great. Somebody paying you for a name, and some old PowerPoint presentations was great. Started Master Trader as it is today. And that was the booth back then in 1999. All the firms at the time that want you to sign a brokerage firm with them today was saying, stay away from that day trader stuff. You'll lose all your money. All they talk about today is day trading, opening up an account, and how they're going to show you some basic information. What I'm going to show you today is how to think. But it was at T3, right? Training, trading, and technology. So how do you learn how to think? Well, I'm not going to tell you it's about the latest, greatest indicator. It's about putting together what we have right here. And let's see if I can get a pointer working here. I'm not familiar with this platform. I can draw, I guess. Okay, there we go. All right. So through my journey that started in the late 1980s, the path is essentially the same as it is today. You get some platform that you can make charts. And from there, you see a gazillion indicators. There weren't a gazillion when I started out. And there's lots of different settings. And through a process of trying to figure that out, I gave up. And I came to the conclusion, price is king. Everything else is secondary. You can get rid of everything else, but we need prices. And I want to see them in a candlestick format. Why? Because it creates pictures. And those pictures give me a guidance as to what's happening. Then I came up with this concept, bar by bar analysis. And it became a really powerful thing. It didn't start out that way. It started out with, how do I control my emotions? Meaning each bar has a meaning. And if I was long and I'd see a red bar and I was like, from past experiences, oh, that was going to go down, right? That's going to go against me. I'm going to lose money. And it's like, well, sometimes there's this idea that red bars don't follow through. Well, why don't they follow through? Well, it comes to this multiple time frame concept, because a red bar in one time frame presents a buying setup in a smaller time frame, and people buy those buy setups, and at times red bars can be ignored, or they turn into bottoming tail bars, or whatever you call that in candlestick analysis. Now, as we put that all together, we look at trends. Nothing special, earth-shattering here? Yes, we look at trends. Are they going up, down, or sideways? Are they doing that in at least more than one time frame? How do we combine that? And support and resistance. Nothing new here. Basic stuff. Where's support? Where's resistance? We have to define those areas without looking at things like trend lines and Fibonacci's and Gann lines and Elliott waves and all the things that we think are predicting the future. No, it's the simplicity that frees your mind from the analysis paralysis. We're going to get to that. And relative strength and weakness. Pretty simple concept. Some people make special charts that compare one instrument to another. That's okay. But you know what? If I just look at one and it's going up and another one that's going down, well, I know the one going up was showing relative weakness. Sometimes one going up faster than another, and that one's showing relative strength. Or something is going down slower than something else, and it's showing relative strength. So a relative strength chart where you have two instruments that are falling, the relative strength chart could be going up, but because one is falling slower than the other, that doesn't mean I want to buy it. Now, volume and moving averages. We're going to look at some moving averages. Volume is secondary. I don't make a big deal about it. Why? Because I used to make a big deal about it. And then I found out after, listening to or reading at the time, again, there wasn't internet. I'd get Barron's on the weekend or get something mailed to me way back when, and I would read how, it's a secular bear market because it's not going up on volume. And I believe that at the time, because you're vulnerable to these kind of information. And it's like the market kept going up, but I remember them, hey, this is a secular bear market. Hey, it's already up 10, 15%. Where does that bear more? Is that bear market? And I realized markets can go up on relatively low volume. Eventually, the volume will pick up as more individuals recognize what's happening. And that's what we want to get to, is recognizing in a systematic, objective way what other people are doing. That's what charts are about. How do you do that? I'll explain. And then the broader markets, as it is right now, the broader markets are going down. They're in a correction. Certain things, more and more things are going down with it, except for oil, right? And a few very select things like fertilizers. But for the most part, the markets are in a corrective mode across the board. We all know why. That in-market internals and inter-market analysis. So what I also learned over the years was, while price is king, and we look at price patterns with the idea or belief that similar patterns result in similar outcomes, theoretically, I found out it's not always true. And, well, why is that? Well, sometimes what's happening in the broader markets, what's happening with market internals and intermarket analysis. I call that techno fundamentals, is looking what's happening and measuring what's happening in the broader markets with market internals when they've reached an extreme. Breadth and sentiment, intermarket analysis, what's outperforming, what's underperforming. And this is the big one. position and money management. Without this, you'll never make it. Never. I'm totally convinced of that, because you will blow up your account sooner or later if you don't understand the money management part. And you may say, Greg, that sounds ridiculous. Who would ever trade without a knowledge or plan of money management? Well, after doing this for 30 plus years, the majority will do it, including myself when I started out. You'll swing for the fence. You'll always be thinking about the money. Eventually you'll lose. You'll get scared. You'll draw back. You'll go back into it. But money management is the big thing to surviving, which is connected to trader psychology. And all of these concepts, they come together. And from there, in of themselves, we cannot trade any of these without putting them together and forming strategies, right? Trading plans. So all of these, they have subsections. Like within a course, we go into great detail as to utilizing bar by bar analysis, or defining trends and how trends changes and how we utilize that in multiple time frames and all of that, right? It's in depth, because it's like going to college, right? To think you're going to come into a webinar and you're going to buy some indicator that's going to tell you when to buy or sell, and you're going to make it with that, good luck. Sorry to be so direct, but it is what it is. So this is how I look at charts. I look at the charts the same way you do, of course, but I look at them and say to myself, what does that communicate to me about others' beliefs and expectations? And it's important, because they created those charts with money. They put their money to work. They put their money where their mouth is, and they created these price patterns. And as I recognize those patterns, it communicates to me what they did. That's the past. And it also communicates to me the present, as I can see. And I have to put those candles into groupings that tell me how traders have acted, what are their beliefs and expectations in the time frame that you're viewing at that moment. And this will continue to tell me what's happening in the moment. And so through that, I form a bias using multiple time frames that creates a belief, my belief, as to what's going to happen in the future. That's what we do. However you approach your charts, right? Whatever indicators you may choose to use or put trend lines on there, whatever you put on that, that is what's going to create your belief system as to what you believe is going to happen in the future. And I just for a moment, I'll bring you back to the money management part. As strong as your beliefs may be, there's no guarantee. You already know that. But you begin to believe that based on a certain combination of indicators and analysis, that this is going to work out. And that really just puts the odds in your favor. And that's great. That's the best we could do. Put the odds in my favor. Now, as we put it all together, you see, that's going to tell us where traders are going to act and how they are acting. Okay. All right. So on the left side, there's a little breakdown of what I just talked about, but I'm going to talk more about the candles. And so minor support, I'll just get a little quick definitions here. It's as prices are making higher highs and higher lows, minor support would be what was resistance becomes support. Again, nothing new there. Major support is the low prior to the higher high. So as prices move up and down, or making lower highs and lower lows, we just recognize these areas of minor and major support. And we're going to see that in multiple time frames. We'll look at the candlesticks, which I'm going to show you. We're going to simplify. And these narrow and wide range bars, especially the wide ones, or what I'd call range expansion bars, are really powerful. And we scan for those every day, looking for wide range bars, because they communicate to us something significant has happened. Right, versus narrow range bars, which are relatively insignificant, but everything is put in the context of, is it going up, down, or sideways in multiple time frames? So as we look at that, we continue to build our belief system, our bias, and eventually to place a trade. Now, as we look at these, right, what time frames are we going to utilize, and which ones should we have the discipline to stay away from? Now, this here, let me tell you something. This here is something, if you haven't done it, you'll do it. You've probably done it already. It's right. You in a great swing trade, and you're looking at a 5-minute chart, and you say, "I better get out of that swing trade. That 5 minutes got a big, nasty red bar in there," and you get out of it, and lo and behold, it's going up. This is not your friend if you're a swing trader. You're just getting into too many details, so you want to stay away from that. It's like looking at even worse. Go look at level 2. And you see that thing jumping up around, and you'll see a couple of red prints, and you'll get scared, and you'll give up the trade. And unless you're a super scalper, I mean, level 2 is not something that really is to your advantage, especially in today's day and age with algos. It's just too much noise there. So if your focus is day trading, 5-minute charts are great. I use them every day. But if you're a day trader, looking at a monthly time frame is a waste of your time. Right? Why do it? Because nothing that's happening on that monthly time frame is going to affect what's happening in the moment. So this is the big picture, so to speak, of what we're at, right? To just broaden it out. What's happening in the bigger time frame? So if we're swing traders or investors, we're going to utilize weekly charts, maybe monthly charts, especially as an investor, to see what the big picture is. And this light blue line depicts that. Meaning, I pressed the wrong button. Sorry, give me a second here. 2. Okay, that should be back. All right. So the blue line is to say that's my big picture, my macro bias. Is it going up, down, or sideways? And of course, what time frame are you looking at? And so as a swing trader, my weekly chart is in an uptrend. Right now, a whole lot of weekly charts have broken to downtrends. So you got to keep that in perspective. As we go to the daily time frame, we're going to expand the data by definition, going to lower time frames. And by expanding data, a grouping of 3 bars could look like this. Or they move back down, and you get these ebbs and flows, or they're going sideways, whatever they're doing. But as you go to a lower time frame, you expand the data, and as you go to higher time frames, you compress it. Same thing intraday. You got to pick what time frames you're going to utilize, especially intraday, because there's more of them to pick from. Now, in today's day and age, with the software technology being available what it is, you've got minute charts, you've got equi-volume charts, you've got tick charts, you've got all of these different kinds of charts, which leads to more and more choices. Eventually, you have to make some kind of a choice and stick with it. That's where your consistency is. So I use a 65-minute chart intraday for a higher time frame, and then I primarily trade it from the 5-minute. And if the 5-minute gets all erratic and overlapping bars and a lot of indecision, at that point, I'll go up to the 15-minute and compress the data. If I compress data, it takes away noise. Now, I don't have it listed here, but first thing in the morning with gap trades, and for futures, works on futures. I trade futures too. 2-minute chart. So I want to see more detail where it's super active and super liquid. These are choices. You could stay on the 5-minute, but first thing in the morning, I will share that with you that I will use a 2-minute chart. Now let's simplify candlesticks. I'm not interested in names. I'm just interested in, is it a big green bar? Is it a big red bar? Is it a narrow bar? Is it a topping tail bar, or is it a bottoming tail bar? And I know candlesticks have different names for these. It's irrelevant to me because this communicates to me what people are doing. If I see a big green bar and it comes out of a consolidation, like if I could take this and drag it over here, and it's a breakout. Now, is it a breakout in an uptrend, Does it have room to go up? I believe it can continue to go higher. Pretty simple. It's in a downtrend. I take this big red bar, I put it over here, it broke down. I believe it's going lower. Now, when we talk about bar by bar analysis, keeping us in the moment of what's happening, and the moment doesn't always mean you're going to act, but you're being objective. If a stock or a futures market or an ETF or a Forex contract was in a downtrend and it's going sideways and we believe it's going to continue to go down, which we should, and the next bar went down and broke the lows, let's drag this one over here. And it did that. It was like, uh-oh, that wasn't supposed to happen. The red bar turned into this. So that doesn't mean I'm going to close the trade, but I am objectively looking at something on a bar by bar basis that I'm not going to begin to rationalize something that isn't working out the way I thought it would. I believed it should. So my stop is going to be wherever it is. I'm not going to react to every single bar because it could just be noise. This bottoming tail bar over here, where it broke down and came back up, could easily be followed by this one or this one. But I want to continue to monitor something and put it in the context of that bigger picture. Again, where does it happen? So when I say that and you say, well, Greg, what if that big red bar turned into that? And lo and behold, I should have been paying attention, but all of this was happening in an area of major support. And so at that point, I've been thinking to myself, you know what, Greg, you were looking at too many things. You made a mistake. It's probably best to just kill that if it trades above those highs. So we're constantly being objective, staying in the moment, putting it in the context of the bigger picture, not looking at what my stochastic MACD combination ultimate indicator is going to do. And that's what you do as an indicator trader. You look at the indicators like, should I be getting out? When you see that kind of a bar and you start to get this little palpitations, right? Because you know the price action isn't confirming. So you need to rethink things. Oh, it's just noise. Or did I miss the fact that it's at an area of major support? This is how you begin to think, right? Not being told what to think by an indicator combination. You're thinking based on what's actually happening in the chart. So as we look at these candles, they can form in endless amount of ways. Right? It truly is endless. So we can't say exactly what's going to happen next, but I know what kind of candles typically follow the ones that exist in the moment if things are going the way I believe they would. So as I look at these and I see a wide range bar out of a consolidation, let's assume it's in an uptrend. What kind of bar would I like to see or should I like happen from this one? A consolidation by definition means it was resting. And if it was resting and now there's a wide range bar, that means it's off to the races and maybe it's another green bar up, or it's a narrow range bar, or maybe a bar like this where that would communicate, if I could drag this one over here, it would communicate buyers are stepping up on the dip, similar to down here. All right, so there's a wide bar, an inside bar, and here it dipped down and it came back up again. That confirms what happened here. So it's a continuous bar by bar analysis scenario of monitoring what's happening. Now, bad things sometimes happen, news related. You know, the president comes out and says something, and all of a sudden you got this great looking chart, and all of a sudden this big nasty red bar gaps under here. I was like, oh, what the hell happened there? So we're monitoring. If things are going well, we just manage. This pullback type of a pattern. This was a red bar before it became a bottoming tail bar. Communicates there was strong demand and they drove it back up. And then it consolidated. This type of a pattern in an uptrend at minor support communicates it should continue to go up. So we're continuously looking at these patterns that speak to us on a continuous basis. And as long as things are going well, all I need to do is manage the trade based on my method of at what time do I bring up my stop? At what point do I possibly sell half or everything? Position and money management. We need to build on that. So I said, well, what do all of these suggest? I've already told you. Right? So this is something you could start utilizing today, tomorrow. As we look at these, I'm primarily a trend trader. And you've all heard the trend is your friend. Why? Because if you got multiple time frames in an uptrend or in a downtrend, we're all working together in a sense, meaning if you have multiple time frames moving higher together, the majority are thinking buy. How do they buy? They buy breakouts, they buy pullbacks, they buy continuation patterns. Those are the three primary ways. Or they just, maybe somebody arbitrarily buys and says, you know what, I'm going to risk X amount of money. And that's, it's some kind of risk, but it's not great. So as it says, a higher probability of success. Right? Common sense. Right? It works. Momentum works in your favor. Right? More likely to continue moving in the direction of the trend than reversing suddenly, of course, unless there's news. People are trying to get on board in different time frames. They're looking for that pullback, that consolidation. They have a bias. They're finding a way to get on board. Easier trade management, multiple time frames, cleaner patterns. What does that mean, cleaner patterns? Well, there's attributes of patterns as they form, meaning when patterns, I should say, form in certain manners, meaning in a fluid manner. I'm going to say, what does that mean, Greg? Use that word. What does that word fluid mean? It means that as prices are moving up and the time frame that we're looking at, we decide, well, if we're on a daily time frame at 4 o'clock, it stops updating, right? So the market stopped it. If I'm using a 5-minute chart, every 5 minutes, the bar ends and a new one starts. But when there's fluidity, the next bar starts with the old one ended off and it continues in the direction of the trend and it stops and it continues and it keeps doing the same thing. Maybe it pulls back a little bit and it continues to go higher. So that's fluid versus when something is displaying uncertainty, it chops back and forth, overlapping bars. So these patterns, as I said earlier, communicate to us what other people are thinking. If they are uncertain, and it doesn't matter whether they have an army of analysts that they're paying to tell them what's going on in the market, if they don't know what's going on, it's going to form a pattern or a picture that communicates uncertainty by the masses. And when there is certainty, it's going to display other patterns. Right? Less emotional stress. To some degree, there's always some emotional stress, but utilizing our methods, we know what's happening. So we're not flying blindly. So we can gain confidence and clarity through our method. This comes with experience. Right? This is true no matter what the profession is. You learn how to do certain things, whatever it might be. You get educated, of course. Then you start to use it. You gain experience. You gain confidence in your ability that you've assimilated that education and you could utilize it. And it's a little more difficult in trading because market environments change, but that's why we use market internals and intermarket analysis. As it says there, you ride the wave, right, versus fighting it. So let's look at a few examples. Now, I'm going to refer to these as smart moving averages. They're not really smart. There's nothing proprietary about them. It's just a smarter way to utilize them. because it communicates to me what's happening in other time frames. So when I look at a daily chart, I put on a 20, I put on a 50, and a 200. The 20 is just going to follow prices more closely. And you'll have people that say, I use the 10 or an 8 or an exponential. It can only follow the prices. How tight do you want it to follow or not? Now, the 50, if you do this calculation here, it's equal to the 10 MA on the weekly. So we primarily, what we're looking for is stocks in uptrends where the 20 is rising. It's rising above the 50, and the 50 is rising at about the same angle, and it's got room to go up. That communicates by pullbacks. Now, the 200 is approximately equal to, very closely to the 10 MA on the monthly. So I look at this and I say, you know what? Multiple time frames in alignment. Odds are it's going to go up. Now, over here you can see it broke down, and then it begins to, I'd call this repairing the damage. At this point, I'm thinking, as this moves down, I didn't know it was going to do this. Can't tell the future. But the candles tell me what's happening. At this point, as this broke down, it gaps down. I'm thinking, oh, maybe it can fill the gap. Odds are it's going to come down to the 200. That's where traders are focused and institutions. I see that there's a prior low over here. So that would make sense that it's going to go down to the 200. And then it comes all the way back up again. So the candles tell me, Greg, they're not going down there. Get with the program. It's traded above this high. It's repairing the damage. Look to buy pullbacks. What was resistance should become support. Look at the candles bar by bar. And as it trades up, that's a buy setup. Now, on a 5-minute chart, we want to do the same. The idea is to look at one time frame and have a really good idea what's happening in multiple time frames. So, different calculations here on a 65-minute chart, calculating what the 20 MA is on that 65, roughly equal to this red bar, right? The 260 MA. And then a 60 MA is, doing the calculation, 13 bars times 20, you're going to get the 60-minute simple moving average equal to the 20 on the 15, and that's just a 20 MA. So what I'm looking for is an alignment where, same here, they're going up. Over here, they're going up, or prices are above. So over here, it dips down. It comes all the way back up again. This is a retracement concept, and it's not based on Fibonacci analysis. It's just based on, this went down. I know it's short-term extended. That in of itself suggests to me that it could go lower, but it's extended short-term. So we need to look at more of why this turned around. If we were to look at, over to the left here, is it on support? Even though the 5-minute is trending down, you see this was flat. So the higher time frame, the 65-minute, was not trending down. This came into support. That could be the reasoning why this, at this time, it came back up again. It was lunchtime. Traders come back, from lunch, and they start buying. But over here, you can see how the pattern is so much more evident as to what's happening. After this move up, they bought the dip, and it comes back up again. Now it's above all the moving averages. So you know what? We're all sometimes thinking, well, why couldn't I have bought it here? Well, you could with other types of trading strategies, but that's not what I'm after here today. I'm after the highest odds setups. That's when multiple time frames are in alignment. And so when I see something dip down like this after a run up into an area of support and it comes right back again, that tells me other traders are doing something that I'm not, but they came in and they bought that and they drove it right back up again. Now from here, I have so much more in alignment with me that this is part of the reasons why this can move like this. I'm not going to tell you that every pattern that looks like this is going to result in this kind of momentum move. But what I can tell you is that when you have multiple time frames in alignment and you have a pattern structure like this, where it's evident and crystal clear that buyers are taking control, is just a much higher probability that you're going to get this kind of a move. That's what we're after, higher probability scenarios. As I says, all traders are working together. What that means is you have more and more traders that are thinking similarly. Here, they're thinking down. Here, they're thinking maybe it's not going to keep going down. Now, you have to look at other time frames, but look, it starts coming all the way back up again. And this is one of the reasons why of course, you need stop losses, right? This comes right back up, and it's like, oh, you know what? Maybe it would have went sideways on another day. It would have went sideways and down again, similar to what happened today in the markets. Right? They started out higher, they went down, they went sideways, and they couldn't go up, so they went down. And they're continuing to go down as I speak. Reiterating, you don't have to trade every setup. What we're after is the highest probability setups. And over here, well, you could say, oh, Greg, you missed all of this. That's okay. I'm okay with that. Because this I wasn't so sure about. Over here, I'm confident based on what I've explained to you already. All right. So I'm going to show you a few more examples, and I'm going to show you a discussion that I had in the chat room today with the traders in our green room. Because when I had this discussion today, I said, you know what, I got to share this in this webinar today, because it was a great discussion about a stock that was asked about in the moment. So I like to share, these are old charts, but I'd like to share, something in the moment. I think it drives it home much better. So just to reinforce what I said, look, here's a daily chart. It's in an uptrend, right? Wide range bar up. It's choppy. It begins to rebuild. And over here, it begins to tighten up. The weekly chart is in an uptrend. Right? So by compressing data, weekly time frame, things are clear to me. It's going up. Over here, where it starts becoming erratic in these whippy bars, it's still a rising 20 and a rising 50. Right? The trend is favorable for it to move higher. So when I see a big red bar like that, I'm like, that's not really what I want to see. After I see a big up bar like that, I want to see something that's tighter. What does tight mean? That means the ranges contract. Right? They're not overlapping like this with big wide bars. So as certainty increases, ranges contract. And this being in an uptrend, and I got a rising 20 and a rising 50, odds are it's going to continue to move up because the prevailing trends in multiple time frames is up. We do the same thing intraday. 65-minute trend is up. Uh-oh, something happened there. It dipped down, damage control, and now it begins to tighten up again. So the 5-minute chart, all the moving averages were trending down. And now it begins to improve. It begins to tighten up. And you know what? It's just wash, repeat. This is your trading should become systematic in that way. Is that once you find things that work, just continue to do the same thing. The hard part is doing nothing until it sets up. It truly is the hardest thing. Because once you know what works and you see that the prices are moving and you're like, I could have done this or I could have done that. And you wind up, you know what you're going to do. You're going to press that button on something because you lose patience. All right, some more examples. So this is your 65-minute chart in this box here. So it had gapped up that day, and here's the gap up. Gap ups create areas where traders look to buy as they pull back into the gap fill. Ideally, it happens early in the morning. And like this would have came back down. You see the red bar right here? It's like, okay, if it breaks the lows, it'll come down into the gap fill. The trend is up. So I want to be a buyer there. I don't want to short this because the trend is up. And even though someone else is going to short it, that's not my money, so to speak. When it gets down here, I want to be a buyer. Well, it never got down there. It went higher and just leaves me in the middle of nowhere as far as this goes. And then it just gets choppy and grindy and all the way back down until it fills the gap here in the last part of the day. Right? Just before the end of the day, that's where the buyers showed up. I know they're going to show up there. It's just how the market works. And there's the bottoming tail bar where they showed up. It pushed it right back up again into the close. Well, it gaps up the next day. Let's apply simple stuff. Maybe it's going to fill the gap. So on my 5-minute chart, I've got the prior close and I've got the opening price. Same story here. If it pulls back into the gap fill, right, the unfilled gap, I'm going to be a buyer. Well, gapping trades don't always pull back there. So we mark off what was resistance, becomes support, and I see if there's a reaction there. Over here, right, this 2-bar reversal says it's coming down there. But bar by bar analysis, this bar took out the lows, which I know some traders are going to short it because that's just their strategy. You know, sell it short, look to buy it in the gap fill, short-term trade. It's a reasonable trade that traders do all the time. Well, this was an uptrend. I don't want to do that. I want to wait for it to get down here where the most traders are going to come together. And now this bar is a wide range bar, range expansion bar. It took out the lows. The ones that shorted, they got caught. What are they going to do? Imagine you shorted it. You're going to buy the cover. Now, I know in multiple time frames, buyers are looking to get long this stock. So I'm going to buy it above the highs. I'm going to put a stop down here, which means I'm going to share size it accordingly. And it should not go down below this bar based on that being a range expansion bar. It should do this, multiple time frame alignment, rising 20, rising 60, and rising 260. Is there any resistance to the left? There are unanswered questions on this slide, granted. But I want to get past giving you the majority of this information here to where you have information to utilize tomorrow. Right. Some more examples. And this is a trade setup that doesn't happen every day, but it's a great one if you're focused for intraday trading in the latter part of the day. So while we look for gaps on a daily basis as a starting point, at around 2 or 2:15, this setup often happens. Something that cannot go up, meaning it gapped down, it didn't fill the gap, and it goes sideways in the afternoon. And that tells me that, and look, if you apply bar by bar analysis, it tried to go up and topping tail bar right there. It tried to go up, resistance, and it came back down again. Now, that 20 and that 60 come together. They pinch together right around 2 o'clock. So this gives me a visual picture of recognizing multiple time frame alignment in a stock that could not go higher. It didn't fill the gap. Traders that were buying it here in anticipation of it going up there, they didn't get paid. So in the latter part of the day, they just get tired. And they say, you know what? This thing's a dog. It ain't going up. And so when it breaks the lows, they sell. I sell short. And ideally, it does something like this. But we're putting together a plan, a thought process, what I call a belief system, as to where can I place a trade based on my method? Where can I place a stop where it shouldn't go from there? And then trading it accordingly. Downtrend, right? Downtrends, odds are in my favor. Multiple time frame alignment. Different example, right? Giving you a lot of stuff here today. So price patterns create beliefs. I see a pattern like this that was under the moving averages, wide range bar up. It's like, hey, you know what? Maybe that's the start of the move. I'm not so sure. It's below the moving averages here. The 200 is flat, and the damn thing explodes higher. I don't have the reasons for that right here and now, but what I'm focused on here is to communicate to you what prices, the way they act, what traders are doing. This explosive move up tells me that institutions want it in. This is a daily chart badly. They didn't care about pullbacks. Now, this consolidation over time creates new support. Now, whatever you want to call this 3-bar reversal, a morning star, or who knows what, who cares? It looked like it was going to go down, where buyers would be lurking down here, and it flipped right back up again. That means buy. If you're a credit spread trader, it means you could do a put spread. You could buy, if it's liquid, a call option, or do a debit spread. There's different ways of trading an instrument, or you just buy it. Now, say this isn't great. And this is frustrating to us because we want something to continue to do what it was doing when it was great. But when it came up to this high, this red bar, it fell all the way back down again. So while this is at a rising 50 and stabilizing, the way this came down with this kind of momentum, similar to what happened in some charts, like if you went and look at gold recently, that had a big momentum move down off of the high. When they come down like this, with this kind of momentum, they rarely go all the way back up again without longer periods of consolidation. No, 3 days sideways, it creates an intraday base. If I'm a day trader, this is the kind of pattern that I would consider as a day trader, but not as a swing trader. All right, here's a sell setup. Just a breakdown, and it comes up to converging moving averages where there's price resistance, and this bar was your trigger bar right there. Wide range bar, breaks out, comes all the way back down, sell it short, stop loss up there, share size it accordingly, and manage. So here's the setup from today. Trader asked me today in the green room, Greg, and you can see the symbol, Moderna. First thing I tell him, I said, it's a biotech stock. You sure you want to trade biotech stock? The only thing he types in the room is he goes, looks lower. I'm like, okay. I said to him, what are you going to do with it? How are you going to trade it? I said, it's on a rising 50 MA. I don't know where it is right now. I could take a look, but point being, it's on a rising 50 MA. It's a widely followed moving average. It is in trouble short term. It broke out. It came back down. It's getting sold on rallies, topping tail, big down bar. I've got this color coded as far as just being a big down bar. And so at that point, what are you going to do with this? I said, I'm going to watch it. I said, watch it for what? What pattern does it have to form for you to do something? And I explained to him, you need a continuation pattern. If you wanted to put on a position, a very small one, and share size it up here so you'll watch it, you could do that. I said, but there's no pattern here for you to act on in the moment, but you have a bias that you believe it'll go down. So in this time frame, you're going to watch it to see if you get a continuation pattern where it could come lower down into this area here. So from a swing trading perspective, that's the two choices, period. Now, if you're a credit spread trader, if there was premium, you could do a call spread, of course, but we're talking directional trades here. So now what I tell him, I said, well, you're here in the room with us every day. If you want to look at this on an intraday time frame, and we go and look at the 65-minute chart, this is what the daily looks like. And it's sitting down on this support, and it's just holding here for the moment. So what are you going to do? I mean, if you choose to trade this on the 65-minute chart, what would have to happen here for you to place a trade that would be reasonable if certain bars were to form in this area. And so what I told him was like, I don't know what's going to happen. No one knows the future. Bar by bar analysis tells me what's happening in the moment. I see it's broken down. It's got a big rounding top. It's just it doesn't present me a pattern right now to act on. So what I said to him, I said, Thomas, if we could take these bars right over here, for example, and I could drag it over here, and you were to see this formation of bars over here, would you have a better idea that this stock has an inability to rally and is likely, if it breaks down below here, it'll continue to go down? It's like, yeah. So whatever it's going to form, if I continue to apply each bar, what it communicates to me as until it begins to form something that tells me it's time to act by, say, for example, shorting under these lows. If we were to take this bar and drag it over here, it would tell us, hey, that was a big green bar. Sellers came in over here and knocked it all the way back down. And then it tried to rally it and started to roll back over again. So 1, 2, 3, 4, 5, 6 bars over here, and it could not go up. That's created a larger area of potential resistance if it breaks down. So I now have a bias from a higher time frame. I've got bars in a lower time frame that give me an ability to place a trade and get on board with a pattern that is in alignment with my bias. So a little bit about money management. I get much deeper into this in the courses, of course, but this is a starting point. Share sizing, really basic stuff, right? So $100,000 account, $1,200. That's what I'm just giving you an example. This is what you'll risk for the day. Let's say you're going to do 4 trades. You're going to risk $300. And this is what we base our trades on that we recommend in our advisory letters, $300 risk. It's all managed in the tracking sheet that you have access to in the member portal. But it gives you the idea. 4 trades, right? $300 risk. And now, depending on what you're trading, you're going to share size accordingly based on your entry point and risk, take into some consideration slippage, of course, but you're share sizing based on your risk. You're not just saying, oh, here's XYZ or ABC, and I'm doing 1,000 shares, and where am I going to place my stop? I'm going to lose whatever. It's got to be systematic. Control those losses. So this is your trading plan. It gives you, what we just talked about, but the risk management and your discipline rules, that's the key to being successful at this. So I call this creating a belief system. That's how you get confidence based on this price structure that I explained in multiple time frames. I'm not adjusting my indicator for the market environment or this instrument. No, it's right on the price. Example of what I'm utilizing daily, weekly, 65.5, right? Same data, different perspective. I trade with the trend, master trader technical strategies. I didn't explain pivots. There's nothing proprietary based on what I do. Those red dots and green dots on your chart, I showed you on the chart, you have that in your platform already. It's just, you call it swings or pivots or fractals. You just set that to 3 and it shows you a bar with 3 lower highs to the left and right, or a bar with 3 higher lows to the left and right. It helps me with my decision making. Multiple time frames. Telling you again, discipline. You can't have discipline without money management. It's where you got to go. You got to have it. So 2 things that I'm going to offer today. Right? One is the bar by bar analysis course, which if you check out my blog, I did a write-up on candles and different types and stuff. You can go check that out. It's under Start Here at the website, but it's been on course for the last 2 weeks. Just type in mastertrader.com best course, And you can see that's the price when you get to the checkout. This is what it's on the page for every day. But when you get to the checkout, that's the price that you will see. The other thing, if you want to get further into the gap trading and the swing trading and so on, there's this offer, and that's the URL to it. But the full swing trading course, and all courses, you get 24/7 forever access, lifetime access. The gap trading course for trading, obviously gaps, as well as what I showed you at the end of day, that slide where the 20 and the 60 are coming together, the afternoon trades. Gap trades are great for scanning for swing trades as well as afternoon trades. And option trade, this is a short course. You get to learn about options. This, you get 3 months of the advisory swing and options trader, where I go deep into sector analysis and the broader market analysis, as well as the trades. Coaching comes with our courses, where we do monthly coaching, and scans you can get at no charge. So either of those offers are on the table today. They will be there tomorrow, but after that they are gone. So you can check that out, and you are certainly welcome to emailing me if you have questions. But these are full courses. These are many hours of education, where any of my courses, I go all in to explain everything. So the gap trading course is a standalone all by itself, and it sells day to day for the $9.97. The swing trading course all day, $9.97, and so on. So it's a huge discount, and the bar by bar one is a huge discount as well. So I hope you take advantage of that, become a member of Master Trader, and whether you are or you aren't, you're always welcome to email me if you have questions. Always happy to help. I am done. Surprisingly, no questions. I guess I just overwhelmed them.
Yeah, not a lot of questions came in. Donna says she's not heard the word DOS in a while.
She what?
Hasn't heard the word DOS in a long time.
Oh, yeah, that's showing my age.
Yeah, I think we all remember DOS, or I do at least. I haven't heard it for a while either. Greg, thank you very much.
Thank you for inviting me, Jeff. Thank you.
Let me go ahead and do this. And let me kind of just transition over to the PowerPoint again. One of the things that we did sit down with Greg is we sat down and we created all of his setups into MetaStock as well. So you've got his trend following setups and his gorilla setups, and there are a lot of them. So if we kind of come in here, I've got them broken down. These are the trend following ones, and you can kind of see the purpose. We don't have a lot of time to kind of go through this. You can kind of see there's quite a number of actual setups there for both trend, reversal, momentum, etc., etc., etc. Here's a listing of all of them. These all take advantage of MetaStock, the expert advisor, the commentary. When you get a trade, it's going to give you a clear entry. It's going to give you an initial stop loss. It's going to tell you exactly how to set up and manage your trades. And this is a bit of a newer master trader methodology, but it's pretty massive in terms of what's included. It's got 17 different explorations, 17 expert advisors, a trend indicator to help you identify if you're trading on the right side of the trend. There you go. As part of it, you can get access to the options trades membership area. That includes like an advisory letter, swing trading and options trading videos, all that kind of stuff included. And we sat down when we released this and we created a bootcamp class where Greg discussed the add-on, how to use it, the setups, how to implement them. And I did a best practices of MetaStock. That's included, it's available, it's already part of the downloads page as well. So 16 really good volume and price and volume based setups, great for swing trading and day trading, complete scanning, complete documentation. All of this is normally available for $19.97. As part of the Summit special, it's going to be at $9.97 today. We'll give you a 30-day money-back guarantee on it, free access to MetaStock, 2 months of the advisory service. You can do that if you go to metastock.com/mastertrader. If you have questions, you can give us a call, 800-882-3040. And you can also go to metastock.com/saleschat. So big thank you to Greg for joining us, for spending some time with us, for helping us implement those into the platform. And I want to make sure he was he had gotten out successfully, and he did. So there you go. This is not supposed to be here. All right, here we go. There's a few leftover slides from when I kind of put together the slideshow. As part of the package as well, you can get all of the add-ons that we're talking about today. That would be Jeffrey Scott's MRI, the Liquidity IQ by Daniel Sinnig, brand new indicator, the Master Trader Method, Jake Bernstein's JBXC Complete, as well as Steve Primo's Dynamic Duo. Normally, all of those indicators would cost about $8,000. They're all going to come with a money-back guarantee. They're going to be $4,000. If you don't have MetaStock, we'll give you a trial as part of it. And you can give us a call, 800-882-3040, metastock.com/saleschat. You can only take advantage of this particular offer by calling in or by chatting in, 800-882-3040 or metastock.com/saleschat. So as we move over to the next one, I want to encourage you to join the MetaStock, the Traders Forum community. At the Traders Forum, you can chat with other traders, can learn about the markets. We're always doing kind of lessons up there. It's designed to be a community of traders helping traders, and it's been amazing. We always have 20 to 30, 40 people chatting about kind of the positions, what their thoughts on the market are. There's all kinds of educational content that we do, classes. All that's available for free. You can join at thetradersforum.com. So there you go. All right. Also, any of the actual packages that we talk about today, any of the add-ons that we talk about, the extended trial, all of that you can get at metastock.com/summit deal. You can give us a call, 800-882-3040 if you have any questions about MetaStock, what it can do, why it's been rated the best software in its price category for like 33 years in a row, that kind of stuff. Get in touch with us, metastock.com/saleschat. So our next speaker, Steve Primo. Steve has been a partner in MetaStock for a number of years. He started his career trading at the Pacific Trading Academy. That might not be how he started it, but he's been using the same methodologies to trade for 50 years now, for decades and decades and decades. And you wouldn't be able to guess it based on looking at him and seeing who he is and that kind of stuff, but he's got a lot of experience in the market. And the methodologies that he's been using day in and day out have been time tested over and over and over again. Steve, let's go ahead and get you started.
Okay, thanks, Jeff.
All right, you bet. I can hear you already.
Yeah.
Let me make you the presenter.
Okay, just a second here. Let me just press. It says choose what I want to share. I want to share my PowerPoint presentation.
Okay. Up at the top, it'll say like tabs, and then on the other side, it'll say screens, and you can share a whole screen if it's easier for you.
Let's see here. Two tabs and screen. I just don't see the PowerPoint. Let me just.
Instead of maybe looking at applications, do screens. How many screens do you have?
I just have one. I just have a PowerPoint. Okay, there it is. I see what I mean. Okay, and then just share my screen.
It'll automatically kind of get rid of the, or it'll automatically.
Whoops.
Oh, show me. All right, now if you tab into your PowerPoint, this should work.
Okay, let me just see here. How's this?
Oh, perfect. I can see it.
Okay, great. We've got to figure it out.
Yeah.
Thanks, Jeff.
We got it one way or the other, right?
Okay. Thanks, Jeff, and thanks to everyone attending the Online Traders Summit. I appreciate it. Today, I want to talk to you about a great synergy for success, successful trades. In fact, I'm going to talk about two edges that when you combine them together will really increase your odds for consistency. This is what we call our dynamic duo of trading. For example, let me just share with you an example here. And this is a chart in Amgen just from last month or so. As we can see, the stock was headed higher coming into February. let's say you're long the stock, or maybe you're thinking about getting long, but maybe that guy on TV says, oh, it's gone up a little bit too quickly. Now we're in the overbought area. So maybe you want to hold off a bit. In fact, for the next 3 or 4 days, it looks like they're right? Well, what the dynamic duo does is actually pinpoints whether these are overbought situations or whether these are actually buying opportunities. Because the first edge in the dynamic duo actually would have generated a buy signal right here. And the second edge would have confirmed that buy signal. So when these two come together, you have this high probability for a winning trade. And as you can see, the stock in the next 3 or 4 days shot up 40 points. So this is what we're going to be talking about today. We call it our dynamic duo of trading. I'm going to introduce to you today, and you're going to see how simple it is to apply this to your own trading. So welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. If you're new to my webinars, we're all about educating you as traders. In fact, we are first and foremost an educational company. Our sole purpose is simply to educate traders around the world. I'm happy to say we have students in over 115 countries and in virtually every state in the United States. As Jeff said, I started trading nearly 5 decades ago. Next year, it'll be 50 years. I started my career on the floor of the Pacific Stock Exchange. I was on the trading floor for a total of 16 years, and 9 of those years I was a specialist. A specialist is someone who made markets in roughly about 50 or 60 stocks. So that's where we get the name specialist trading. Doesn't mean you're any more special than anyone else, but in the old days, if you wanted to buy or sell a stock, the floor trader would take your order and walk over to the trader who specialized in making a market in that particular stock. So I did that. I made markets during the crash of '87. I made markets in stocks like IBM and Waste Management. I traded through the bull market that followed in the 90s, and I left the floor in the mid 90s to manage money and also to trade my own account. About 15 years ago, I teamed up with Pro Trader Strategies, and we formulated Specialist Trading, where we had this one goal, and that was simply to educate traders around the world all the things I've accumulated in my nearly 5 decades that have high levels of consistency, and then teach them to traders. You see, that's what we feel is missing with most traders. It's not like they don't have enough capital or big enough account or not enough experience. It's that they just are not trading things that have high levels of consistency, and they're not making their own trading decisions. So the first thing you do is you basically piggyback off someone or something else, or maybe buy this system that spits out buy and sell orders. You have no idea what they're based off of. So what we do is teach you these things that have high levels of consistency, and then work with you so that ultimately you can make your own trading decisions. In my nearly 5 decades of trading, the only traders that are still around are the ones that make their own trading decisions. So that's our goal, that's our job, and that's the service we provide, truly educating you with these high probability tips, techniques, and methods. And you'll see that attention to educating you in today's class. Now, before we begin, we are required to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results by using the dynamic duo, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, if you'd like to get more education from us on a daily basis, just follow us on X, formerly known as Twitter. There's our handle right there. I would recommend copying that, writing that down, or typing it down. It's abbreviation for Specialist Trading, at SPC LST TRADG. Every day I post between 5 and 7 different snapshots of signals that our methods have generated, also little bits of financial wisdom. So there's lots of great free education on a daily basis. Just feel free to follow us on X. Now, I'd like to begin by sharing with you something that my mentors shared with me, because I've made no secret about this. When I first started trading on the floor, even though I had access to high-speed computers, and at the time, high-speed computers, it was nothing the way it is now. I had access to a lot of information that the public didn't have access to. I was following a lot of the so-called trading gurus. I was, privy to what the institutions wanted to do because they would give me orders in my book. And even with all that information, my first year or so, I struggled tremendously. Things just didn't seem to make ends meet. It just really wasn't working. Probably the same things you're being taught today as well. Now, here's what my mentors taught me. They said, Steve, trading is really simple. All a trader needs to do is simply this: want what the market wants. I mean, think of it. That's all your job is as a trader. to want what the market wants. If the market wants to go up, then you're a buyer. If the market wants to go down, you're a seller. Okay, it's that simple. But the trouble is, we're always taught the opposite. Oh, the market's going up, but it's up too high or too quickly. We got to sell it. We got to short it. Or the market's going down. It's gone down too much. It's oversold. We got to buy it. It's a very inexpensive prices here, right? But we're really out of sync with the market. I mean, think of it. You only lose money when you want the opposite of what the market wants. Let's say you're selling short. You bought some puts or some type of spread strategy with a downward bias. And the market goes up. The market wants to go up. Well, you're going to lose money. You're not in sync with the market. Or let's say you want to buy the market. You want to buy calls. You want to buy the actual stock or the future or the currency pair. And the market goes down. You're not wanting what the market wants. So you only lose money when you're out of sync with what the market wants. Now, I can probably guarantee that everyone goes into a trade thinking, well, I know what the market wants. I wouldn't buy this or I wouldn't sell this unless I knew what the market wants. And it's obvious with my system or with my indicator or with my trading method that it tells me what the market wants. Well, it's been estimated that 80 to 85% of all traders fail. So obviously, they have some faulty mechanism in their trading. For example, everyone thinks they know what the market wants. If we look at this trade, someone would say, oh, this is an older chart of Meta. Obviously, the market wants to go higher, so I'm going to be a buyer. Let's say at this point you decide to buy and you're doing okay for a week or so, and then this happens, right? Well, you didn't know what the market wanted. It was telling you it wanted to go down, but we couldn't figure that out. Or let's say this stock, this is an older chart of Tesla. Now the market obviously is going down. Let's say you're long, you say, I can't take this anymore. The market wants to go lower. It's plain to see, so you sell, and just when you get out, this happens, right? Remember, the market always knows what it wants to do. Our job is just to follow and jump on board, but it's not that simple because it's almost as if the market is speaking another language, right? It's almost as if it's speaking French and we only speak English. So we really want to be in sync, but what we need is a translator, okay? We need someone that translates what the market wants to do, because in order to be in sync, you need a tool that translates what the market wants to do on a tick-by-tick basis. Well, here's the good news. That's our first edge, and we call this the PET-D. Now, this is a tool I was first introduced to some years ago on the trading floor, almost 5 decades ago. And at the time, we called it the formula because it was a very complex formula that we only had hand calculators at the time, but we had to calculate almost on a tick-by-tick basis. And by the time you figured out what the calculation was for that bar, you had to move on to the calculations for the next bar. So there was no way you could use it intraday or for a small time frame. We could only use it on daily or weekly bars. But guess what? With the power of high-speed computers now and all the algorithms we have and computer programmers, here's what we've done. So let me give you some of the highlights of what the PET-D actually is. It's a proprietary algorithm. We're keeping the formula in-house, but we're doing you a favor because it's too complicated to figure out on your own. And so what we've done is we've made it a color bar tool. And all it does is simply color the bars either green or red. Now, once we have the color bar tool, it tells us the direction of the trend. In fact, in my nearly 5 decades of trading, this is the best trend directional tool I have used. Better than any type of moving average, better than any type of pattern. This is really the best thing. Now, it's not a predictive tool. In other words, it doesn't tell you how high something will go or how low something will go. It doesn't call the top or the bottom. It has a very uncanny ability to tell you when a trend is about to change, though. So what it does is it translates on a tick-by-tick basis what any market, doesn't matter if it's currency pairs, crypto, stocks, futures, makes no difference, but what any market, any time frame wants to do. So let's go back and look at these older charts. Here's that older chart of Meta, right? Now remember, we were thinking, well, the market wants to go higher, and then all of a sudden it changed and decided to go lower. Well, if we applied the PET-D, here we have a series of green bars that told us in advance we wanted to go higher. And then we had a series of red bars that told us in advance we wanted to go lower. Remember, it doesn't call the top or the bottom, but it tells you much quicker. It's much more sensitive than any other indicator I know what the direction of the trend is. Or if we look at that older chart of Tesla, obviously it wanted to go lower. Let's say you sold your stock, and just when you get out, it turns around and goes back up. But if we apply the PET-D, It told us well in advance, way up here with a series of red bars, red colored bars, that it wanted to go lower. And then once we had a series of green bars, it says, you know what, I've changed my mind. Now I want to go higher. That's how simple it is to apply. Now, remember, this is a translator, but the beauty of the PET-D is you can also use it and apply it as a standalone tool to trade with, to trade different techniques. So let's share with you some of these, because the beauty of the PET-D is that it tells you which direction you should be trading. Any market, any time frame. And once you know, you can apply any method, any technique, or any strategy. It doesn't have to be one of mine, could be one of yours or someone else's, that is in sync with that direction. Now, once again, the beauty of the PET-D also is that you can apply it as a standalone tool. So let me share with you just a couple of ways, because there are multiple ways to apply the PET-D. Let me share with you just a couple of different ways to apply it on its own. We call the first one consecutive same color PET-D bars, because it will signal a trend change. This is what we talked about earlier. All right, we're looking at a chart in ADI here. Stock is kind of going sideways. Then we have a nice little upward move, but is this a little bit overbought, or is it just a fake out, or is it a pullback and going to go lower? Well, if we apply the PET-D, we have consecutive green bars. That is a signal that the market wants to go higher, and look what happened. We shot up in the next month or so. Now, what confuses a lot of students is they say, well, Steve, what are these dark green bars? Well, these are days that the stock was down, obviously, or if you're looking at a 5-minute chart, when the 5-minute bar was down. But just because it's down doesn't mean that the bar has to be colored red. If the bar is down on the day and it's colored a dark green, that's telling you that even though we're still in an uptrend, this is just a down day. And that actually is a buying opportunity. It's almost like a pullback. You're buying when it's down, but the bar is still green. Think of the summer, all right? When you have a summer month, sure, most of the time it's 80, 90, 100 degrees, but every once in a while during the summer months in middle of July or so, you'll get a 50 or 60 degree day. Does that mean that summer is over? No, it just means that that's similar to a pullback or a down day in an overall uptrend. Because you know in the next week or so, you're going to be right back up to 90 or 100 degrees, right? Coming into August. It's the same way with down bars. You know that, right? As long as this bars stay green, we're going to be right back up and going higher. So all these down days were colored dark green because the PET-D was saying, even though it went lower, closed lower on the day, the trend is still up. I still want to go higher. This is how sensitive this tool is. Here's another example. We're looking at AXON, Exxon, all right? Now we're kind of headed higher and then we kind of slowly roll lower. Is this just a resting point? Are we going to be going higher again? If we apply the PET-D, we see now we have a series of red bars. It takes more than just one bar. We need a series of red bars. 3, 5 would be ideal, but all you need is 3 to tell you that the trend is now down. Until we get 3 green bars, this stock wants to go lower. And look what happened. You see what a great tool this is that you can apply on your own? That's just one of the techniques. Here's another one. We call this the lowest low green bar will signal an up move, or the highest high red bar signals a down move. So let me share with you what this means. Obviously, we have a downward move in charter. It's going lower and all the bars are red, okay? We're making new lows, new closing lows. All of a sudden, the very next bar is outlined green. This means that the PET-D may be changing its mind. Now, before we said we need 3 bars to tell us that it's going higher. But in this case, look at the low of the bar. Now, it doesn't have to be an opening or closing that low. It just means that somewhere interbar is the lowest low, the most recent short-term low. If you see that, that is a high probability that we've bottomed out, right off, based off that bar. That's all you need to know. And look what happened. The stock shot up in the following week, okay? Basically went from 190 all the way to 250, 60 points in a couple of weeks. Or how about this stock? Going straight up, right? The trend obviously is up, but look at the very next bar. It's colored red, and the high, even though it didn't close at the high in the most recent high was colored red. This wick was the highest of the last 5 or 10 bars. So that is telling you that most likely the trend is going to change. If you were long, get out, or if you wanted to get short, this is a high probability short, and look what happened. You see how powerful this tool is? Now we can use this tool just for telling us the trend and use it to trade within that trend. For example, here's a chart of ZS. We apply the PET-D and we see the colors oscillate between red and green. Now, as we were heading higher here, in a nice little short-term uptrend. Here's a red bar that is the highest of these last 5 or so bars. So that was telling us the market wants to go lower. And it did for about a week until we have the lowest low right here outlined green. So that was signaling that this short little downward move is over. And look what happened after that. We headed much higher until right here we have a bar that is the highest high of the last 5 or so bars, colored red. So this was telling us the trend most likely is over. And look what happened after that. Do you see how powerful this tool is? This is why I say this is a tremendous edge, and you can trade it just by itself using these tools. In the course, we share with you a number of different ways in which to apply it. But this is just the tip of the iceberg. We were talking about 2 edges, okay? Let's talk about the next edge in our dynamic duo, and that's what we call strategy number 4. This was one of the first strategies that my mentors, these were specialists themselves on the trading floor, taught me. And let me share with you a little bit of highlights of this particular method. It's a pattern recognition strategy. Doesn't rely on overbought, oversold, institutions, doesn't rely on moving average crossover. No, it relies on a pattern that we teach you in the course that repeats itself over and over and over again in any market and in any time frame. Now, it's designed for traders looking to catch quick momentum moves. And oftentimes you'll get signals where there is actually no momentum, where the stock is going sideways or the futures are going sideways, and all of a sudden you get a buy signal. You go, wow, how can there be momentum here? And then you'll see momentum after you've even gotten into the trade. So you're one step ahead of when the momentum comes in, because this pattern is a great way for identifying this even before it's identified on the chart. Now, when I first started trading this, I was on the trading floor and I was using this, getting in and out of trades in a matter of minutes, because that was our background on the floor. We'd trade something and sell it 30 seconds later. But we've developed ways, and you'll see this in the course, to exit days, weeks, even months later if you like, all right? And lastly, it only uses one indicator, okay? And I'll share with you what that is today. Even though you may not see it on the displays on the charts, it's just a 50-period moving average. And the way it works is you will only see buy signals if price is above the 50. So if price is above the 50, we're only looking for buy signals. We're not going to go against the overall trend. If price is below the 50, we're only looking for sell signals. It's that simple. Remember, as my mentors taught me, trading is really simple. We've just got to get out of our own way and listen to the market. So let me share with you some examples here. For example, someone looking at this chart here would say, well, it's GILD, doesn't really know what it wants to do. It's going up and then back down. I don't have any idea what this stock wants to do. But strategy 4, if you apply it, it actually generated a buy signal right here at the very bottom of that little sell-off. And look what happened to the stock after that. It took off. In fact, the very next day, it gapped up. This was just a month or so ago. And if you missed that one buy signal, it generated another one off of that pattern that we teach you. Here's another example. All right, this one is in Lulu. Stock's going sideways. Maybe you say, well, Steve, I'm an institutional trader and there's major support there, so I think I should be a buyer, right? Looks like it's going to hold. Well, according to strategy 4 and this pattern, it said, nope, there's actually a sell signal right here, right where you think there's support. And look what happened. Fell out of bed and it started to bounce. So you say, okay, well, I missed that shorting opportunity, but it's starting to go back up. I think I'm going to buy it. Well, nope, because strategy 4 says, no, we're still going lower. There's a sell signal again, and you had a second chance to get in before the stock really fell out of bed, okay? Now, I've been trading long enough to know that nothing works 100% of the time. I mean, I trade on a daily basis, just about, I intraday trade the E-mini futures. And there's not a day where I don't have a losing trade. There's nothing wrong with that. But you want to have more winners than losers, or you want to keep your losses smaller. For example, here's a strategy 4 trade in LIN. It's a sell signal. It looks perfect, right? It's been going up. A sell signal was generated, and then it just takes off. Or we can have this example here in VRSK, a buy signal is generated, and it goes, after a little while, goes straight down. So no trading method works 100% of the time. But there is a way to increase our odds for consistency when we apply these 2 edges. So we talked about strategy 4 right now. We talked about the PET D, all right? Now, when we combine these 2, that's what we call our dynamic duo, because we create the synergy for a really highly successful setup. There's a high probability for success when we combine these 2. All right, so these are the rules of the dynamic duo. I'm just going to share with you what the rules are. Now, in the course is extremely simple. We teach you different entry points, different exit stop placements. It's all in the course. It's very simple. And like my mentors taught me, remember, they said, Steve, keep things simple. Nothing is really, if you've been trading 30 minutes or 30 years, everyone gets the same rules and they're all very basic. As I said in the beginning of the presentation, our job as an educator is not to tell you, okay, you have to buy right here, you have to sell here, and you have to place your stop here. Our job is to provide you with these different variables, work with you, and have you study the course rules, and then contact us so you can put together some type of structure that makes you feel comfortable. So that's why this is not systematic. You learn the rules, you learn everything, you learn the different entries, different exits, different stop placements, and you formulate your own pattern for success. All right. This is not just a system where everyone gets into the same place, everyone gets out. Sure, we'll all see a same buy setup when all the rules come into play, but you have different options of where to enter. You have different options of where to exit. We have a number of traders who like to get in and out of a trade quickly. They don't want to hold their money long overnight. We also have other traders that say, no, I want to stay in as long as possible. So we have different ways to teach you how to do that. We also have different ways to place your stop. If you have a small account, you may want to have less risk. If you have a large account or don't mind taking on a lot of risk, well, then you use another stop placement. But this is all in the course. It's very simple. It's all guided step by step. And all you have to do is watch or read the course materials and watch the videos. And it's very simple. And we work with you. All right. So here are the basic dynamic duo rules. Okay. First one, if a strategy for buy signal is generated, you only want to trade the signal if the setup bar, that's the bar that's above the green arrow, if the setup bar is colored green by the PET D. That's it. In other words, you have a high probability signal bar using strategy 4, and the PET D is just confirming it, saying it's either green, or if you have a strategy 4 sell signal, you're only going to trade the signal if the setup bar is colored red. And that's the bar right below the down red arrow. It's that simple. See, trading is really simple, as I keep saying, as long as you get out of the way. It's usually traders that make things overcomplicated that really have more losses. And take this, I'm not trying to be arrogant or condescending, take it from someone who was there. My trading was extremely complicated when I first started trading. I had maybe about 20 indicators. I was following all the so-called trading gurus. We didn't have trading rooms or chat rooms at that time because there was no such thing as an internet, but we had subscriptions and newsletters. I subscribed to all of them. I was watching all the guys on TV say what they thought the market was going to do. And remember, for my first year, I struggled tremendously. It wasn't until I started listening to the market and stopped listening to that, what my mentors called noise, that my trading turned around. I simplified things and things started to become consistent. So that's the way we want to teach all of our students around the world. So let's go back and look at those older trades. Here's one in VRSK. Remember we had a buy signal that went sideways and then went lower? Well, if we applied the dynamic duo, we would have seen that above the buy signal, in order for us to take that trade, this bar has to be colored green or outline green. And what color is it? Excuse me, it's red. So this is not a valid signal. We would not take it, and we saved ourselves a huge loss. Oh, there we go. Or how about this one? Here was a sell signal, an LIN, okay? All right, so just taking it off this face value, it looks like a good sell signal, but we want to take our consistency up a notch, so we apply the PET D. In order for us to take this with a dynamic duo application, the bar below the red arrow also has to be colored red. And what color is it? Even though it closed down on the day, it's green. So this is not a valid dynamic duo setup. We will not take the trade, and we saved ourselves a huge loss. Now here's the good news. Since the market started going higher, strategy 4 doesn't stop. It continues to look for setups, and there were 2 more buy setups right here. They were both colored green. So it would have saved you. The dynamic duo kept you out of this faulty signal and got you into this positive one to the upside. And if you missed those, there was one more later on, just a couple of months ago. Okay, so now you know the basic way, oh, one more that we would have missed too. Now you know the basic way of how the dynamic duo works and the basic concept behind it. Let me share with you some recent signals, some a month or so ago, some just this past week. All right, let's look at DIOD, all right? looks like nothing was really happening coming into last month. In fact, it's kind of a sideways market, right? This is the kind of market you're always told, stay away from these markets because this is where you get whipsawed. You buy and it goes lower, you sell and it goes higher, right? But if we apply the PET-D, which is not based on conventional wisdom, it's based on a pattern and that algorithm, the PET-D. Well, we see here that strategy 4 generated a buy signal. And if we apply the PET-D, the bar above it is green. So this is a valid dynamic duo setup. And look what happened. The stock went up 22 points. And not only did it go up 22 points, 3 days after the signal, it gapped up based on some news or some event that happened, right? But how is it that we got long 3 or 4 days in advance? It's not like anyone called us up and from the company and told us to buy this. The market tells you just about everything you need to know. Remember, stop overcomplicating your trading by listening to outside sources and just learn to listen to the chart in front of you. It's all right there. Here's another example. This one is in iron, IRON. Once again, kind of a sideways market. Let's say you think there's institutional buying going on here. So you say, well, you've got to, that chat room I go to says the institutions are buying, so we've got to be buyers too, because that's the big money and they're never wrong, right? Well, what is the market telling you? What is this pattern telling you? Well, it's actually saying the opposite. It's saying that momentum is building up to the downside. And someone would say, well, how can you tell? It's just going sideways. This is the beauty of knowing and being able to identify this pattern, which once again, it's not a black box. We teach you what to look for. And if we want to take it up a notch and have a higher level of consistency, we apply the PET-D, and the bar should be colored or outlined red. And as we can see, it is colored red. So that is a valid dynamic duo sell signal. And look what happened. It fell 38 points in the next week. What happened to the institutional buying? What happened to the support? Remember, just learn to listen to the market. That's your only job. Now, that first chart we started the presentation with, Amgen. Okay, remember you were long or thinking about getting long and someone said this was overbought. Some guy on TV or in a webinar said this is overbought, you should sell it. And for the next couple of days, it looked good, but strategy 4 generated a buy signal here. And if we apply the PET-D, we see that it is outlined green. Now, a lot of our beginning students in the dynamic duo say, yeah, but Steve, the bar before it is red. Remember, it makes absolutely no difference. Sure, it'd be great if every bar was green, but it really doesn't matter. All that matters is that the bar above the arrow is green, and 40 points in the next 4 days. Here's an example in Dash, all right? In a little downtrend, but maybe we bottomed out here, okay? Maybe we hit some type of a bottom and we're starting to bounce up, but no, according to the pattern, strategy 4 says there is a sell signal. If we apply the PET-D, they're all colored red, both of these sell signals. So these are 2 valid dynamic duo sell signals, and the stock fell 50 points coming into last month, okay? Now here we have 2 signals, all right? This is where the dynamic duo really helps you because it'll keep you out of some trades and keep you in the good ones. Now, which one should we take? Well, if we apply the PET-D, we wouldn't have taken this one because the bar above the signal is outlined red. So that's not a valid setup. And look what happened. It went up for a little bit and then went down. Now, really, perhaps you wouldn't even have been stopped out, but at least you didn't have to sit through 3 or 4 downward days. This is where traders get scared and they say, gosh, maybe I should get out now because even though I haven't been stopped out, I don't like the way the market looks. That guy in that chat room doesn't like the market. And I just don't feel comfortable. I got a loss on my hand for the next week. But here, you wouldn't have had to experience that. You would not have been in the trade. But this one was valid, outlined green. So you would have taken this 48 points. And once again, another gap up. And it's funny how strategy 4, and along with the PET-D, knew that there was momentum change prior to that big gap up about a week later. Okay, here's another example on workday. A sell signal was generated just using strategy 4. And if we just traded strategy 4, most likely would have been stopped out, okay? But here's the beauty of the dynamic duo. In order for us to take this, this bar has to be colored or outlined red. So let's apply the PET-D. And look, it was green. So this is not a valid dynamic duo setup. We're not going to take it. And we simply wait. and this is a valid setup. We would have gone short on this setup. Whoops. And there we have it, 70 points to the downside. If you missed this setup towards the top, there was another one just a couple of months ago, and you could have potentially captured roughly about 40 points or so. Okay, now remember, as I stated earlier, nothing works 100% of the time. If anyone ever tells you that, take it from someone who's been trading for nearly 50 years, I would run, because nothing works 100% of the time. It's normal. It's like saying I have a basketball player that makes 100% of his shots. No basketball player does it. Michael Jordan missed shots. It's like saying there's an actor or an entertainer that every album, every movie is a blockbuster. No, every once in a while they'll have a dud or no one goes to see. It's just totally normal. It doesn't mean that they're faulty or that they shouldn't be in the business, okay? It's just that's the way life is. For example, we had a valid dynamic duo sell signal right here. It was strategy for sell and the bar was colored red. But look what happened. It quickly reversed and turned into a buy. Now, if you stopped and reversed, you would have taken a small loss in your hand, most likely about 3 points. But here's the beauty of it. We always tell our students, if you're going to be trading this correctly, you got to stay on the horse, because most likely, oftentimes you can recoup your loss on the very next setup. And had you switched from a sell to a buy, well, guess what? You had potentially 25 points you could have captured, made back that 3-point loss and then some. Now, in the course, we have 6 or 7 different exit levels that we can teach you how to trade and apply. We have 6 or 7 different stop placements as well. So remember, it's very simple, and you can experiment with each one of these and pick the one that makes you feel the most comfortable. Because as a mentor, our goal is to put the power in your hands so that you make your own trading decisions. Think if you wanted to learn how to, let's say, play golf, all right? So you hire a coach to teach you, and you're all excited because there's a tournament coming up with your friends, and you want to impress them by how well of a golfer you are. Well, when that tournament comes, you're not going to ask the trainer that taught you how to play golf to play for you. You're going to have to play and make your own decisions on the fairway and how you're going to actually play. It's the same way with trading. But for some reason, traders say, well, I'll let this guy decide, or I'll let this system decide. Just spit out the orders for me. You've got to be a part of the process. You've got to decide for yourself. The good news is that's our role. That's the service we provide. Now, here's another example. Let's look at this next chart in TTWO. All right, as you can see, we're going lower, and we have a buy signal right here. It's valid. It's outlined green above the buy signal. But look what happened. 3 days later, it switches to a sell. So had we taken this very first trade, we would have most likely lost about 5 points. That's okay, but here's what most traders do. They sulk, they get depressed, and they say, oh gosh, I had a loss here, so I'm not going to trade the next one. But oftentimes, not promising or guarantee, but oftentimes you're able to recoup on the very next setup. And here you had potentially a capture of 55 points, more than enough to make back that 5-point loss. Here was a sell signal into it, okay? We're going down, and then we had a little 3-day bounce, but all of the color of the bars were red. So this was the market telling you, the pet D, saying, even though we're bouncing, I still want to go lower. So don't get sucked into this, okay? It's almost like in the winter. Once again, go back to the seasonal conditions. Let's say the temperature right here is going lower and lower. It's at 50, 40, 30 degrees, and all of a sudden we have a couple of days where it goes back up to the 70s. Does that mean winter is over? No. This is actually just telling you that in the next week, we're probably going to be back to 30 or 40 degrees. The same process works here with stocks. In the next week or month, we fell 185 points. So this was a great dynamic duo sell setup. Now we've just looked at stocks or daily bars. Let's look at some different markets entirely, and let's look at some different time frames, because the beauty of the pet D is you can apply it to any market, any time frame. I know there's a lot of systems and trading techniques out there that only work on one market or one particular time frame. I've always said, if something is valid, you should be able to apply it to any market, any time frame. So let's look at our next example here. This one is in the British pound. All right. This was just, I believe, last month. The currency pair is going lower. We have a buy signal, and it's outlined green. On top of that, you can see we've been going lower. It's the lowest low of the last 5 or 10 bars. So this is telling us we want to go higher. 440 pips, okay, in the next week or so. That's over $4,000 per unit potentially you could have captured. Or how about looking at the Canadian dollar? This is a 4-hour chart of the Canadian dollar. Now we're going lower. It looks like we're bouncing. A lot of people could have said, hey, this is the bottom. Okay, this was a not confirmed low. Okay, so it looks like we've reversed, but we have a strategy 4 sell signal. The bar below it is red, and 340 pips coming in to the next week or so. Okay, this was a 4-hour time frame. And if you missed that first signal, 2 more signals were generated in the following days. Or we can look at an ETF. These are the gold shares, GLD, the ETF that represents gold. We all know what happened with gold coming into the year, but let's look at this weekly chart going all the way back 3 years to 2023. All right. A lot of people love to play the victim role as traders. They say, gosh, I miss gold, or I miss this stock, or I miss this future. I never get those big moves. Well, this can help because looking back in hindsight, we would have wanted to be a buyer somewhere around these levels, right? All you had to do is apply strategy 4 with a PET D, and as early as 2023, we were generating valid dynamic dual buy signals all the way up. Now, there was only one that wasn't valid, and that was right back here in 2023 because the bar above the signal was colored red, but that's okay. About 3 months later, you had valid buy signals all the way up. This is a weekly chart of gold. We can also apply this to a monthly chart of silver. This is SLV. This is the ETF that represents silver, okay? If you've been, kicking yourself for not buying silver, well, guess what? Going all the way back once again to 2023, when it looked like silver was doing absolutely nothing, going sideways, strategy 4 identified that momentum was building up to the upside. It was confirmed by the PET D. The PET D colored the bar green, and we all know what happened with silver coming into January and February of this year. Or if you're an intraday trader, okay, here's a 5-minute chart of Apple. And we have multiple buy signals generated. Nothing much happened until it finally kicked in. And remember, this is just a 5-minute chart. There's a quick 6 points you could have made in less than a day if you're an intraday trader. Or Tesla. Here's a 5-minute chart of Tesla. A couple of sell signals generated here. They're both colored red by the PET D, so valid sell signals. This was just last month. 10 points in 1 day. And if you missed those, here was another sell signal just be at the close of that day, and look what happened the very next day. Lastly, if you're an investor, it makes absolutely no difference. Here's MU Micron, okay, a monthly chart of Micron. Let's just go through the process to show you how simple it is, how easy it is to apply. There's no big class you have to take to learn how to do this. It's very simple. It's all in the course. Let's say you're looking at this and you say, well, okay, kind of doing nothing, just going sideways. So I think I'll avoid this stock because it's basically a directionless market, right? Well, see, this is why you may miss some really nice moves because you're just looking at worn, outdated, conventional wisdom. But if you listen to the market, if you learn this pattern, you would have known that even though it may look directionless, it generated a buy signal. And when you apply the PET D, it was green. Even though all of the bars prior to it were red, this was telling you it is confirmed that there is momentum to the upside, okay? This is going back to 2025 or so. And look what happened, 360 points coming into last month that you could have potentially captured. And I'm not saying you're going to make 360, but that's how much you had to work with, okay? Let's say you only took half of that, okay? Would you be happy with 180 points that you made? Or let's say you took half of that. Would you be happy with 90, 80, or 90 points? It's up to you. Remember, our job is to point out these high probability setups. Your job is to make your decision on how you want to trade them, where you want to enter, where you want to exit, where you want to place your stop. Do you want to get in and out quickly? Do you want to hold on for as long as possible? We teach you different ways in which to do that, and it's all in the course, and it's extremely simple. The dynamic duo gives you a higher level of trading consistency for virtually any market in any time frame. And you just saw numerous examples of that in action. So let's recap what we share with you today. Strategy number 4. That's a great strategy. I still trade it on a daily basis with E-mini futures. I trade this with the dynamic duo on intraday trading with E-mini futures. It's based off a pattern that repeats itself over and over. It's not a black box. We teach you exactly how to identify that pattern in the course. And then We also take it up a notch by applying the PET D. When strategy 4 generates a buy signal, if that bar is colored green by the PET D, that's a high probability setup. If strategy 4 generates a sell signal and that bar below it is colored or outlined red, that's a high probability sell setup. And these two edges combined together are what we call our dynamic duo of trading. Probably our most popular trading package we have at Specialist Trading and Pro Trader Strategies. So ask yourself, do you think the dynamic duo can help your trading for the remainder of 2026? We're already through the first quarter of the year. Now, I often say this, but everyone, virtually everyone, all traders say at the beginning of the year in January that this is the year that their trading turns around. This is the year that we make that extra income to maybe go on that dream vacation or to have that add on to the house or maybe just to have some extra supplemental income. And usually by the first quarter, you realize that you're not going to reach those goals that you were so excited about. You're never going to reach them because you've probably taken too many losses, or that $10,000, $15,000 product you bought just isn't performing and you don't have enough money left to really invest in anything else. Well, we have good news for you today. We have a great offer for all of you attending that want to become students of mine in the Dynamic Duo course. We're going to offer you our Dynamic Duo special. You'll get instant course access, detailed instruction. You'll learn all the entries, exits, and stops, really simple, the entire course rules, okay? You'll also get the PET D color bars along with the PET D ribbon. You'll learn about stop placement, also PET D pullback technique, all this information all there for you. Now, it's a great course, extremely simple. Now, I know a lot of people say, well, I guess I can figure this out on my own. I can see if there's a pattern. It looks like a bottoming or reversal pattern, and I can figure out just by looking at something if it's going to go higher or lower. Well, the Dynamic Duo regular price is close to $3,000. Here's what we're going to do for all of you people that are not convinced. We're going to slash that down to $1,995, okay? You're going to be able to save $1,000. This is a great offer, and I believe that they may even offer some payment plans. I'm not sure about that, but you may want to ask MetaStock and Pro Trader Strategies if you can't come up with the full $1,995. But this is a great discount. And if you're still not convinced, let me share with you just a couple of more charts, okay? Here's a chart in USO. This is the United States Oil Fund, all right? And we all know what's happened with oil lately. Now, once again, traders love to play the victim and say, gosh, you know, I missed that. How did I miss that big move? I just wasn't aware of that. I could have bought certain things. Well, if you were tracking oil, or if you were just scanning on a daily basis, you could have scanned for strategy 4 signals and Dynamic Duo. And you would have seen that going as far back as December, the Dynamic Duo was generating valid buy signals all the way up throughout February, and then we all know what happened with oil. In fact, I took this snapshot, I believe, Friday. I think it's even higher today. So, you know, this is just showing you in real time how this is working all the time, how you're getting valid signals and how the Dynamic Duo can take your trading up a notch. And the Dynamic Duo, at the same time, can keep you out of these bad trades. For example, one last example here in the diamonds, that's the ETF that represents the Dow Jones Industrial Average, all right? These are 4 strategy 4 signals. If we apply the Dynamic Duo, the PET D, we see here that they're all valid. Some are better than others, but they're all valid. And sure, if you had held on and placed proper money management, which we teach you in the course, very simple, you had a nice trade here. And then this happened. We had kind of a sell-off, but another buy signal was generated. But guess what? What color is the bar above this last buy signal? It's red. So that's not a valid signal. This was going back to February, mid-February, and you would have avoided this large loss that we've seen happen in the Dow, in the market, as represented by the DIA, the Dow Jones Industrial Average ETF. So not only will the Dynamic Duo get you in every so often into these nice trades, it will also keep you out of these bad ones as well. And that was a 4,000 point drop in the Dow, by the way. Take your trading to the next level with the Dynamic Duo. I trade it on a daily basis. I've been trading it now for nearly 5 decades. I really think it will help improve your trading, or at least make you a more consistent trader. Here's how to take advantage of this great offer. These two links here are the way you can buy it through MetaStock, or you can call directly. I would probably say call directly at area code 800-882-3040. Trading consultants will be happy to answer questions and to take your order over the phone. They can provide you with that great discount, which I believe is for a limited time only. But this is a great way to take your trading to the next level. And I'm going to leave this information up here. I believe we have just a couple more minutes left. If there are any questions, I'll take them. Jeff, I don't know if you want to read them to me, or we take them from here.
I can do that. I can read them for you. B wants to know. Actually, we do have a few questions. I'm going to start with Bridget's.
Okay.
Bridget wanted to know, how do you exit the trade?
The exits, I didn't want to get. The reason why I didn't want to go into exits is because then I would be giving everything away for free. You know, it would be like if you went into a restaurant and someone gave you a free appetizer, the owner of the restaurant, and then you said, well, can I have the meal for free too? Well, that wouldn't be fair to our students around the world who purchase it. The exits are all in the course. They're extremely simple. Like I said, we have upwards of 6 or 7 for people. Some people, like myself, like to get in and out of trades quickly. They don't want to be holding a trade that long. Others like to take a moderate exit. Others like to get as much bang for your buck. It's all explained in the course. Really simple, very basic.
B says, I don't understand why some buy-sell signals are not taken.
Well, the reason is because the PET D is so sensitive. It's telling you that even though the pattern is telling you that momentum is joining in, the PET D is so sensitive, it's not confirming it. So the PET D is acting as a confirmation tool. And that's when you combine it with the strategy 4, it's keeping you out. It's almost acting as a filter to keep you out of these trades. Because as I said, nothing works 100% of the time. And there's no way you're ever going to trade a method or a technique or a system that works 100% of the time. But what we can do is add a filter or a tool to confirm and keep you out of these. And that's what the PET D does. And that's why you wouldn't take all the setups.
P wants to know, if when you say the color above the bar, I think she means the PET D, does that mean the bar before the signal bar?
No, the signal bar is always the bar that is above the arrow or below the arrow, if it's a sell signal. So we're just looking at the bar that is above. If it's a buy arrow, you'll see a buy arrow. If it's above, or if it's below, it's a sell. And that's it. So it's the bar, the signal bar is where all the rules come into play, where the pattern has been met. And then you just want to see what color it is. And it really doesn't matter what the colors are before or after.
All right. B also wants to know if the PET D stands for the Primo Early Trend Detector.
Boy, that was a pretty great guess there. Exactly. That's what it does stand. Wow. We should go on a game show or something. That was psychic. Yeah, that's what it does sound. Because like I said, Jeff, when I learned this nearly 5 decades ago on the floor, I had to use a hand calculator. It was just so cumbersome. And there was no way I would ever want to teach it to anyone, because I said, there's no way you can use this, It's just too analytical and too complicated. So we were able to, make it into a color bar tool, and we just gave it the name, the Primo Early Trend Detector.
And B wants to know, do you have classes to trade together or webinars to use these? And there's tons of training that's included. I'm going to talk about that.
Yeah, I know you're going to talk about this. There's tons of trading videos and everything. And I just want to say, when I first started, I had no background in stocks. I always tell people I didn't come from, going to business school or have a degree in business. I didn't. In fact, I had a degree in music. So I had no background in stocks. I just walked onto the stock exchange as a summer job, and I was hooked. And at that time, they tried to explain everything to me, and it made no sense. I couldn't understand what an open order was. I couldn't understand what the buy-sell was, And so I told myself, if I ever get into a situation where I'm able to teach people, I'm going to make it as simple as possible. And everything is extremely simple, because it would be going against my own a background to make it complicated. We have, everything is really simple. And I teach my webinars really simply so people can understand everything.
All right. And just as a side note, it's metastock.com/PETD.
Right.
No, not PET-D, just PETD.
Oh, okay. Sorry. Yeah, sorry.
Yeah, no worries.
And
then, of course, you can call us too, 800-882-3040. I see one more question. Are the color of the bars the same as the candlesticks?
That's a good question. No, and this is, when I first started trading, candlesticks were, I learned candlesticks from a Japanese bank, the very traditional. This was in the 80s, and there was the West couldn't understand how to apply candlesticks. I know just about everyone uses them now, but in the beginning, no one understood them or how to apply them. They said, "What is this? Looks so different than an open, high, low, close bar," And so the way they made the West easier to understand is when it was an up day, they colored it green, and when it was a down day, they colored it red, and that's what made people understand candlesticks. But the way candlesticks traditionally were used was with a white background, and if you had an up day, you just had an open body, meaning that it was kind of a black, just a black line. And if you had a down day, it was colored a black bar. It was filled in black. So what the PET D does is it just fills in the bar what the PET D is saying. So if the PET D is saying it's going up, it just outlines it green. And even if the day closes down, it will not color it red. If the PET D is still saying it's going up, it will still color it green. It's that same metaphor I used before with in the middle of summer. Every once in a while during July or August, you'll get a day where it's in the 60s. It does not mean summer is over. It's going to go right back up to 80 or 90 degrees in the next week. Well, it's the same way if you see a couple of down days colored green, it doesn't mean that the trend is over. Actually, those are actually buying opportunities. Most likely it's going to go right back up.
All right. And then B had another question. She wanted to know if there's any moving averages on the chart. I did tell her that strategy 4 has a 50 SMA.
Right, exactly. Yeah, that's what I said earlier. I said it only has one indicator, and that's the 50-period moving average, which once again is in the course, but I'll explain it right now. It's so simple. If price is above the 50, it's our belief that the overall trend is up, so we'll only look for buy signals. If price is below the 50, the way we look at the market is that the overall trend is down, we'll only look for sell signals. It doesn't matter if we're looking at a 5-minute chart or a weekly chart. That's how we use the 50 period. And that's the only indicator we use other than the PET D.
All right. Lots of questions there, but we got through them all. Good job, Steve.
Thank you so much, Jeff. And like I said, it's all explained in the course. Excuse me, the course videos. And it's very simple, and you can watch it over and over again. And plus, everyone will get my personal email address. If they have any questions, you can always contact me.
All right, Steve. I want to say thank you for being here. I appreciate it. I'm going to just kind of talk a little bit about the MetaStock side of things. You did a great job. I appreciate it.
Thanks to everyone, and have a great day and a great summit conference. Bye-bye.
Will do. Bye. Okay. All right, cool. Try and put on my cheesiest skin here. So there's a picture of the box. Of course, this is going to include both the strategy number 4 and PET D. It's the dynamic duo combo. It's going to include your scanning, the expert advisor, the layouts, the training videos, and that's just strategy number 4. So these are 2 different unique systems, and Steve does a really good job about combining them and talking about both of them. Your strategy number 4 is kind of the original one. Here is a list of all of the training modules that are included as part of that. There's 12 courses, and in addition to that, as part of the PET D, which includes all of strategy number 4, you get the PET D, the Primo early trend detector, designed to give you the direction of the market, gives you confirmation. It also includes some of its own training as well. You can see you've got included PET D training, some video lessons that are included, 2 lessons on PET D, using PET D with strategy number 4, pullback trading techniques with the PET D. Both of these are included. So all in all, you get like 16 video lessons, all 4 indicators, the explorations, the expert advisors, the templates, everything that you need to go ahead and get started, including a boot camp that Steve and I put together. Steve and I sat down and did a boot camp. I can hear a live mic, just so you know. Steve and I sat down and did a boot camp where he talks about the masterclass, the using of the dynamic duo. I did a little bit of a class where we talked about tips and tricks, and all that's included. Normally, the add-on cost for this is $3,000 at the summit today. You get it for $19.95. We'll back it with a 30-day money-back guarantee. We'll also give you a free trial to MetaStock. So something Steve's been using for decades now. You can get metastock.com/PETD, 800-882-3040, or metastock.com/saleschat. And just to be clear, as part of that big package that includes everything. Pet D, the strategy number 4, that includes everything that we had talked about there. It's going to include all of the add-ons we've talked about, and that was the last one. So you get Jeffrey Scott's Market MRI, you get the new trading indicators, Liquidity, IQ, and MA Rush, you get the Master Trend Method, you get Steve Primo's Dynamic Duo, 3 months of Learn MetaStock. All of that would be normally $8,000, $4,186. Has a money back guarantee, so you can try everything out, see how you like it. Give us a call, 800-882-3040 or metastock.com/salespchat. As we move on to the last speaker, I want to thank again Stocks and Commodities Magazine for being a sponsor of the event today. We really appreciate all the work they've done over the decades of supporting the conferences and the shows that we do. If you haven't yet and you're watching on YouTube, come register for the event, metastock.com/Traders Summit. There you can sign up for not only a free month of Stocks and Commodities Magazine, but all of the speakers today have offered a free course or a free ebook or a free bonus offer just for subscribing to their email list. Metastock.com/Traders Summit. You can sign up for a bunch of free goodies that are very valuable. If you haven't yet, join the traders community at thetradersforum.com. We do a lot of really cool sessions up there. Metastock or thetradersforum.com. And I'm going to go ahead and move on. I know we're just about 4 minutes late. Not a big deal. I do want to get our last speaker going because she does a great job. Melissa Armo has been a friend of MetaStock. She's been participating in our conferences, I think, for 3 or 4, maybe 5 years now. Time flies. The older I get, the faster it seems to go. Melissa does a great job, though. She, a market gap is a really, really big sign that investor sentiment has shifted. Melissa's going to talk to us about market gaps. I certainly hope so, because that's what I just said she was going to talk about. Melissa, how are you doing?
I'm doing great. Let me see if I don't think I'm set up to share the camera. Or the, not the camera, the PowerPoint. I'm not set.
You should say, hey, do you want to share your screen? It should say that right now.
Screen 1.
I can see it. See, that was easy.
Perfect.
All right. Let's see, Melissa, I think I've introduced you. I can hear you. I can see your screen. I can get out of the way and let you take over now.
Okay, wonderful. Thanks for having me. Where would I see questions?
Let's see. I'm going to make you a organizer so that you can see them. And if you see the questions tab right at the upper right hand of the thing, there's a big thing there's a box with questions. They'll show up right there.
At the chat.
There's a chat, and that'll have a bunch of stuff that Greg is putting in there. Next to that, it'll say questions.
Oh, I got it.
All right, on. All right, I'm going to get out of the way. Your turn.
Thank you so much for having me. Welcome, everyone. Forgive me if it sounds like I'm losing my voice. I've been talking a lot in the last week. I teach classes. I run my own live trading room. I talk on TV, and I'm losing my voice because it's been such a crazy market. So you'll have to forgive me here if I sound a little hoarse. I'm going to have to take a couple of days off and rest my voice, but what a market. I've actually really can't remember the last time I saw this kind of market. And I was sort of comparing it for COVID, because I traded during COVID in 2020. But this is different. This is even different than COVID. And 2022 was also, the market had a downturn and was bearish for a while. This is different than that. And then even last year in March, February, March, we sold off. Remember, we had all the tariff stuff happen before the Liberation Day. We sold off, and then we had the big bounce. So that was the beginning of April 2025. But even this sell-off that we're seeing now, that's happening, that's been going on now for a few days, is actually even different from that. So it's a really good time to trade if you understand what to do. And as Jeff said, I focus on gaps. We're going to talk about that today. But specifically, I focus on trading on the side of institutional money. So as you can see from the market, institutional money is not buying the overall market right now. We're nowhere near the highs. Will it last? I don't know. You know, again, I'm an active trader. I'm a day trader. I trade and short in the morning or go long quick in the morning, and I do puts and calls on a weekly basis. So I'm a short-term trader. I'm not a long-term investor. But I will say that there could be a lot of opportunity in the market for people who want to go long at some point. Again, because the market is down so much. So we'll have to see. But today I'm going to talk about trading on the side of institutional money. This is me, like Jeff said. I've been trading now for 20 years. I've had a business for 15. If you're interested in more information, you can email me at melissa@thestockswoosh.com or call me at 929-3200-GAP. And again, I have a lot of social media. Probably the best place to follow me is YouTube, though. I appear on TV. I talk about the stock market. Of course, everyone's worried about the war. Everyone's worried about oil prices, high inflation, interest rates not going down or possibly going up, which no one could have expected for 2026 because of the high inflation, because of the oil prices. So it's really going to be a really wild year to trade. Again, when opportunity comes, you have to be willing to strike. And you have to know what direction to take the trades, and you also have to know what stocks to trade, which is obvious. One of the big trades we did in the last week, I don't think I have it in here, was Meta. Huge short, big sell-off. Mu was another one, totally collapsed today. So there's been really a lot of nice picks, you know, particularly to do. Again, with big moves and momentum. And what I do is I actually trade momentum. So it's spring here. I live in New York City, and it's spring, even though it's a little chilly spring, but Easter's in a couple of days, and it's actually a good time to trade. Why? Because earnings season starts in about 2 weeks. Earnings season happens 4 times a year. So there's 4 quarterly earnings seasons, and you get the biggest moves in stocks during earnings season. The last week, notwithstanding. Again, considering it's not earnings season right now, we've had quite a lot of big moves in stocks. But stocks report their earnings, and then they usually have a big move. They could move up, they could move down. I don't trade stocks usually into earnings. I will wait for the earnings to occur and then wait and see what type of move the stock makes. And so again, if you're an average, day trader and you have a normal account, you want to have a big move, whether you take small size or medium size or big size. You make more money when the stock moves big. So in earnings season, stocks have big moves. And that's one of the reasons why it's a very profitable time to trade. Again, you got to get the direction right. You got to get the move right. And also you have to have a good system. Again, this market, I think, has been great since the beginning of the year, but a lot of people are struggling in this market because it's so different from 2025. And it started changing really at the end of 2025. I think the market started changing again after that, the tariff liberation day, and we lifted. Market was very bullish from April up until about the fall of 2025. A lot of people were just buying every dip in the market and stocks, and it worked, but that stopped working towards the end of last year, and obviously that has not worked at all this year. You need a good system to get results, and you should have a good system that works under any market conditions, whether the market's bullish or bearish. The market could turn bearish this year. So if you do not know how to short, if you don't know what stocks to do or how to do trades to the downside, you're going to have a very difficult time this year if all you're wanting to do is go long. I started very early on in my career focusing on shorts because I made a lot of money shorting stocks, and I realized that stocks fall faster than they rally. So I really realized that I could create a niche for myself by shorting. And actually, you can short stocks in a bullish market or a bearish market. You obviously get larger moves in a bearish market. But it is hard to go long stocks or find anything to go long in a bearish market. So it's the opposite as far as shorts go. So again, very interesting times, but I developed my system for myself, and then I ended up teaching it to people after several years. And like I said, now I teach a class once a month, and I run a live trading room. So these are our results in the live trading room year to date. This is just through last Friday. $518,687, and most of these trades are shorts. Again, I have the losers and the winners, and we have had an amazing start to the year. Why? A lot of stocks have been moving. They've been moving big, and again, we've been shorting. And I think, again, going back to what I was saying about 2025, You know, a lot of people are struggling with the fact that this market has been falling because it's surprising. It's surprising because people were going long so much last year. So again, how do you earn money in the market? You have to know what to do. You have to have a good system. So that's step one. Learn a good system. This sounds very simplistic, but actually it's true. You're just watching the news or trying to trade the news or Trump's tweets or what's happening, you know, whatever the Federal Reserve is doing, you're struggling. You can't even go long necessarily good news or short bad news. You really have to know what to do in this type of market. So step one is learn a good system, period, end of story. You're going to struggle otherwise. And again, it should be a system that works in any market conditions. So hiring an expert to do a job is really the intelligent thing to do. It's just like when I go get my hair done. You know, I pay someone to cut my hair. I don't want to cut my own hair. We're getting into tax season. You hire an accountant unless you want to do your own taxes, but that can be a pain in the butt. Anything that you want to do, you hire an expert to do it. You pay them a fee. It's the same way when you come to someone, you want to learn a trading system, like people come and pay me for my class. They pay me for my time and my information and my knowledge and know-how. And I will tell you that I thought the market would turn way early this year. Like we have been in trades very, very early. We did a 625 SPY put, and the SPY isn't at 625 yet, weeks ago. The trade is up. You could have got out of it with profit. The trade's still up. I've been calling some ridiculous numbers, and the market's going to the numbers, even though they're very, very far away. So again, how am I able to see that? Because I'm good at reading momentum, because I'm good at reading the gap. We're going to go over what a gap is in a minute, but it's experience. It's experience because I've been trading now for almost 20 years. And not only that, I've been trading nothing but gaps for that long too. A lot of people, when they start trading, jump around from thing to thing to thing. I never did that because I really liked shorting and I really liked gaps, and I started making money. So even though initially when I started trading, I didn't know everything that I know right now, I had, you know, an intuition that there was something to this gap that if I could just figure it out, if I could just get it right, if I could just hone it down, that I'd be able to make money. And so I really never got off of it. And that's part of the reason for my success. Again, I just stayed on top of this same one thing, and then I've gotten really good at it. And so people that come to me and take the class and follow me are taking the trades that I call in the room or the trades on the options newsletter. But again, you need a system, and it has to produce results. It does not mean that every trade works. I have some trades that lose. Again, I showed you the stats earlier, the parentheses trades of the losers. You're going to have some trades that lose, but then you're going to have some big winners too. And when you get the big winners, again, if you shorted the market today, for example, it was a nice trade. Shorted the market Friday, we shorted the market Friday, big trade. That's how you cover the losses. You have some big winners, you got to have more winners and losers, and that's how you cover the losers. So getting back to what I was saying, time is money, and you've got to invest in yourself and learn. I just had the class for March. It was just this past weekend. And one of the guys that did the class has been trading with me. He was on the options newsletter. He never did the class before this past weekend. He was making money because I've been calling good trades, even though he was all over the place and really didn't know what he was doing. But he was familiar with trading options, so he was able to manage the trades himself. But it was an eye-opener for him doing the class. And he was really good. Glad he did it then, because he can move forward now and understand how I'm calling the trades and why I'm calling the trades. As human beings, we're curious. You may not think you want to know why something's happening, but you will trade a lot better and make better decisions, particularly with risk and money, if you understand why. You know, does that make sense? If you think it through and you say, I get this, and this is going to work because whatever the reason happens to be. So the reason that I take trades is because the stock is gapping. So gaps are a strategy or foundation for your trades in the market. When you choose to take a trade, there has to be a support system behind why you're taking the trade. Again, I'm not just shorting resistance or buying dips. Okay, I'm trading the gap. I'm going to go over what that is in a minute. But gaps are the support system or reason why you would enter a position. The reason you're choosing to enter stock or the foundation for your entry should be because the stock is a quality gap. So you need to have a foundation for every trade. Again, you just can't trade the news. And if you're trying to do that right now, you're in and out of position every 60 seconds. I mean, there's breaking news alerts all day long. You almost can't even keep up with it lately. I mean, that's how crazy it's been. And you also can't even believe them. Like sometimes I see a news alert and I'm like, okay, is that true or false? Like literally, that's the type of environment that we're in right now, depending on what channel you're watching, or if you're on social media, or where you're getting your news, what country it's coming from. You understand what I'm saying? But price action is different. If you're looking at the chart and you're seeing the price, you can feel confident in that. If the market's trading at blah, blah, blah number, you can see it exactly, and we can all pull up the same thing within seconds. You know what I mean? That's not like, well, I think that, this is going to happen, or I think Trump's going to end the war. I think this, or I think that. You're not guessing. You know for sure that the QQQs are trading at whatever number. You know what I'm saying? Or they're rallying or falling. Anyways, you need an infrastructure for every entry, and it's the strategy. The strategy is the core reason behind why you're even watching a stock in the first place, or even contemplating an entry or trade in it. An entry in a stock should not be taken unless the trade has a foundation supporting it. So fact, many stocks in any given day have no strategy to trade it at all as a day trade. And that is why in most days stocks do not have a proper entry. There's no strategy. So what do? Well, most stocks on any given day will go with the market direction. So guess what? The market power trended on Friday all the way down. And so most stocks fell because the market fell. Same thing today, actually. Not as much as Friday. Market fell further Friday. Market didn't really power trend today. Market power trended down on Friday. So if you can't read the market direction or predict the market direction accurately, it's going to be tough for you to trade unless you find something different, something specific, something that's doing something like a gap. So a stock gap in the opening price today is different from the closing price of the previous day's trading. A gap is a break in the price action from one day to the next. Simple. So while it could be the case that a stock could close at 58.02 at 4 o'clock today and open tomorrow morning at 9:30 at 58.02, I would call that a neutral gap. That's rare. But most stocks will gap. Stocks gap up, stocks gap down. Okay. So let's talk about an example of a gap. This is BA. Just going back here, stock closed here, gap down, fell. So this was going back to March 18. BA closed here at 4 o'clock and opened at a lower price at 9:30 on the 19th, and then it fell. So you could have shorted this here. Closed here, gap down. This was a short. Okay, so this is a gap. There's another gap over here. Closed here, gap down, fell. That is a bearish gap too. Now, this is a bullish gap. So there are bullish gaps as well. Closed here, gapped up, rallied. Closed here, gapped up, rallied here. So we're going back 13 and 16. Okay, so there are bullish gaps and bearish gaps. So I developed a system, again, over 3 years when I was trying to figure out how to trade. I wanted to find a system that had a high win ratio where I could point it down and say, I think this is going to work and has a lot of points that I want to risk my money instead of a 50-50 crapshoot, because I really didn't want to lose. Now, again, some trades I take lose anyways, because that's the nature of trading in the market. You're playing the odds. If you understand that, you will do a lot better with your trading, and you will also do better emotionally. People get upset when they lose. The odds are some trades are going to lose. So how do you win and move forward? You find a system that you can use that has more winners than losers, where you can put the odds in your favor. So that's what I do every day. I rate the gap using a 26-point professional bearish gap rating system. And if the gap rates 20 points or more, I will take the stock or the ETF of the market in the direction of the gap. If it rates under 20, I don't do it. So if I don't get any trades or don't get any gaps or don't get any high rated gaps, then I won't trade at all. Then I will do no trades that day, which you see in the stats where some days there were no trades. The purpose of the system is to help you evaluate which gap to trade each morning using the checklist. Because again, you can't just short every down gap or go long every down gap or vice versa. And that's how I ended up figuring out the whole system, because I wanted something that gave me high odds. I felt that, looking at one or two indicators or one or two things just wasn't enough. It just wasn't enough. It wasn't enough meat and potatoes for me to feel like I really wanted to risk my money. So I developed a whole checklist, a system. The system I use to find the right gap each day is called the Golden Gap Point Checklist. And this is what I teach in my class. Like I said, I just had a class this past weekend. It's part of the reason my voice is hoarse. I talked for 16 hours. But when I go through, I tally up the points. And if I get a high score, then I feel confident that I want to risk my money. And then I take the trade. Okay. And again, I still set my risk, and you have to use the same risk, or you should, per trade in every trade, same or equal. And this checklist is like my double, triple check on myself too. Because in today's environment, you can get very swayed, again, by the news or all kinds of things that are out there. This helps you stay grounded and focused, and you're focused on the gap and not necessarily saying, oh, well, this is going to happen because Trump tweeted, or whatever the case may be. If you're looking at the chart and you're going with the rating, then that gives you something to keep you grounded on making your trade decisions. Otherwise, like I said, you're back and forth looking at the news or tweets or whatever somebody's saying on television and not knowing what to do, or not knowing even whether to believe whatever the person is that's talking and saying things. You follow what I mean? So again, checklists work. You know, you have any type of career, somebody has a checklist. If someone's flying a plane, the pilot comes in, they go through a checklist. Someone goes in and they have surgery and they're going to go through surgery. They go through and they ask you all these questions and they go through the checklist. The 26-point Golden Gap rating system helps you pick which stock to trade each day. It pinpoints ahead of time which stock will have the move of the day with volatility to trade. Again, volatility is your friend if you know how to play it. You shouldn't be scared of volatility. If you are, chances are you don't know what you're doing. And so therefore you shouldn't be trading or risking money, because you'll have a high odds of losing if you don't know what you're doing. You follow me? So having a checklist keeps you organized and focused, and having a checklist forces you to look at what you should be looking at in the chart of stock to make the correct decision. Having a checklist helps assist you with directional bias, and having a checklist keeps you on track to reach your goals. A checklist is a plan of action. Everyone that puts money into the market should have a plan of action and a checklist. On a professional level, all high-income career field specialists have checklists, like I said. If you were, you know, I live in New York, there's so many airports around here. There's so much air traffic around here. There was an accident. Unfortunately, remember that accident 2 weeks ago was terrible. But again, people have to know what they're doing when they're flying planes. I mean, they go through the checklist. There's a lot going on, and you have to take it that seriously. You know what I'm saying? You're in charge. You're your own pilot when you're trading. You're directing the course of your money. So gaps are a specialized strategy. If you want to make money in the market, you need to think and act like a true professional. This is true even if you're only trading part-time. So even if you only trade a half an hour a day, you still have to take it very, very seriously within that period of time you're doing it. Like this is your job. You have to take it seriously. And again, it should be something where you're totally focused in that trade in that moment when you're in it. Professionals have specialized strategy systems or reasons for taking trades. I am looking for institutional money when I take the trade, and I want to trade with it, and I want to get a big move. That's the whole point of what I'm doing. Now, this is going back, looking at the cues from last week. Okay, so let's go back here. This is the 25th, so this is the QQQs. The market closed here on the 25th. That was Wednesday. Gap down on Thursday, fell. Closed here, gap down on Friday, fell. So again, this is momentum. That's a big move for the market. So what happened here? I'm looking for institutional money. Well, again, you could say, well, why did they do it? They did it because of inflation. They did it because of the war. They did it because of ground troops, whatever. You can say any reason you want why institutional money dumped the market last week, but they did. So they did not buy it, or we wouldn't have had this type of move, again, within 2 days. So I'm looking at that gap before this even happens. This didn't even happen. And I'm saying, do I want to short the market here? And I'm saying that. And then if I get a good rating, then I'm in. And it did work, and we fell. Okay. So again, institutional money dumped it. Boom. Dumped stocks. Now, I also go long. Okay. We've been going long oil. Again, what happened here, this had to move up. Okay. So again, this is a bullish gap scenario where you have a 4 o'clock close, CBX, which is Chevron, gapped up here, rallied, almost went up to 210. This was back the 24th. Then it closed here, then it gapped up, then it rallied up here. This was the 27th, Friday, hit it for 212. Today, we continued further again before we came down into the morning, but we were up this morning initially in this too. So again, what's happening with Chevron? Chevron is getting bought with institutional money. We've had bullish gaps, and we've done calls on this, or you could have just gone long as a day trade. We've just gone long as a day trade Friday in CBX. So again, institutional money is buying Chevron. So why are gaps so profitable? Because of large institutional money and momentum. Gaps are created with large institutional money. That is what makes the gap. The professional gaps that happen and play out in stocks are formed by one thing and one thing only, large institutional money. Therefore, you need a way that will help you pick the correct direction to play the gap and then confirm that the large money will flow with it. By having a formula to rate and qualify the gap, you get confirmation. And that's what gives me conviction that the large institutional money is on my side, and then I play it. And then whether you do it as an option or a day trade or swing trade, however you want to take your cash and do it. But gaps are an event, a serious event, and create a sense of urgency. But guess what? Not every gap is important. And that's how I ended up creating the point system. Do you follow me? It just so happens we have had some very important gaps recently. Okay. Thus, an action is being forced by participants of the stock. This is why gap trading is incredibly powerful. Trading gaps is a powerful and profitable way to trade because you're trading the side of the power of money, which is what? Momentum. Momentum. So the whole philosophy behind my trading system is I'm looking at a daily chart. That's where I'm getting the points. And I'm analyzing a large time frame to make the trend decision on the directional bias for the gap. And actually, all large traders of every kind look at large time frames to make decisions, particularly institutional traders. And then I'm looking at entries on a 1 minute chart in a smaller time frame. That's how I'm doing the day trades. This gives me a high degree of focus and accuracy because I'm still getting in a trade and putting a stop in. It's a limit order stop. If the trade hits through it, then I'm stopped out and I lose. Okay, I can't just take a trade with unlimited risk. I put stops in. Okay, so using the daily chart to make a decision with the stock pick allows accuracy in the direction, and then using the 1 minute chart allows for good risk reward trades with accuracy, which is what I do. So I developed a system, like I said, but I focus mostly on shorting because I feel like that gives me a niche because many retail traders actually go long. I also feel like it gives me an edge because of the fact that I can short in any market condition. And then when you get markets like this, you really can make it work to your advantage. Where a lot of people are struggling and wanting to buy every dip and not knowing what to do and are afraid to short because the market's down for 17 days or whatever it's down. You know what I mean? If you don't understand what's happening, you're going to lose. And a lot of people don't right now, to be honest with you. But the purpose of the system is to help you evaluate which gap to trade each morning. And since there are so many stocks each day that gap, and not everyone is good, using a system is significant to your success. So it's a checklist. You come and you take my class, you're going to learn the checklist. That's what was the whole past weekend I just did. You go through it, boom, boom, boom. And then it helps you get the confidence and conviction to risk your own money because that's the only way you're going to make money. You have to risk your own money to actually make money in the market. Again, it seems like, well, I'll just watch, but then you're not going to get the move. You know what I'm saying? What else was I going to say? When you have conviction in a trading strategy, you can produce positive results. Okay. When you do not have conviction in a trading strategy, do not expect positive results. So again, you want to be able to look at something and say, okay, this has a high odds. There is no 100%. There just isn't. Any questions about that? Okay, so step one is learn a good system. Step two, master that system with the help of a mentor. So again, I call the trades live in the room, And again, they set up fast. So you need to know what you're doing, which is why the class is a prerequisite to join the room. So I call the trades of the room. Like I said, Friday we called the market. You can go to my YouTube. I have videos of the room on, I think I have Friday's room on YouTube. And you can listen to me short the market on Friday. So again, I do day trades where I'm shorting on margin, where I have a margin account. Okay, now if you don't want to do that, you can do options. So you can buy a put. You can buy actually daily puts in the market. And now they have Monday, Wednesday, Friday for a lot of big name stocks. This is something new recent. They have 3 expiration dates a week, which is something brand new. They didn't used to have that. And that's another way that people can trade stocks. When you're a put is a short, and you don't have to have a margin account. So that's something that's really new, again, to open up, the ability for people to be able to trade, whether it's the retirement account or if somebody just doesn't have a margin account. And again, you can open up an options account with as little as $2,000, okay? But step 2 to become successful is to master a system with the help of a mentor. Again, it helps you if you have someone calling the trades or saying, this looks good to this target or that target or whatever the case may be. Like we did the CBX and I said, I think this is going to get to 210. And if people listen to me, it obviously got to 210. It got above 210. Okay. Anyways, anything that you could put the odds in your favor to trade will give you an edge. The 26-point golden gap rating system gives you an edge. It reads the price of the gap and using technical analysis at an advanced level pinpoints which stock to trade that day and in what direction. Because you can't short every bearish gap. And you can't go long every bearish gap, and you can't go long every bullish gap, and you can't short every bullish gap. You know what I'm saying? If it was that easy, then nobody would ever lose. So I'm looking for high probability when I'm figuring out, and I do all of this before I even start to trade. This is all in the morning, okay? And I usually do one thing at a time. But having high probability is the ticket. Again, because otherwise you're relying on the market and you're relying on the market's direction and getting the market right. And then you only really will get a trade to go right, even if the market's power trending in that direction, like I said. And we have had days where that has happened recently, okay? So anyways, 26 points is an enormous amount of detail, but that's what it is. If I could come out with 126 points, I would if I could never lose. It doesn't really take that long though. It takes maybe 5 to 10 minutes to rate a gap if you're new, and it takes less than 5 minutes if you become experienced with the system. So the whole purpose is to find stocks to trade that have number one, a high probability of directional bias, hopefully for the whole day. Again, Mu is a good example because Mu, if you want to pull up Mu fell all day. Big moves on the day. Again, Mu is a good example of that today. Early confirmation of my bias on the move and precise entries with follow through. And again, I'm doing it on the 1 minute chart. Again, we're just in an environment here right now that you have to take, heed of what you're doing because we're not in the same type of environment as 2025, okay? So 2025, like I said, was very bullish. Market was making 1 million brand new all-time highs, and people were buying dips, and a lot of stocks were strong, and many stocks were making brand new all-time highs too, But again, things have changed. Now, I said that earnings season starts in 2 weeks. So earnings season means stocks could change. So some stocks could turn around. Some stocks could look worse. Again, 2 weeks is a long, long time for where we're at right now as far as where the market's at because things could change in a dime. So we have Easter week this week, markets close Friday, and then we have another week, and then earnings season is after that week. So it's 2 weeks from now. So anyways, getting back to what I was saying about March. March was a really good month. So stats for March for the room were 207,440 for the room trades, which is huge. So again, it was a fantastic, fantastic month to short. And we captured pretty much every big bearish move that we possibly could. So again, how did I find those trades in March? Using my gap system. Again, what is a gap? A stock gap from the opening price today is different from the closing price of the previous day's trading. A gap is a break in the price action from one day to the next. Simple. So again, the market closed today, and tomorrow will open at a different price. Who knows where? Again, it's a long way away. The futures, if you trade the futures, have been absolutely crazy, where the futures could be up a lot. Then they could drop, or vice versa. Futures could be down a lot, and then could flip and go totally up. Again, this is the type of environment that we've been in right now where things have just been absolutely crazy, okay? Any questions about anything I'm talking about right now? Anyways, you've got to find a big move. because then when you have 100 shares or 1,000 shares, you'll get paid. Again, it's the idea of having a good risk to reward. And I'm looking for early confirmation of my bias in the move between 9:30 and 10, and precise entries with follow through and a good risk to reward. So what do I think is a good risk to reward? 1-to-1. So if I'm risking 1,000, I'm trying to make 1,000. If I'm risking 2,000, I'm trying to make 2,000. So that is how I look at my trades. I don't want to take a trade and risk 2,000 and make $200. I don't think that that is good odds. Okay. So we're going to go over 1 week in the room. I should have put last week in here, but this was the middle of March. My average risk per trade in my day trades, again, these are margin trades, is about $5,000. So let's go over a JPM. So this was 3.9. Okay, this is a day trade. Let's go back here, 3.9. You see this? So JPM closed here, gap down, fell. See that tail? We did a short here. This was March 9th. So entry was 285.25, exit was 283.50, got in, got out, shorted it with 2,000 shares, got out, made $3,500. That was right here. Again, you could take less size. Could have taken 500 shares. We got in, got out, and that tail. So that was Monday. Tuesday, 310, no trades. We didn't do any trades there. Then 311, we did BA. Here's the BA. Stock closed here, gap down, fell. So we shorted it 216.50, got out at 215.30. Actually, I could have held this. This kept going. Profit was $3,000. Again, if you don't have a margin account, you could buy a put. Okay, you could just buy a put. And actually, you could have bought a put and you could have held it, actually. So that was on Wednesday. And then Thursday, we did BA again. Fell again here on the 12th. Stock closed here, gap down, had a bigger move. You see this here from tip to tail all the way down. Entry was 211, got out at 209.75, made $37.50. Again, this is on Thursday, the same week. And then we did Amazon on the 13th. Where are we here? Here. Stock closed here, gap down, fell. Shorted Amazon 209.50, got out at 206.40, had 4,000 shares, made $12,400 just from that little bar in the Amazon. And then I also took a stop in the first Amazon and lost $52.50. So that was 1 week of trades. And again, my average risk is about $5,000 a trade. And last week, it was the same thing. We had one loser last week, and the rest of the trades were. So on average, we're doing 1 trade a day, maybe 2. But most days we're only doing one trade a day. And then on the 16th, what did we do here? Oh, we did CBX on the 16th. This was a long though. 196.60, got out at 197.30. We've been doing calls in this too, but this was actually a day trade where we went long, 2,800 here, right there. That was on the 16th. Again, Chevron is oil. So if you want to hold this overnight, the best thing to do is really to do calls, because when you're doing an option, you have a fixed risk. Whereas when I do a day trade, I'm in and out very, very quickly, and I'm flat before 4 o'clock every day in my day trades. So anyways, you know, that was 2 weeks ago. I should have put this last week, and we had a bigger week this past week, or the week before that, the week ending the 20th. But, you know, whether you want to do this for full-time or part-time, you have to take it seriously. And I think that's the whole point. I think a lot of people do not take trading seriously enough. Yes, making money is fun. Yes, trading is fun, but it's not fun if you're losing. And this is one of these things, even though if you only spend a half an hour a day doing it, you still have to take it very, very seriously during that period when you're focused on it and when you're doing it. Does that make sense? So step 1 is learn a good system. Step 2 is have a good mentor. And step 3 is add size to earn more money. So everyone wants to make all this money. Well, guess what? It only just has to do with adding size once you have a good quality strategy. So again, if you have a small account, I use the example of an options account with $2,000. Obviously, you can't risk $2,000. That'd be your whole account. I'd only risk about $100 or $200 a trade if you had that size account. So you grow your account if you have a small account. And even if you have like a prop account, if you're day trading on a margin account and have a prop account, You start out slow, you grow it. So over time, you trade with small size, grow your account, and then you can add on the size later. And over the while, hopefully you're getting good at it, you're learning the system, and you're getting conviction in it yourselves. And again, the whole point of trading obviously is to make money, but if you are someone that doesn't understand what to do, it's going to be difficult for you to make money. And this goes back to the whole point of learning from to begin with. So you can't go hog wild and risk all kinds of money if you have no idea what to do, or if you don't have a good system. Again, sometimes people take trades and they make a lot of money and they get excited and they think they know what to do, but they really just took a crappy trade and just got dumb luck that they made money. And if they replicate that same thing over and over, they'll lose 10 times over. So it's about the consistency. And again, that's why I showed the stats at the beginning for the room, having more winners than losers. And no matter how much you risk, whether it's small, beginner, an advanced trader amount, you will get there over time if you learn it and do it. And again, I've been doing this now for 20 years and I've been doing nothing but my system. So, I'm risking an advanced amount. But getting back to what I was saying, one pick is all you need. You don't have to trade all day. I do not trade all day. Again, I'm in and out of the trades very quickly. I want to talk a little bit here about options. I know people like options. But as far as options go, for me, it's not even about the cost. Even though, yes, the market's very expensive right now to do as margin trades. And so doing options is cheaper. Really, for me, one of the biggest benefits to do options is this idea of being able to hold overnight with a fixed risk. And particularly in this kind of market. Now, some people don't like to hold overnight. I get it. They don't like to do that. But actually, you can do very well if you hold overnight and the stock or the ETF, this is the diamonds, we're going to go over this trade in a minute, goes in your favor overnight versus just buying the stock or shorting the stock outright on cash or 2-to-1 margin, and then you could lose an unlimited amount, which you don't want to do. So you have a fixed risk, when you take an option. And then the benefit is if it goes in your favor overnight, you can make more than it would move on the live day. You follow me? So for the people that are interested in options, I have a newsletter. So this trade went out in the morning at 9:09 a.m. You can't take the trade until the market opens. This was 3-2. We did the diamond puts, the 480s that expired 3-6. So let's look at the gap here, the 480s, 3-6. So here, closed here, gap down, fell, boom. So again, this is a daily chart. Stock closed here at one number at 4 o'clock and gapped down here at 9:30 and fell. So you could have bought a put. Again, you could have bought one, you could have bought as many as you wanted to. The cost was pretty reasonable, $250. And again, I'm trading an advanced trader size. I've been trading for 20 years. 87.50, profit was $13,125. It was 150% return investment. What if you did a smaller risk? What if you had a beginning account? You could have done 4. Again, you could have done 1. You could have risked $250, but you could have risked $1,000 and made $1,500. So again, this is the gap. Let's go back to the chart here. Close to your gap down, fell. And so again, this is on the daily chart. Okay, see that? And again, we did market puts last week, actually. Again, the market sold off. So getting back to size and small accounts and big accounts, the only difference between a beginner trader, intermediate trader, and advanced trader is size. But again, you can't trade size if you don't know what to do. If you had more money, you'll just lose it. Everyone says, well, if I had more money, I could make it. No, if you don't know what to do, and if you don't have a good system, then you're going to lose more. That's all that will happen. So you still need a good system, and you can do well even with a small account, and you can grow it with a good system. If you have a lot of money, it doesn't matter if you don't know what you're doing and you don't know how to trade and you don't have a good system. So a trader cannot risk more money per trade and take size until they know how to actively trade over a period of months. And for sometimes people, it takes years. Some people really are lost and don't know what they're doing. Some people are brand new. Again, I've taught people that have never traded before. But obviously size is your goal, building your account up is your goal. And one play with size can really make your whole week. Again, you can pull up the chart of Mu. It was a beautiful, beautiful sell-off today in Mu. Actually, that's been selling off. But today it had a really big move. So one trade like that can make your whole week. You know, can make your whole month. And 2 or 3 great plays a month can make your whole month. And months when you get lots of huge plays, which we had in March. Again, we had a lot of good shorts in March and got things to big targets. That's why you say, okay, this is why I'm doing it. Again, if you're in 5 options, I say chunk it out. Don't hold everything forever. Get out of 3, hold 2. Get out of 4, hold 1. You know what I mean? Not everything goes to a big target, but some things do. And again, you want to give yourself the chance. So you've got to keep chunking it out. Take a trade, book it, get it out. Anyways, getting back to the risk to reward, it's usually 1-to-1. But you know, if you're someone that wants to day trade and you don't have the $25,000 to open up a margin account, which is the requirement at a retail broker, then you can go prop. You have to learn about prop accounts. There's many, many prop accounts out there. And it's something that you want to do, then you just look into it. Again, there's lots and lots of places, lots and lots of things. You don't necessarily have to go with a retail place. I would just do your due diligence because there's a lot of prop places out there. Some of them you have to put up money. Some of them you have to pay a fee. You know, you have to go through the process and check them out. Or like I said, you can do options. Okay, so let's go back here to options here. The QQQs 590s we did. This was back 3-2. Let's look at the daily chart here. The QQQs 3-2. Here. Closed here, gapped down, gapped up, gapped down, gapped down, gapped down. So again, we did the 590s. So this totally fell. And again, this is into the 27th. This is not the whole month. I wish I had the whole month. But this is where we were actually. You can see now from the beginning of the month down to here we were on Friday. And then we were lower even today. So again, we did the 590s. See this here? Right there. So this trade was 350. Again, sold at 675. Profit was 81.25. Return on investment 93%. Good trade. Really nice trade. Again, this is an option. What if you wanted to do a smaller size? 4 contracts, 1,400. Sold at 675. Profit was 1,300. Return on investment 93%. Again, you could do one. You could have spent $350 and done one. Okay. So you can build up your account. Again, do one contract, take the trade out, book it. Do another one, book it. You know, every time you take a trade, if you're in a trade, the money's being used up. You say, well, I want to hold it. Yes, but if you exit the trade, you book the money the next day, guess what? The profit's back in your account, plus the money that you used to take the trade is there for you to do another trade. So my options letter is a very, very active letter. I mean, there's some days I'm in, 10 things at once. That's a lot of trades. Again, we've been very, very active lately doing options. And most of them have been puts, again, because the market's been falling. But you don't necessarily want to hold every single thing. Any other questions here? So again, set your goals. Look at how much money you have. If you want to day trade, we trade in the morning, the first half an hour. If you want to do options, you do not have to be in the room. Okay, those trades go to your go to your email. And I would sit down and make some goals for yourself. So again, if you're someone that is a slow learner, it could take you a couple of weeks, it could take you a couple of months, it could take you the rest of the year. Again, I think following my trades in the room live will help you get there, but you still have to take the trade yourself. You still have to size the trade yourself. Okay? And I think having goals really, really will help you. So get clear with your goals for becoming a trader. Face the reality of what's going to take for you to be successful. And I think that's important for people. I think people are back and forth constantly jumping from thing to thing to thing, and they wonder why they never get anywhere. You will only get somewhere when you decide to be serious about it and you commit yourself to doing it. So, I mean, you have to think about it. Time is money. Like I said, when I started trading It took me 3 years. I thought I was going to be able to figure everything out in 6 months, and then it took me 3 years. And now here I am. It's like, like I said, it's 20 years later. So time really flies. But if you're someone that's been attempting to trade the market unsuccessfully for a very long time, how serious have you been about it? It's not about a get-rich-quick thing. You really do have to invest your time in learning and understanding what to do. So think about where you want to be at. Create your future goals. Again, it's only March. Well, I mean, it's a couple days. It's going to be April, but it's still very early in the year. So you have the rest of 2026 to get where you want to be. And I think change of seasons, earnings season, spring is a good time to really, really, start something new, start a new project. Spring cleaning, ever hear about that? Anyways, we were talking about inflation earlier. Again, I discussed this on Fox. I think there's a possibility we may have no rate cuts this year. That is going to be very, very disappointing for the market. And I think a lot of people are going to be upset about that, who expected 2 rate cuts this year. We may not even have 1. We might have a rate hike. I mean, nobody knows how long oil prices are going to be inflated. So as costs go up, as things go up, you kind of start to realize and say, wait a minute, I have to decide my own course in life. You can't rely on other people to make things happen for you. And, look at the government shutdown. That's another example. How the government shut down people that work for the government and weren't getting their paychecks. You feel so bad for these people. So when you get to the point of realizing that you can decide your fate and you could do something different, you know what I mean? And that's really what I was at with it. When I decided I wanted to trade for a living, I wanted a brand new career. But you've got to have a focus. You've got to have the right knowledge. You have to have a successful system. And you really have to stop wasting time doing crappy trades and taking bad classes. A lot of people go back and forth doing a million different things too. They're doing futures, they're doing Bitcoin, they're doing crypto, and then they're always looking for the get-rich-quick thing. And it's just not like that. There is some time involved and investment involved in actually, moving forward and actually learning how to do it. So take charge of your own finances and your own life, And again, don't waste years of your life trying to make a little bit of money while you're actually losing money in commissions in the market by taking plays and doing trades that are not of value. Learn what trades are valuable. Don't waste time trading for months and years with no conviction. Again, you need to have conviction in what you're doing. And I think that's really important because, again, you're putting money on in a trade. You want to do well. So empower yourself today to become a success. Take actionable steps to make it happen. And again, think about it. You want to do something different. Again, when I started trading, I realized very early on that I wanted to short. I wanted to do gaps. I realized that stocks actually fall way, way faster than they rally. And then that's how I really got into it. So anyways, if you're interested in learning my method, it's called the Golden Gap Course. It's a complete system to use to trade the market. You learn the 26 points. You learn all the entries. And the next class is not until the end of April, but you will learn a checklist, and it's invaluable. And this is basically the blueprint that you can use to trade every day and make your stock picks. And you have to invest the time and energy in yourself. This weekend was funny because I guess it's a basketball weekend. So there were people there and there's a basketball going on. But listen, you have to take time to do something for yourself so you can move forward. Any questions here so far?
Hi, Melissa. This is Greg Lewis, the marketing manager. Jeff had to step away for a family emergency. Nothing to be concerned about terribly, obviously enough for him to step away. I don't see any questions or comments. Today's audience has been particularly apparently satisfied with all the comments because they don't have a lot of questions.
All right, I'll just finish up here. Then I didn't know Jeff had to leave. Anyways, I teach a class. It's called the Golden Gap Course. It teaches a strategy on how to trade gaps. And the course teaches a 26-point rating system to find the best stock to trade each day. The course also teaches you how to play the stock in the day. And the course teaches you chart analysis and technical analysis on an advanced level. So the class is 2 days. It's all day Saturday, all day Sunday. And it's a full 2-day course on how to strategically find, pick, and place stocks that are professional bearish gaps. So the next class is not until April. It's April 25th and 26th. And I'm Eastern time zone. I'm in New York. And then the trends course is April 28th. So the combo price is $79.99. Class is online. You can be anywhere in the world to take it. And I'm doing an Easter special because it's a holiday, which is going on until next Monday. If you sign up by Monday, which is a week from today, the 6th, April 6th, you will get the trading room free for 1 year, the options newsletter free for 1 year, the market report free for 1 year, and 2 one-hour mentoring sessions, which is great. So this ends on Monday, the day after Easter. So I think I got done here on time. So any questions? Anyone want to email me at melissa@thestockswoosh.com if they have any questions. And looking forward to seeing where this market goes again tomorrow. Again, big sell-off again today. You know, be careful out there for those of you that like to buy dips. Again, that's not what I do. But we're in a very, very weak market environment.
All right. Well, I'm sorry. Is that refinished? I didn't mean to cut in early.
Oh, that's okay. That's fine. I was just looking at the clock. I saw it was 6.
Yeah. No, you're fine. And thank you so much for your presentation today. I enjoyed it. I'm sorry, I'm not as good at this as Jeff is. I'm not quite accustomed to being I'm usually the guy behind the, pushing the buttons, pulling the levers.
Oh, there you are.
Thank you. There I am. Thank you so much, Melissa. Today we did very much enjoy our presentation. I don't think there's anything else that anyone's asking. So thank you again.
Thanks for having me.
You're very welcome.
Thank you.
All right.
Happy holiday.
Thank you. Yourself as well. Thank you. Okay, so I'm going to go ahead and change this over to my desktop. Just one moment, please. Okay, I think this is looking right. I'm sure if it's not, somebody will let me know soon enough. Thank you again to Melissa Armo from Stock Swoosh for her presentation today. Really do appreciate it. I did mention again that Jeff Gibby, who would normally be closing out this event, who's the host of today's event, was called away early. There was a small issue, a medical issue with his family, nothing to be terribly concerned about, but he did need to leave. And we do appreciate Jeff always for his efforts. But and it takes quite a bit actually to get him pulled away from the desk. So we do appreciate that. Let's see. As we are ready to close this event out, let me see if I know. Okay. Once again, we'd like to thank one of our sponsors, Stocks, a technical analysis of stocks and commodities. They have been a partner of ours for just ever and a great partner indeed. To find out more about them, go to metastock.com/traders summit. And that's not actually what I wanted to say. There is a link that I have put in previous parts of this. Boy, I'm not doing this very well at all. Okay, there is previously in the conversation here, I put links on how to get that. You can go and find that right now. Next. The Traders Forum. Do take advantage of our Traders Forum. Jeff Gibby runs that, and he does a really great job, and I know he'd appreciate any of you attending. It's a great way to get information from other traders and also to join a community of like-minded people, and just go to www.thetradersforum.com for that. Finally, we are, of course, MetaStock. We do appreciate everyone who presented today. I can tell you that almost all of our presenters do use MetaStock, and we really appreciate them for that. If you want to find out more about all of the presenters' add-ons that are using MetaStock, you can go to metastock.com/summitdeal, or give us a call at 800-882-3040 or metastock.com/saleschat. Finally, there is a group deal, I should say action pack available. If you'd like to find out more about that, you can give us a call again at 800-882-3040 or metastock.com/saleschat. Let me take this one last opportunity to say MetaStock is a fantastic way to answer the questions that every trader should be asking themselves. When should I get into a trade? How do I find trades in a universe of securities? when do I get out of a trade, how do I test my trades. It's a fantastic product, and I know you would appreciate it if you tried it. You can go ahead and give us, again, 800-882-3040. They can get you set up with a trial, or metastock.com/sales chat. I think that's the last slide I have. Yes, it is. All right. Thank you so much again for joining us for the Trader Summit. We really want to send our appreciation to all of the presenters and say thank you to everyone that listened today. Please don't hesitate to contact us for any questions or comments. Thank you again so much for joining us, and successful trading.